Hello everyone, welcome back to our channel. And if you're new to this YouTube channel, I request that you subscribe and also hit the notification bell icon so that you can stay connected and notified whenever we upload new videos. And if you are a returning subscriber, I really appreciate your effort for trusting our work and for continuing to support us. We are dedicated to provide you with everything about accounting and finance, accounting and finance. So thank you so much for your support. Now let's dive in and get started. We are going to look at financial management, and this is going to be our lesson 1. Is going to be our lecture number 1. So this is financial management. It's financial management paper, and this is our lecture number 1. And my name is Charles Kafel, and I will be the one taking you through this course until the end, including even the revision lectures. Here, you will need to have some idea or some understanding of quantitative techniques, and this is a paper that we do at CPA level 1 and even financial accounting. So we shall be having these disciplines: financial accounting and even some business law. And I'm very sure by this time you must have done these at your level 1. And the reason as why you should have those is because we are going to look at things that are going to be related to some of the things that we do from those different courses. Because there are things such that when I say this is a financial report or a financial statement, then you'll be able to understand what I'm talking about. However, the journey of financial management starts here on level 2. This is where we are starting our journey of financial management. So for CPA course, the journey for financial management, it starts on level 2. And then we shall conclude it with advanced financial management. That is when you reach level 3. And I will be the same person taking you through the same advanced financial management when you reach there. So without wasting more time, let's now look at the paper structure. The paper structure of financial management, FM. Now, financial management paper is made up of 2 sections. That is section A and section B. Section A is 40 marks. It's marked out of 40. And there we have only 1 question. We have our question 1. And then section B, for section B, is made up of 4 questions. 4 questions from which we are supposed to attempt only 3. So we attempt 3 questions from section B. And each question takes 20 marks. And of course, I repeat this same breakdown of the paper structure when we reach to our revision, so that we can be able to explain more on the question approach. But right now, I just want you to understand what we have in these different sections. Meaning the section B is going to be marked out of 60. So when you get the section B and section A is 40 marks, that makes it 100%. So that's the paper structure. Now, let me just give you a brief idea on question approach, because this is very important. And let me give you the question approach so that by the time we go to doing some numbers, you actually know what you are looking for. So we are getting these basic principles from the start. Now, one thing that I want to let you know is that we have a Telegram channel. We have a Telegram channel, and the link for you to join the Telegram channel is on this same YouTube channel. So the link is within the About section of the YouTube channel. The About section of our YouTube channel. That's where you are going to get the link that will connect you to our Telegram channel. Now, that Telegram channel or group, what is the use or what's the reason behind that Telegram channel? We created that channel specifically for you to join and also receive documents, receive the recent communications, receive all the necessary documents, notice, and other information that are in relation to accounting and finance. So anything to do with accounting and finance, anything that you need as a profession in that docket, you'll find it in that Telegram channel. Meaning we are not only sharing things to do with the CPA, there are things to do with the SCCA materials, there are things to do with CIMA materials, there are things to do with the CFA, there are things to do with the FMVA, there are things to do with BIDA, there are things to do with accounting. There are so many things that you are going to find in that Telegram channel. And it's the same channel that we use to submit the past papers and the different marking guides. So the reason that's why we connected that link there is because we want you to join and be able to download these course materials, the past papers, and the class notes. So that's one thing that I wanted to emphasize straight out from the beginning. So we shall have the course materials and other things that are related to accounting and finance. Although you may also get some assistance using our WhatsApp number. It's +256 775 771 676. That's our WhatsApp number. That's my WhatsApp number. So we also provide assistance from there, but most of the things that we need to download, they are within our Telegram channel. And the link is in the About section of the YouTube channel. So that's what I wanted to clarify. So let's look at the question approach, because this is very important. If I'm to start answering questions, what should I start with? That's what we are going to look at for now. Now, I'll give you the options that you may be having as a student, but I'll also give you my preferred approach. So I prefer to assume that for every section B, let me start with section B. Section B, question. In other words, those questions, section B, each student should take only 36 minutes. So for every question in section B, for each question, for each question, a student must spend a maximum of 36 minutes. Because there are going to be three questions that we are going to choose from section B. And that is very important. So we need to be disciplined on time management. So if you don't respect that, then you may have challenges. And for section A, because this section A is compulsory, only one number, and it is compulsory, and you have to attempt it. So we must spend a maximum of 72 minutes on that question 1, whether you like it or not. That's as per time management. So what we are trying to do here, we are trying to manage the time, because most students fail not because they don't know, but it is all about time. If you don't time it yourself, you will not get it, because you can spend 2 hours on question 1 and you actually don't finish it. But for you doing only section A will not make you pass, because section A is marked out of 40 and you can't get it. You may not get it 100% right. So that's why we have to put in the aspect of time management. So the reason as why we are deciding that way is because the FM paper has 3 hours and 15 minutes, where you are told that you should spend the 15 minutes, you should spend the 15 minutes reading through the question. And we need to have a note on those 15 minutes. Let's make sure that we don't spend the 15 minutes reading through question 1, because we can't finish it. The 15 minutes, we shouldn't spend them on question 1. If they tell you have used the 15 minutes to read through the question, then you should not focus on section A. This one should be only on section B. The only thing that you can read about section A, you can only read what is required. From section A, just see what do they want us to do. You just look at the required, and that's it. After reading the required, just rush to section B. So within the 15 minutes, you should only read the required, because after all, even if you don't read the section A, even if you read it, it is a must, you have to do it. So whether you like it or not, you will have to do it, and you will be forced to read it in the end. So, but we said that we should spend the 15 minutes reading through section B and only reading the required from section A. What are they interested in? And that's it. And for section B, because there are 4 questions then you are going to make sure, because there are 4 questions and we are selecting 3 questions. These are the ones that we are supposed to select only. Then it is important for you to read through those 4 questions that have been provided to you, and only select those 3 questions that you are going to do. Therefore, at least in the 15 minutes, you must be able to choose which questions you are going to attempt. So from the 4 questions, you must select the 3 questions you are going to do. But you should always choose the most doable numbers, the most doable questions. By choosing the most doable, the interpretation for most doable is that you can maximize points. In other words, where you can get maximum marks. In other words, choose those questions where you can get at least 15 and above. Why are you going to make yourself stranded by selecting a question where you only know you can get 5 marks correct? The rest you will just be gambling. If the question is hard, it is very possible that the paper is very hard and you can't be sure of what you want. At least select the 3 that you can try. Within those 3, if you have 2 and you are very sure maybe you can get 15 and above, the 2 numbers you can get 15 and above, then that will be okay. Because we can't make ourselves comfortable that we are going to pass number 1 and we get 40 out of 40. So if you have made the selection, now what is next? What is next here is how are you going to start answering the questions? Because that's also important. How do we start to answer the questions? So how are we going to start answering those questions? This is very, very important. You can forget everything, but don't forget this step, because it is the one that is going to make you time yourself well, or it will make you fail. So we have agreed that section A we are going to spend. We say that section A we are spending only 72 minutes. Remember, this one is 40 marks. And in section B, because we say that in section B we have section B, we have 3 questions, and each question we are supposed to spend 36 minutes. So it means in the section B we shall spend 108 minutes. These are the minutes that we are supposed to spend in section B. So this is now the issue on how do we start answering the questions, or how we should start answering. Let me give you options. A student may decide that I'm going to start. There are 2 options. You can choose to start with section A. For section A, I'm going to call it A. And then for section B, I will call it B. So you can decide to start with section A, and then you end up with section B. Remember, section B has 3 questions, so there are going to be 3 Bs. Now, The other aspect is that you can start with section B. Those are going to be 3 questions. And then you end with the section A, because section A has only one number. But since section B has many questions, because we are seeing section B has many questions, there are 3. So since section B has many questions, I prefer that you start with 2 questions from section B. I repeat, I prefer that you start with 2 questions from section B. The 2 questions from section B, they are going to be B. So those are 2 questions from section B. Now, since we have, now when you look at the time, we are using 36 times 2. So meaning we are taking 2 questions from this. The time that the full time that we have is 108. So meaning we've spent 72 minutes on these 2. So the issue is when you have spent the 72 minutes, but remember you have section A which will take you more 72 minutes. What you do, you come here and do section A. So when you do 2 questions from section B, you do section A. Now you will be left with 1 question in section B. So when you are done with the section A, you can come and write the section B number. So my preferred approach is for you to start with 2 questions from section B, then you do section A, and then you finish with the section B. And why do I choose that? Because if you start with the section B, 2 numbers, then section A, and then B, section B. The gist of the matter is here. You must start with section B, you must start with those numbers that you can maximize. Maybe you can get 15 marks each. You can get 15 marks from each. So if you can get 15, that will mean that that is 30. Remember now, the challenge is we are going to spend a lot of time on section A because it needs you to read the scenario and you interpret it. So most of the students, they don't actually spend the 72 minutes. They spend more than this. So since we are going to spend more time on section A, this section A, even if you just get 25 out of 40, it is okay. 25 out of 20 is because you are going to spend, let's say we've spent more than the 72 hours. And maybe instead the other question that we are left with, it's supposed to be for 36 minutes, and we find ourselves spending only 25 minutes. Maybe we are only adding there 25 minutes. So within these 25 minutes, even if you just get 8 out of 20, it is okay. When you sum up the 30 plus the 25 plus the 8, you've already passed. You find yourself you have already passed, because this is going to be 55, then this one is going to be 63%, and you've passed. But the issue was for you to manage time well, because here you surrendered over 11 and you added to this one. You surrendered over 11 minutes and you added to this one. So it becomes 83 minutes. Because the reason why we end with the section B is because this question, maybe it wasn't very easy for us. Otherwise, if it was easy, we would say we are going to do BBA. If it was easy. But it is very hard for you to find all these section B numbers are going to be very easy and you can maximize them 15. It will be a little bit hard because they are going to be involving some calculations. So it is always better to go with the same idea, B, B, A, B. Even if the numbers are very easy, all of them are very easy for you to do, go with this format. Because if you use this BBA, by the time you reach to section A, you are already frustrated, you are tired. You've spent a lot of time on these ones. You are already tired. You can't even read the scenario. That's why we prefer you first do the two numbers and then you start section A when you are not all that old, when you are not all that tired. By the time you go to this last number, even if it is very easy, you will be tired. So when you are tired, you'll find yourself not maximizing it, but at least you have maximized this first one. So that's the reason, or that's my preferred approach on how you can be able to answer those questions. So the key things to take out from this before we look at the requirements, because we need to look at the requirements that we need for FM paper. So the key takeaways here is we shouldn't use the 15 minutes to read section A number. We should read only the required from section A. Then we concentrate on those 15 minutes and we finalize them with selecting the questions that we are going to attempt. So that's what I wanted you to have from that point. So we need now to look at the requirements. What do we need to have? You are supposed to have a study material, and we said you may be having a book, you may be having a workbook, anything, a pamphlet, a handout, so it can be anything. But we said from the start of this lecture that you can download those notes from our Telegram channel. So those ones are sorted. You need to have at least a study material. These study materials, they may include past papers, because these are very, very important. Past papers. So the reason is why I prefer to make some of these notes, because even when you have these study materials, make sure you make notes for your own, because your own handwriting, your own notes that you've made from the summaries of the lectures that you had is very important than carrying a 500 textbook that is going to make you look like you are going to just be there reading all the time. So it is more for you to listen to the lectures, make the notes for yourself, then use the other one as just additional materials for you to make research to, or to get some deeper explanation of certain things. So we said you can download the study materials, the past papers, and the solutions from our Telegram channel, and the link is on the same channel. But the other second thing I want you to get is a training plan, or what we call the course outline. There is a course outline for CPA financial management paper, but I also have my training plan that we are going to be following whenever we are taking these lectures, and it's also going to be in the same Telegram channel. So the training plan is like the course outline or the schedule that we are going to be following. So on my training plan, I also created a link, because I make sure that every topic we do, we link it to the exam past papers, so that when you check the schedule, you can know where some of those questions, or which questions can they set from the things that we've covered. So I make sure I highlight the courses. I highlight the outline, then we look at some of the questions. So when you look at the training plan, make sure you follow up those questions to see what they actually said there. So the second thing is you need to have a scientific calculator, and you don't actually need to just have it, but you have also to understand how to use it. So it is very important. So you should have a calculator and even the exam syllabus. Of course, the exam syllabus, even if you just use the training material, because I developed the training material from the exam syllabus as it was revised in 2023. So just know that the training plan was designed out of the exam syllabus. So the third thing that we need to have, we need to make sure that we revise the theory almost every day. Even if you just give it 15 minutes, it is okay for the theory, because we need to have the theory. But there is also a website where you may get some more. It's called Investopedia. This is a website for financial managers. So you can go there in case we have, maybe I've highlighted something and it is different to what you knew, then you can check it out, check that website and be able to have something that can enlighten your understanding or change on what you've been knowing. But otherwise, you don't need to make any research. The training plan that I developed is actually catering for it. Now, this is our training plan, or what we call a training schedule. It was developed from the examination syllabus, and it has, or I linked it to questions that have been set from the different topics that we may look at. So that's how we are going to be moving. So we have the topics, we have even the questions that are within that. So you don't need to make any research about anything, because we are going to be having everything. Remember, I said that there is a website for finance managers, and I called it Investopedia. So if there is anything that maybe the way I've internalized it is different from how maybe you learned it somewhere, you can actually be able to research there, and we'll be able to reconcile on the things that we've discussed. But if it's not that way, then we may not have any issue. But what I'm only requesting is that you follow the guideline. You'll be able to join the Telegram channel, download the course materials, download the past papers, and have everything in place. So you don't need to get any pamphlet or make some research on your own. Just know for financial management, I've researched everything that you need to know as far as the CPA paper is concerned. So that's how I can describe, or that's what you need to understand as far as introduction to financial management is concerned. So let's dive in and get started with learning. So here we have some kind of homework as we are starting to go through our learning. So we are kickstarting our learning, but here we have something like homework. And it will be upon this homework that will guide us on the things that we are going to cover today. For this homework, by the end of this lecture, we should be able to at least answer some of the questions that we have. So without wasting more time, let's look at, there are two numbers. We are going to have two numbers, but these are basically on memo and report. A memo and a report. So the homework is going to be on those two aspects. And that's how I want us to start for our lecture. So let's first present the homework. So we can expect that if you are done with your homework, you can actually share to this WhatsApp number, +256 775 771 676. And the reason why I kickstart with something like homework, it is going to give us a target of certain things that we are going to handle. So this is a WhatsApp number where we are going to be able to submit all our homework. So this is homework, and we are supposed to present your work after say 2 weeks. Let's just give it 2 weeks. So we have two questions. There are two questions, and they are requiring us to do either a memo or a report. So by helping us to understand that, in other words, if you do the work, you'll be able to understand, and I'll come back and I make some guidelines. But we are going to look at how do we prepare a memo and how do we prepare a report. The reason as to why I'm starting with these items is because the examiner is going to be looking at you as a finance manager. So finance managers, they are supposed to be submitting reports. So we are going to look at, that's where I wanted us to start from. So let's first look at the questions. Hope you've gotten the WhatsApp number. So question one, it says you are required to write a memo to the managing director of KC Group, explaining the functions of finance manager, finance controller, treasurer, then the treasury, and the role of a treasurer in a multinational company. Then we also provide the merits of a centralized and decentralized treasury function. So that's our question one. You are required to write a memo to the managing director of KC Group explaining the functions of finance manager, finance controller, treasurer, the treasury, and the laws of a treasurer in a multinational company. Merits of centralized and decentralized treasury function or department. So that's our question 1. So let's look at question 2. Question 2, it's a scenario-based number. In a company, an agency problem may arise between management and shareholders. On the one hand, and debt holders, in bracket we have the creditors and lenders on the other hand, because management and shareholders who own and control the company have an incentive to enter transactions that may transfer wealth from debt holders. So in a company, an agency problem may arise between management and shareholders on the other hand, and debt holders, those are creditors and lenders on the other hand, because management and shareholders who own and control the company have an incentive to enter transaction that may transfer wealth from debt holders in lending contracts. So the company is now called KC. Let me just call it K2 Limited, a company operating in central Uganda, has hired you as a financial advisor to the managing director, and the managing director has requested you to write a report and address the above issues as follows. So these are going to be now our questions. Part A, you are going to highlight the various measures that would minimize agency problems between owners and management. Part B, you are going to define agency relationship from the context of a public limited company, and briefly explain how this arises. Then we look at part C. Part C will be saying state and explain any four actions or transactions by management and shareholders that could be harmful to the interests of debt holders. In other words, these are the sources of conflicts. So we look at part D. Part D will be saying, briefly explain any four restrictive covenants that debt holders may use to protect their wealth from management and shareholders. Then part E we shall explain the three forms of business formation. Explain their merits and challenges or demerits. So that's the end of our homework. So end of homework. So the reason as why I started with this work, we can see this homework, the whole of it. So that's our homework. And it's all about a report and a memo. So that's where I've started. And that's how I wanted to start this lecture, by giving you homework that we can finish in 2 weeks. The reason as why I gave you that homework is because whatever we've highlighted in that homework, we are going to have it. Now, by looking at those two numbers that we've just given as our homework, it means in the homework that we've got, we shall be able to understand some of those things if at all you try to do it on your own. In the homework number 1, they wanted us to write a memo, and homework number 2, they wanted us to write a report. And the reason as why I started with it is because the examiner will also expect you to know how to write both the report and the memo. And that's where I want also to start our learning lecture. And whatever we see, or whatever we will see in these questions, these above two questions that we have just highlighted, will be handled 100%. So just stay connected and we shall have everything done. So the memo, we are looking at memo and the report. The question is, how do we do our memo? So my first lecture is going to start from knowing the difference between a memo and a report, because most of the times the examiner is going to be asking you to present your work in either a memo or a report format, especially under the advanced financial management, because here they are going to ask it, but not too often as it is in the advanced financial management. And that's why we need to understand these things from the very start. So that's why we need to differentiate to get the difference between the memo and the report. And the only way we can be able to do that is by looking at their formats. What is the format of a memo? In other words, what's the template? We are going to be looking at the template on report or memo writing or presentation. So these two things, they are very important. As I said, we need to look at the difference between a report and a memo. And we are going to use a template to get the difference of what these two items look like. So here I'm going to illustrate the template on how we do these two aspects so that we can see the differences. So we are going to follow the question. We are going to borrow some words from the question, these two questions that we have highlighted. But if not the case, then we can provide a small, just a brief question. We are going to use this scenario here as a finance advisor to the MD or to the managing director of, let me call it KC Group, prepare a report or a memo on the effects of, say, let's just go with COVID-19, because that thing disturbed people, disturbed all of us, to the financial performance of a company. So we are going to basically look at the effects of COVID-19 to the financial performance of KC Group. So we know the effects. We all know what COVID-19 is. That one we don't even need to explain. But as we are writing, if it is the question, then you have to put you have to put something in context to actually explain what COVID-19 is. Then we have to look at what was the impact of COVID-19 on the financial performances of the company. So it is actually a very good question that we can look at. So we are going now to be looking at the formats, but bearing in mind that the question we are looking for is, we are preparing, you can't prepare both. In an exam, you are supposed to either prepare a report or you prepare a memo. You should get that from the beginning. So now, there is a simple assignment which we've just written here. As a finance advisor to the managing director of KC Group, prepare a memo and you prepare a memo or a report. And as I said, you can't prepare both in an examination. But since I'm going to be teaching it for the first time, then we will need to see how these two actually look like. So we shall prepare both here because we are learning. And the topic that we have is the effects of, or the effect of COVID-19 to the financial performance of the company. So the effects of COVID-19, you know them. But what I'm only interested in is, how do we write a memo or a report? So these are the things that we are going to basically focus on. So let's look at how we can start by looking at, maybe we start with looking at a report. So we wanted to start with a report. So when writing a report, we always start with a title. The first thing that we have to deal with is what we call the title. So we don't need to forget the title. So for a report, we always start with the title. And we don't need to write the word title. What we just need to do, we just need to start the effects of COVID-19 to the financial performance of KC Group or ABC Limited. And that's going to be our title. And that will be followed. So from there, we are going to indicate, or it's going to be followed with who we are writing to. So we shall put to, and then semicolon. So we indicate that this report is going to any other person that we have in the question. So the question was going to the managing director of, let's say, ABC Limited, KC Group, or whichever company they have given you in the question. So this was going to be the second idea. So the next thing that we have to do is to make sure that we show where it is coming from. So who is writing? From who? Now maybe from maybe our finance advisor. It's the examiner will tell you, will guide you on who you are in an exam. You will see in the scenario that is giving you the title that you're supposed to call yourself. But most of the times we are referred to as finance managers. So the examiner may not necessarily tell you that you as ABCD, but you will see in a course in the case, and you'll be able to know who you are writing to or who is actually writing, and you're writing to which person. And in this case, we had ourselves as a finance manager. You can be anything. So whatever the examiner has called you, you can take it. But the other thing is, what we need to note from this is that even when the examiner has not told you, don't ever put your name, that Charles Kafero. No, don't ever put your name. If the examiner hasn't given you what you are, you can say as a financial consultant or as a consultant. It is from the consultant or the financial advisor. So the main thing here is to locate where it is coming from and then where it's going to. So the other thing is the date. Now for the date, we are supposed to be careful with the date, because we are supposed to use the exam date. In other words, it's always that day when you are sitting the paper. So in the exam, don't just put it, instead of putting the real date, or you've sat maybe the paper on 20th, let's say June, and for you just put exam date. No, you're supposed to put the real day when you've sat for the exam. And I hope that's okay. So from here, now we give a brief introduction. You can just come and you put the introduction here. Introduction, then you start giving your brief introduction. And in this case, you will talk about COVID-19. So those are the things that you will give as a brief introduction. So from that point, then you start looking at if there were parts, maybe part A, part B, part C, you also respond to each in a different paragraph. So you are going to be responding to the different parts, and each part should be on a fresh paragraph, unless there are no parts. If there are no parts, you can put everything in just one paragraph. But what is important is the format. Finally, when you have done talking about the issues that you are supposed to talk about, then you can come and say, you give your conclusion. And the conclusion should actually be simple, even if it is just one line or two. Then the other thing, because you may be having some workings, maybe you've done some calculations and other things. Maybe they were asking about ratios and you've done some calculations. You put appendices or the appendix, that working 1, working 2, but what is most important is that you are not supposed to sign. If you sign a report, it's like you have disqualified it. So you are not supposed to sign off a report. So at all times, never sign a report. So let's now look at a memo. For the memo, we don't have a title. Most of the times when you're writing, you just find yourself, if this is the page, you just come and put the word memo in the middle. You can even highlight it, you underline it, then you start to. So you start straight away to where it's going. So normally we don't have a title since it is mainly an internal document. So you start straight away to show who you are writing to. And in this case, they told us was the managing director. And then the next thing is to show where it is coming from. So it is coming from the financial advisor. Now from there, we have to put the date. But as I said, the date is always the exam date. It is always the exam date. So that same day when you are sitting for the paper, that's what you put. Then we are supposed to put a subject. Here you can also call it dear sir or madam. Then you put subject. Like the same way you write letters, you can put subject. So when you put this subject, most of the times it's supposed to be slanting in this format, that all these words are supposed to be starting here. And the next thing, you give an introduction, a brief introduction about COVID-19. Then we do the rest, because the rest are going to be the same as for the memo, sorry, for the report. And that's all that we wanted to show as the difference between a memo and a report. You've seen here we don't have a title, here we have a title. So now, however, the examiner doesn't care if you write either a memo or a report. This is very important for examination purposes. For examination purposes, if the examiner says write a report and for you write a memo format, it is okay. That is strictly for examination purposes. Don't say you are writing, someone has told you to write a report and you write a memo and you think it will be okay. This is for study purposes as per the examiner. So, because how we are going to be focusing on strictly writing reports, that's going to be in paper 18, that is integration of knowledge. Because there you'll have to read the cases that have been given to you, maybe in 15 to 20 pages. They have given you a case, then you read through the case, then the next shift you come and attend to the report. So that's where we shall be able to learn how we can write reports in the right way. But for now, that's what we can do. This is very important, and the reason as why I started with it is because most of the times they are going to ask in that order. Because if they say prepare, if the question is about ratios and they want you to show in a report format and you don't provide a format for the report, it means you are going to lose some marks. So this is how I wanted to start the lecture. And because I've already guided you on what we need to have, then we can now go straight into the real issues that we wanted to talk about as far as financial management is concerned. This was just something you needed to understand right from the start. So that's how I wanted to start this lecture, and I've already guided you on what we need to do. But now, when we are doing financial management, whenever we are attending on financial management, I'm going to be looking at you as a finance manager. And that's how even the examiner will be looking at you. So when they are asking you to advise on something, then they will call you a finance manager. That's how the examiner is going to be looking at you. So when you're a finance manager, you are expected to make decisions. So as a finance manager, you are expected to make decisions. And one of the decisions, you are supposed to do what we call investment decisions. And that's the role of a finance manager. For example, sometime back we saw the government during COVID-19, where they wanted to convert all the resources to constructing roads, those that we are going to Congo and so on. But the MPs were saying, no, let's buy food for people. So even you in your organization, you are supposed to make decisions. And those decisions you are going to make, you are going to guide your CEO or other managers. And the aim of making those decisions is to increase the wealth of the shareholders. Because it is the business is for those shareholders. They are the ones who put in their capital. So the moment we make these decisions is we want to increase the wealth of the shareholders. The other decision you need to know, but you have to note something. When the examiner asks you for the roles of a finance manager, one of them is to make investment decisions, as we've looked at. Now, the other is you are supposed to make finance decisions. Because if you say that we are going to construct, let's say we are going to construct a factory, we are going maybe to buy machines, and maybe it requires, let's assume it requires 800 million. Maybe you wanted to construct a factory, but it will cost us 100 million. Then the question is, where is that money going to come from? So you as a finance manager, you will identify the possible sources of funding for the factory investment that you are proposing. So for example, we saw sometime back what M10 did, and even of recent, even Airtel did the same thing by floating their shares to the public. In other words, they, instead of borrowing money from banks and other institutions, they went in for shares. They went in to borrow from the public. Therefore, as a finance manager, you will have to make decisions whether you are going to go for shares or you are going to go for a loan. And in this paper, a loan is more of a bond. So it is either going to be loan, we call them bonds, or debentures. not these small loans that we get, or we go for shares. Now for shares, we go to the public, but it is only for those listed companies or the public limited companies. Because now, the reason as why when we talk about these loans, we are meaning bonds and debentures is because we are looking at bigger companies. We are not looking at these small loans, because when you are talking about corporations or companies, we are talking about corporations like MTN, corporations like Stanbic Bank, corporations like Standard Chartered, are not these small startup companies. So when we are talking about corporations, we mean these big institutions, and they are the ones that we are going to be focusing on. So as a finance manager, you take more decisions, and ideally for these decisions, actually for now the order doesn't matter, but as we go on and on, when you are learning some of these things, you realize that actually the order matters, and you'll be able to arrange these decisions and to put them in the right order. Now, the finance manager makes 4 decisions. There are mainly 4 decisions. There are 4 decisions that the finance manager makes. We've seen 2. We have discussed 1, investment decision, and the second one, we've looked at the finance decision. The third one is what we call the working capital. Working capital management. It's also a role of a finance manager. Now, working capital decisions are short term, whereas the investment decisions are long term. For example, if you are going maybe to invest in, let's say, a butchery, it's a long-term project. And if you are going to buy, maybe, let's say you are going to buy trucks that will help you or that will be used in transporting your meat, then it's a long term, because that truck is going to be there for years. And I hope that makes sense. We need to understand that the short-term decisions, working capital decisions, are always short-term. So if you are going to buy the truck to transport your meat, if you have finally started your butchery, so since it is long-term, we will have concerns, because money will be there for a long period of time. But now you will need working capital to keep the business moving. In other words, you will be required to pay certain things that are going to be short-term in nature to keep the business operating as you wait to harvest profits from the long run or the long-term investments that you made. And therefore, working capital decisions needs to be done and understood. And later, we shall learn about working capital decisions. So now that's the third one. The fourth one, now, that is the third decision, working capital decisions. But we shall learn more about it, because under the working capital decisions, This is where we shall look at things to do with management of receivables. And that's why I told you that you need to have some knowledge of financial accounting, because the receivables are appearing in the balance sheet, and they are the ones that we call debtors, the people we've sold goods on credit. So therefore, if we are going to sell our meat on credit, then we should learn how to manage our receivables. Otherwise, if they are not paying us, we shall lack cash in the business. Secondly, how are we going to be managing our cash if we have those that are buying on credit, and we need to know how to manage them so that they can bring in cash? So when they bring in cash, plus those that bought on cash basis, how are we managing our cash in the business? Whether we are going to keep our cash or we are going to invest our cash. Then the other thing, or the third aspect under working capital, what of the inventory? Because we need raw materials. Even when you are starting your butchery, the animals you are slaughtering, they are your direct raw materials. So how are we going to manage our payables or creditors, those, especially those who give us those raw materials on credit? Therefore, those are the working capital decisions that you as a finance manager, you are supposed to make and take care of. So now, the last bit of the decision is what we call the dividend decision. This is the last decision that the finance manager do. Now, at last, when the company makes some money or they have made some profits, then you as a finance manager, you need to make some dividend decisions. And those are basically the 4 decisions a finance manager must know and make decisions on. Therefore, when I ask you a question, what are the roles of a finance manager? Whereas when you read through the notes, there are others, but these 4, they should never miss. So you can look at the notes and you add in some more, but these 4, they should never miss. But now there is some highlight I need to make on the dividend decision. Although dividend decision is something smaller, or it is a smaller topic in this level for financial management, on level 2 it is very small. We just need to know the theoretical things. But it is a very bigger topic in advanced financial management. That is on level 3. And on this level, the examiner only expects you to understand the following scenarios. These are the scenarios that we need to understand. 1, we need to understand whether you'll pay dividends or not. And it's all about the finance manager to advise the board on whether to pay dividends or not. But at sometimes there are concerns They are constants of what we call the M and M. These are Modiglian and Miller. They are constants of Modiglian and Miller. Or the traditional school of thought. So you will see those ideas or those aspects as we reach to those topics. Remember, this is going to be like the one of those last topics that we will cover, and it is very small here on level 2. So here it will just take like 30 minutes and it will be done. So we shall see those concerns, the M and M, then the traditional school of thoughts. Traditional school. These we shall elaborate them under level when we go to level 3. So at times under dividend decisions, the finance manager need to decide how much to pay. These are the key issues. He has to decide whether to pay dividend or not. Then he has also decisions to decide how much to pay in dividends, or to pay or declare. Because once declared, it's like as if it has been paid. Because once declared, it will be paid, however much the company may delay. For example, if you had made, let's say, a net profit after tax of, say, 2.5 billion, then are you going to pay all of that net profit after tax in dividends? And if yes, then you are going to have problems of cash in order for you to invest. Because if you are going to pay everything that you've earned in the profit because you just want to make your investors happy or the shareholders happy, remember you have to make some investment and you need cash. Remember, you as a finance manager, you have to keep investing. You keep investing and investing in order for the company to make more profits in the future. So if you are going to give out all the money in dividends, then you will have challenges under the financing decision, because you will have to go and borrow. You borrow money, yet the dividends were free with you. So that means as a finance manager, you have to think, and it's not that it is by law that you are supposed, or it is a must that you are supposed to pay all the money in dividends. And that's why these school of thoughts and the Modiglian and Miller, they have their arguments. We shall look at those arguments of whether we should pay or we shouldn't pay dividends. So it is not mandatory that you are supposed to pay everything that you've earned. So it is the finance manager's decision together with the management team in a company. So I hope that makes a little bit sense. So the last thing that you need to take note of, you have to decide whether you are going to pay dividend by cash, to pay cash, or you are going to issue shares. They may be issue shares. They may be bonus shares, whatever it could be. Because you may decide that instead of me paying the money that I have, let me keep the money that I invest in to make more money. But instead, I increase the shareholding of these shareholders rather than paying actual cash. So we shall look at some of those different payments, but those are going to be theoretical. But when we go to level 2, level 3, we shall do some computations. So you may issue what we call bonus shares or bonus issues. And that's the whole concern of decision, the dividend decision at this level. That's the concern. We are just looking at these 3 parameters, whether to pay or not, or how much to pay. Then are we going to pay by cash or by issuing more shares? That's all that we need to understand as far as dividend decision is concerned. So let's now look at the laws of finance. In other words, we are going to look at the laws of finance or finance function in an organization. This one, we are looking at the department, the whole department. What are the functions? Because the functions of the department are almost the same as the functions for the finance manager. But how are you going to state them? That's what is going to make a difference. But otherwise, they are the same answers. We are just going to play around with how we present them. Now, I have already given you the homework on the role of finance manager or finance function. And I can outline for you some 5 points here. But for you to do the work, don't present them in outlines or in an outline format, because you have to make explanations. You have to explain them. Maybe let me try to explain some points, and that will give you a starting point. One of the roles of a finance manager is sourcing of funds. Now, the finance manager is responsible for fundraising on behalf of the company, where he has to identify the sources that are cheaper to the company in terms of finance costs, and eventually that will help the company to make more money. So that's how a finance manager is responsible for sourcing of finance. Then the second thing is he has to make investment of funds. You don't just bring the funds and you just keep them there. You pile the cash to the company accounts. You have to make investments. You have to assess projects, evaluate projects, and make investments. You invest the money so that you make more money. The other one is working capital management and treasury management. The other one, we may look at management of surplus earnings. And this may be whether they pay dividends or they invest back the money or they buy back some shares. So there are so many issues. So what we discussed in the previous slides were the general rules for the finance department in an organization. But what we have now, we are now looking at the laws of finance manager, specifically as a person in an organization. They are the same roles, but the way you present them. Just know there is a difference between the laws of a finance department and the laws of a finance manager as a person. And if you are cramming that the examiner will bring this and just bring in answers, that's when the examiner will actually get you. Because you will give just one answer or two and you bias the examiner. And you find that the examiner is going to cross you out, crosses your work, because you don't actually know what you're responding to. The whole of these points here, these points you are seeing here, they are the very points that we gave under the finance function as a department. Because this was financing decision. This is investment decision. This is working capital management. And this is, of course, when you're dealing with the surplus, it is all about dividend. So the way you give these answers is actually either going to bias the examiner or you are going to get the attention of the examiner. Remember, the corporation or an organization we are looking at, we are looking for those big companies. Now, let's maybe try to get some picture of the organization that we are looking at. Maybe we'll try to take up the organization. Let's try to look. We are not going to study the organization structure, but let's just have a look, a small look. Organization structure. But the organization structure here, we are only bringing out the finance function. Finance as a function. Finance alone. So we are just bringing out the finance function. We want to see how is finance going to be arranged in an organization. Now, the corporation or an organization we are looking at, if you are trying to look at the organization structure, the organization structure may be different for different companies. Because, and it keeps on changing. These organizational structures, they keep on changing with the time. There are some positions that are going to be phased out. Because in the past, we used to have a person called a chief accountant. We used to have a chief accountant as number one person. We used to have that person. But for now, we have got what we call the finance manager. And this finance manager I'm talking about could be the CFO. This person could be the director of finance. Whichever case it may be, depending on the organization that we are talking about. So it could be anything. It could be the head of finance. So when we go up to top companies, if you try to maybe to look at top companies, like maybe we can look at companies like MTN, Standard Chartered, Bank, Stanbic, and others. So these positions they are actually there. When you go, maybe you go to their head office, you find those positions there. The finance manager, the CFO, or the director of finance, depending on whichever title they call that person. You may find is the chief finance officer, the CFO, or is the head of department. So you may find when they are calling is the head of finance. So therefore, you may have the head of finance, but below the head of finance, there is what we call, maybe they are those that we are calling maybe you may find when there is the treasurer, you may find the treasurer below the head of finance. You'll find people like the financial accountant, or the financial controller. Some of them, they call them financial controller. You know, some of the things they are phased out. Find them, they are calling them financial controllers. Because we don't want to talk about the financial accounting, yet we are studying financial management. So we bring in the other aspect of the financial terms. Financial accountant, they may call it financial controller. So we may have some other people. You may also find that even the finance manager himself is below. Now, you may find that above the head of department, head of finance, we have these other people. Maybe we can try to draw to make some illustration. Let's make some illustration on how some of these can be. That's how we can be able to explain it very well. So here, you may be having the CFO. We call that one the CFO, maybe the head of finance. So now, below this person, they are going to be people. We are going to have, you may find that we have the treasurer. We just use the different pen, different color. We may have the treasurer. The other person, we may say that we have like 3 people. Here we may be having what we call the finance or financial controller. And lastly, we have the finance manager. So we have the finance manager there. Now, this paper is looking at us as we, the finance manager. So you find that all these people, they are on the same line, but they are all reporting to this person up here, the head of finance. But all they are within the finance function. So for those companies, maybe you may find that maybe you are working with the Stanbic. You may find that you are working with Stanbic, but you are working up-country branches, Stanbic branches. There you may not actually see anyone, any of these guys. You may not see any. Maybe you're working with MTN, but you're working with those up-country branches. You will not actually see these people. So these positions, they will not be there. But if you trace your organization up to the headquarters, these positions, they are actually there. So if you look at Total, you look at where you trace, if you're working at let's say any petrol station, you will not actually see these guys. These positions will not be there. But if you trace Total to their head office, you'll actually be able to see these positions. They are there. So here for us, we are calling ourselves the finance manager. Now, when you go to level 3, the examiner there will be calling you the CFO or the head of department, head of finance. But you find these people they may be bringing some information to this guy, the finance manager. Then it is this person to actually report, or they may be all of them, they are just reporting. So depending on how they do it. But we are looking at ourselves as the finance manager, because the financial controller, we shall look at the laws, because we need to understand the laws of a treasurer, the laws of finance control, then the laws of finance manager. They are all having different roles. This one is forming something different. Even this one is performing something else. Even us, the finance managers, we are actually performing different things. The things that we are performing, they are the ones we are discussing here. Sourcing finance, investing the finance. So these are the same issues. So when you look at the homework I gave you, we have to get the laws of a treasurer, the laws of finance control, and the laws of finance manager as persons, even as departments. But the one for financial control, that one we shall not talk about it, because we are not studying financial accounting. You know what a financial accountant does. So the finance controller is the one they used to call the chief accountant. We shall look at these ones. So let's now focus on the laws. We've done the laws of the function. We've done now the laws of the finance. Maybe to elaborate on the laws of finance manager as a person, because they are the same rules, but how you phrase them is the one that is going to make the difference. So here I'm talking about the finance manager as a person. So I want to look at the laws of finance manager as a person. So as I said, we are not going to elaborate everything. We give everything, but I'm going to give out some key points. I explain them, then you can be able to explain other points as we may come across them in our notes, because these things is just a matter of understanding who the person is, what that person is going to be doing. So, but what you have to understand, or what you have to keep in mind, is that the roles of a finance manager as a person are technically the roles of finance as a department or as a function. So one, we may look at things to do with raising of funds. So you have to explain the answers in an exam. So we don't want you to base on what we write on the notes, that you are supposed to cram that explanation. No. As long as the bottom line is getting the concept, you are bringing out the concept, irrespective of whatever words you are using, as long as they are explaining the concept, they are okay. So we don't want to rely on what the notes are saying. And we are not supposed to write exactly what the notes are or what they gave us in the books. Because the words that you find in those books are just there to help you understand the concept, but in the exam, so long as you say maybe a finance manager is responsible, we may say a finance manager is responsible for raising funds for the company through identifying different sources of finances that are cheaper to the company, then that's already 1 point. You are responsible to identify those sources of finance that are cheaper for the organization, and they will help the organization to increase more money in the future. Period. That's very nice explanation. You don't even need to add anything there. So that's already 1 point. So it doesn't mean that you should read and cram whatever we say or whatever we write in different books and pamphlets and all these handouts that you may get. And I hope that makes sense to your end, because the examiner may just allocate like six marks, which means that you should be able to give at least 6 points, because we don't know whether they are giving each point 1 mark or 2. But you just give, if the person says you give 6, the 6 mark question, give 6 as long as you know they are right. If they are not right, give 10 or 12, so that the examiner picks the 6. So the other one, we may look at distributing. We can now highlight distributing dividends. The finance manager has to make a decision whether he's going to give out to declare dividends, and whether they are going to give out that amount in cash or they are going to be using bonus shares. Simple English, and you are good to go. You don't need to write a lot. The other one is allocation of funds. Of course, after receiving the money, we don't expect you to just have the money and you keep it there. You have to make allocations. You may find that in our budget, we had so many issues to work on in a given financial year. You keep allocating that this one is going to go to this one is going, depending on which criteria or depending on the company policy. Because you may say this is very important, this is of a higher priority, so we give it the enough money that will help it to actually finish the project very fast. So you keep allocating that resources, not just being with the money. Even the other thing is even investing, because allocation is different. Investment of funds. Allocation, you are just making an allocation to make sure that this resources is actually enough to all the different key items you wanted to handle in a given financial year. But there is also going ahead and make the investment. Because the other allocation, you may allocate money on expenses. Those are not investments. So we need to be making investments to make more money for the shareholders. So those are the different roles that we could think of. Even working capital management, we haven't talked about it. Is responsible for managing receivables, managing payables, managing cash that we have. So working capital management. So the answers, they are the same, but how you phrase them. So let's now look at the roles of a finance controller. A finance controller. We looked at the finance controller in our structure. But now, I spoke about a finance controller, and many times students don't understand who a finance controller is. And they can't differentiate a finance controller from a finance manager. Now, a finance controller is that person who used to be, the person we used to call the chief accountant. In other words, he is a financial accountant. So you may find that this is the person who is actually heading the accounting department. If the organization is so big and they have so many transactions, you may find that the company has over, let's say, 10 accountants. They may be accounts assistant, but they are all working in the accounting department. They are the ones for those entries, and depending on the size of the organization, you may find that the organization has maybe one chief accountant, that is the person who, or the head of accounting department. But there are very many accounting officers that are within that, but this is their head, the chief accountant. But these are for big organizations. And you find that also this person has his roles specific, which are totally different from those of the finance manager. And those roles, we may talk about some of them. One of them is management of assets, because it's the one who is supposed to know that they are depreciating, how they are they supposed to be disposed of, those things. So it's going to be responsible for managing assets. And you'll find that in most cases, the finance controller is reporting to the finance manager. Because also the finance manager is going to be having, or is going to need to know some of the information from the financial controller. Because if this asset has been there for long, the finance manager needs to maybe to replace it, to make a replacement for that. Then they are supposed to get the information from the chief accountant. They will be knowing what the useful life and whatever. So they are the ones that are managing it, but you may find that most of the organization, you find they are reporting to the finance manager. So is also responsible for preparation of cash flow statements. Is also responsible for preparation of payroll, because the finance manager doesn't actually do those things. The finance manager doesn't handle payroll or cash flow statements, because he's the head of that department, and he has his accountant, whom we call the finance controller in this paper. So the organization that has all these people in place, it will depend on how big the business, all the operations of that organization are. Because you can't be having few organizations and you recruit all these people just because you want to make the organization structure look fine. So it depends on the size of the entity and how its operations are. So how big the operation is for it to employ all these other people. Now, the other thing is also this chief accountant is going to be responsible for preparation of annual statutory accounts. And now these statutory accounts, these are those obligations like filing returns, preparation of financial statements. So it is the responsibility of the finance controller to make sure that returns are filed with the necessary regulators. Therefore, when the examiner asks this question, you should know there is a very big difference between the two people, the finance manager and the finance controller. But remember, we spoke of, there were three people. We had even the treasurer. But now let's look at the treasury department as a whole before we look at the person. So, the Treasury Department, for example, just like you can see that the Secretary to Finance, most of the time, the Secretary to Finance is actually the treasurer to the government of Uganda. Secretary to Finance. But what we have to also keep in mind is that we are not referring to small organizations. So we are not referring to small organizations. Here we are referring to big companies. Because you may find that those small companies, they actually have their treasurer. But me, I'm not talking about there are those treasurers of the board that are on the treasurer on the board as per your business law, because there are those treasurers that are going to be on the board. No, we are not meaning those guys. We are meaning these guys who are normal employees that come on daily basis. Just like you see these banks, big Standard Chartered banks, they have their treasury department handling issues to do with the forex and all that. There are so many things they do there. Risk and the other stuffs they keep on doing. So this treasury department is mainly in banks and other big organizations with these big operations. They have big cash. They are doing different transactions. Maybe they are shipping goods they are shipping raw materials from Japan, from where they are getting. They have very many things to do with the currency and other stuff. So they may find that but this is mainly in banks. So when you go to those big banks, they can refer you to the Treasury Department, and it is headed by the treasurer. But you need to understand these two issues. There are words here that keep challenging the students, and students get confused. For example, there is a very big difference between a treasury, the treasurer, and a treasury. This one is a person, a normal human being. It is, in other words, it's an office, a position. But this one is a department, is a function, and it is headed by this very person. So I hope we can now get the difference. So when the examiner asks you for the roles of the treasury, then you should know that they are different to those roles of the treasurer as a person, because the roles of a department, they may be a little bit limited, but the roles of a person or the roles of a treasurer as a person or as a human being, you find that because a human being is going to be given more responsibilities, you may find that actually the work is not actually there in the treasury department. Maybe they can assign you something to think, like to think of. It may be in the docket of treasury, but it's something that you're supposed to think of. So you may find that as a person, they can allocate you more activities than what it should be for the department or for the function. However, when you're answering a question to do with treasurer or a treasury, we need to be careful, because you must first understand whether you are dealing with a local company or you are dealing with a multinational company. In other words, a multinational company is an international company. Maybe it has their head offices, like we can talk of the international companies. We can talk of Stanbic, because Stanbic is under Standard Bank Group, Standard Group, I think, the one in South Africa. Then we also Standard Chartered, things to do, MTN, because it has its head office in South Africa. So there are other companies, multinational. In other words, they have different branches, different countries. Those are multinational companies. Then the local companies, these small companies of ours, within, they may not be small in size, but they are operating within one country. So as I said, when we are answering this question of the treasury or the treasurer, we need to be careful. We need to be careful when to see the company that is in the question. The examiner may not actually tell you that this is an international company or it is a local company, but they will just be giving you scenarios and you can be able to tell that that's an international company or it's a local company. So we need to understand what a local company is and what an international company is. So we looked at examples of each category. We gave examples of MTN for international companies, Coca-Cola. We have even Pepsi, is also an international company. Then for the local ones, local companies, we can have Uganda Breweries, can have New Vision, and others. Now, as I said, the gist of the matter is on whether the treasurer of a local government has the same roles as those of the treasurer of an international company. So what you need to know is that a treasurer of a local company has some roles that are limited, but the treasurer of an international company has, on top of these other roles, like the ones of the local company that we are going to give. So there are other additional roles as long as the treasurer is of an international company. So we want to look at now some of the roles of an international treasurer. One of them is managing foreign currency, foreign exchange, or foreign currency. So this is because if you are a treasurer of, let's say, MTN Group, you are a treasurer of MTN Group. So we see that MTN has many branches. It has like MTN Uganda. You find that it is spread over Africa. You have MTN Uganda, MTN Rwanda, MTN Nigeria, and others. So if you are a treasurer of that nature, then you need to manage foreign exchange fluctuations, because you'll be seeing that the currency in Uganda is different from that in Rwanda, is different from that in Nigeria, and how they are going to be changing, because remember that this MTN Group is in South Africa. And these South Africans, they are reporting in rands. So we want to see if the treasurer is within the MTN group. We shall look at whether decentralized or centralized. If the treasurer in the MTN in South Africa, that's the group, wants to manage the fluctuations of these different countries, the one of Uganda, the one of, because you may find that these countries are experiencing inflation, and it causes maybe the rates to keep on fluctuating. So we need to be managing those currency fluctuations. Secondly, if you are that international treasurer, then you need to remit money, make money remittances. Now, this money, you are going to be making remittances either to the parent company in South Africa, that's MTN Group. The money can be, maybe you are MTN Uganda and you are transferring cash to MTN South Africa, that's the head office. Because we said MTN is spread over Africa. So it will be MTN Group that wants to maybe to send money to its other branches. They are sending money to Uganda, they are sending money to Rwanda, they are sending money to Kenya, they are sending money to Nigeria. So you find that you need to make remittances. So you need to manage what we call transfer pricing. So you need to be careful with the examiner when he begins separating the two treasurers. And you can see in our notes, I covered those of the treasurer of the local company and the treasurers of the national company. So you don't need to worry. Those functions, they are there. So now we want to look at, we want to make some detailed classification of those treasury departments. I want to give their roles. We start maybe with the treasury department, then we end up with the roles of the treasurers as a human being. Because we need to be talking more about the treasury, because the most important thing is for you to understand the international treasury function. Because for it has some other additional laws or additional functions other than those of the local treasury. So our emphasis is going to basically look at the international treasury. We are just going to focus on the international treasury. So let's try to look at now the laws. The other one we gave just brief, but we want to look at the laws of an international treasury. This is the department, treasury function. This is not the person, this is now the department. So one of them we have setting. They are the same answers, but the way you phrase them. Setting transfer prices. How much are you going to be transferring the cash? Because setting transfer prices to reduce the overall tax bill. Now, normally, if you're like MTN Group, there is money that you are supposed to remit maybe back to your branches, or it is these branches that are supposed to remit money to the parent company. So the MTN Group, the head office are in South Africa. Now, if MTN Uganda wants to remit some money to the parent company in South Africa, through that process, and depending on the tax regime, such a company, in other words, if the tax regime here, because it is Uganda that wants to transfer the money, so we depend on the tax regime that is within the country of operation, that's Uganda. So the more you transfer to the parent company, the lesser taxes you pay in your country. So that's why you find the government keeps on fighting those international remittances, that companies that are transferring everything that they have worked from the same country, and they are transferring it, the money there to their headquarters, called profit repatriation. So the more they keep on transferring, the lesser taxes they are going to be paying here. So depending on the tax regime that is there. So that's why you find the government keeps on restricting it, whereby the government tries to limit, it tries to set limits on how much a company can transfer back to its parent company. Otherwise, a company can transfer everything the other side to the parent company, and it doesn't pay tax in where it is operating. Therefore, that's why we are saying here that the international treasury is responsible for setting transfer prices to reduce the overall tax bill. So the second point is deciding on the currency exposure policies and procedures. So sometimes back we used to have a dollar, we used to hear a dollar keeps on changing, like the shilling it keeps on changing. You find that maybe the inflation is too high. So you find that the international treasurer, you need to decide on how you can manage those foreign currency fluctuations. Because if you don't lock some of those currencies, because you may find that the Ugandan shilling keeps on changing, the Kenyan shilling is keeping on changing. So the issue here is that if the international treasurer doesn't lock some of those currencies to avoid losses, because when these currencies are changing, you find that the company is making some losses. They may increase or decrease. But that's why you find that they are trying to lock those fluctuations. So you find that the currency exchange rates, they are locked. Maybe they say for us we are only transacting in dollars. It means they have removed the risk of fluctuation in terms of losing the money through foreign exchange losses. Because if you don't do that, then you will lose money in transferring or buying materials from other countries. Because there is no way you are going to risk it. Someone may say, well, for us, we want to buy raw material, or we are buying our raw materials from China. But you find the currency is not stable. So what they do, they may fix, and they say for us, we are only going to be transacting in dollars. That's one way of locking your currency so that you don't make losses. Because some of them, they get, because you find that other companies, they get raw materials, others they get components. They get them from different countries. So they keep on exchanging. And that's why the treasurer must be able to manage the currency exposures, and therefore to be able to reduce the risk or the foreign exchange losses. So you learn some of these things under risk management in your financial reporting and even a advanced financial reporting. But the point here is to actually just understand, you squeeze your brain a little bit so that you can be able to pick a point out of it. The other role of an international treasury is that it's a tool for transferring, it is a tool for transferring cash across international borders. Remember, we are talking about the department, not an individual. So, for example, as we said, MTN Uganda, you may find that, let's give an example. You may find that MTN Uganda has no cash. And maybe MTN Kenya has some cash, which is extra. In other words, they have more than what they can use. So what they can do, they can send the money or they can send the cash to MTN Uganda and they bail them out to solve whichever problem that may happen. And that can be a mode of transferring cash. But that is going to be done by the international treasurer. So there are other points that we may not talk about here. But one that I need to highlight is the netting and matching. Netting and matching of currency obligations. Now, here on level 2, the point ends at understanding these two concepts theoretically. We don't need to do any computation because that's what the exam syllabus is guiding us for this paper. So, what do we mean by netting and matching currency obligations? The quickest way that we can be able to understand this is by maybe we use some example. We do some illustration. That's when we can be able to understand this. Now, we can say we've been using, let's use MTN because the one we've been using. We have MTN Group that is based in South Africa. And these guys, they have branches in Uganda, Rwanda, Nigeria, etc. There are other branches. Now, suppose MTN Nigeria supplied some parts to MTN Uganda. Maybe they supplied these components, or they may be raw materials, they may be maybe equipments, anything. It can be even money. Now, so if MTN Nigeria supplied MTN Uganda with some parts, let's say raw materials, There may be equipments. Now, it means MTN Nigeria is going to be expecting some money from MTN Uganda. They are expecting cash. This one is supposed to be paying, MTN Uganda is supposed to be paying MTN Nigeria for the supply of the raw materials they gave to them. Now, at the same time, you find that MTN Nigeria was supposed to remit cash to its head office. They had maybe, let's say they had a loan. Let's just use a loan. They had a loan to, they're supposed to pay money. They pick some money from their head office. Maybe for operation, maybe working capital, something like that. Any amount. It may be that MTN, let's not use a loan. Let's just say they were supposed to submit in money. Just they were supposed to be a remittance. Because even if it is a loan, they would be paying back. But let's use a remittance. MTN Nigeria, since it is a branch, it's supposed to submit money to MTN Group. It may be end of year amount, depending on how much they set for them. That is supposed to be remitted to the head office. So what happens is that, so what will happen is that the treasurer, who is probably seated at the headquarters here in South Africa, what that person is going to be doing, what the treasurer is going to say, is going to tell MTN Uganda that rather than you submitting money to MTN Nigeria and then MTN Nigeria submits the money to us, it's going to cause some foreign exchange loss, because money is moving from Uganda to Nigeria and then from Nigeria to South Africa. So there are so many currencies that are going to be involved. So what they will do, they will tell MTN Uganda that rather than sending money to Nigeria, then they would just tell MTN Uganda to just remit the money to MTN South Africa. Because if Nigeria submitted raw materials of, let's say, $50, and this MTN, Nigeria is supposed to remit, let's say, $20,000, and this one, Uganda is supposed to pay Nigeria $50,000. So what will happen? The treasurer, who is at the headquarters in South Africa, will just tell MTN Uganda that you pay what we owe, what is supposed to be remitted by Nigeria, the 20,000 US dollars. MTN Uganda will pay the 20,000 to MTN Group. And it means it will only be that MTN Uganda will remit to Nigeria only 30,000 US dollars. And this money will not be sent to the group. It will be retained by MTN Nigeria. Because if they had sent 50, MTN Nigeria would remove the 20,000 US dollars and sends it to South Africa, of which it will cause a loss. Because in between these two transactions, there must be a loss in value in terms of currency losses, foreign exchange losses. So that's what happens. It's you net off the obligation of the other, and this one submits less. So those are the issues to do with netting and matching currency obligations. But when you move to advanced financial management, we shall do some computations. We'll go in details and we see how we can do those ideas practically. So that's how the examiner examines the matching and netting of currency obligations, the other side of advanced financial management. So now that we have highlighted the roles of an international treasury, let's now look at the roles of a local treasury, because these are going to be uniform to all. So let's put this in context. So these are the general roles for all the treasurer, but the other one, they are in excess. So these are the roles of a local treasurer. They are also the same. So when the examiner asks for the roles and doesn't specify, you can give these ones and you add on the other ones. So one, we have hedging of foreign exchange risk. Also hedging, we shall study it in advanced financial management. But here we just need to know how it is. So if you are dealing with foreign currency, the Treasury Department should have to come up with a mechanism of dealing with financial, with forex losses, in other words, foreign exchange losses. This is just a mechanism of how to sort losses. And those mechanisms, they are the ones that we call hedging. So we shall see these practically because we have some computations on advanced financial management. The other one that the local treasurer does, short-term cash management. Because these guys are going to be doing the lending and borrowing as it will be required. Because we are not supposed, the Treasury Department is not supposed to keep cash. Cash is supposed to be lent out to make more money. The other issue is interest risk management. Of course, this is most of the things that they do. They handle risks, and that's what they do most of the times. The other one is also raising long-term finance. Of course, these ones, they work hand in hand with the finance manager. They are the ones advising the finance manager on which sources to go for. So those are the roles that we can talk about. But under Treasury Department, there is a scenario that we need to take note of. The examiner brings it and it can give it like 5 marks, and it's all about the Treasury Department. How can we learn a Treasury Department as either a profit or a cost center? So under the Treasury Department, there is a concern whether the Treasury Department should be run as a cost center or a profit center. So we need to understand that any department that is run as a cost center is always a problem to an organization. In other words, for you, if you only expense and you don't make money, like maybe the customer service receptionist, you find that the reception doesn't actually make money, but they are only incurring costs because they are paying the people who are actually attending to the people, but they don't make profit. So receptionists in every organizations, they don't make money for the company. So such a department is only incurring costs to the organization. So we have only costs. And that's what it means by running any department as a cost center. Whereas a profit center, it means you are incurring costs, but at the same time you are making money. Thus, if you try to maybe to take away or to get the difference, you'll be trying to see how that department is performing, whether it is making a loss or it is making a profit. So the examiner will try to find out from you how can the Treasury Department make money, or how can it be run as a profit center. So that's what the examiner will be interested in. How can a Treasury Department be run as a profit center? In other words, how can the Treasury Department make money? So the examiner will be trying to find out whether you know or you can tell how can a Treasury Department be run as a profit center, or how can a Treasury Department make money. And one of the points that we can look up, or that we can think of, is we are saying that the Treasury Department should charge each division or department the market value of the services provided by the Treasury Department. For example, if let's say you are Stanbic Bank and you are in the Treasury Department or division, then you may find that there is a department, maybe the sales department or the production department, whichever department that wants maybe to transfer money, or they want to do something, and it involves exchange of money. So what we are saying is that the Treasury Department must do that on behalf of that other department at a normal cost. And they shouldn't say that since we are brothers in the same bank or in the same company, then we should do it for free of charge. So if the Treasury Department is to make money, these other components or departments must be serviced at a cost, more so at the market value. So that's one way they can be able to make money. The other way is through hedging. And we said hedging, they are responsible for managing any foreign exchange exposure. So the process of controlling the changes or the currency fluctuations, because it is within the Treasury Department where they prepare for eventualities. And by doing this, they should be able to reach at a point where they can make money, especially after handling the exchange losses. Because when they are doing hedging, we are finding mechanism of sorting foreign exchange losses. So in that process of hedging, you must be able to find ways how you can be negotiating to see that you can be able to make money in every situation. Maybe you are transacting with other customers, you should be negotiating, maybe it is a dollar rate and you're trying to negotiate with a customer. It will be a win-win situation whereby you are also being able to make some money. So those are some of the ways how a treasury department can actually make money. We are now going to conclude with the centralization and decentralization of the treasury department. It's a departmental function. Now, the other question under this treasury department or treasury function, we have these two concepts, and these are examinable areas. So the examiner may ask you, in other words, the treasury department can be decentralized, meaning that every branch there is a treasury department, or it can be centralized, whereby it is only the head office or the headquarters that has the treasury department. So now, one advantage of decentralizing the treasury function is if you put a treasury department at every branch, then it means that every branch will have a treasurer or a person responsible for treasury. And that will increase costs because we are paying so many people. The role has been duplicated. Just like the way you are seeing maybe for MTN Group. MTN Group is spread over Africa. They can decide that let's decentralize our treasury department or our treasury component, whereby every country or every branch has its own treasurer. And they can also decide that they should centralize the treasury function, whereby they only recruit one or two treasurers and they are sitting at the headquarters in South Africa. And they are the ones that manage everything because they can manage. Since the technology is there, it is a technology-based environment, things can be handled. Therefore, what will the examiner do? The examiner is going to ask for the advantages and the disadvantages of either decentralization or centralization of the treasury department. In other words, if the treasury department is decentralized, then what will be the advantages of such? So you have a group of company that has very many branches. So if you are to do decentralization, it means every branch is going to be having its own treasury department with a treasurer, or a person responsible for that department. That's what we mean by decentralization. Now, we need to look at the advantages of, let's say, decentralization. you can look at the advantages of centralizing the Treasury Department. One, we are saying that there is no need of having Treasury skills duplicated. No need to have Treasury skills duplicated. Meaning, we shall not need very many Treasury officers or the treasurers. So, we shall not have any duplication of the Treasury Department or the Treasury skills throughout the group of companies. This is because the company can only recruit 2 or 3 people and they can run the Treasury Department, and they are centered at the head office or the headquarters. If it is MTN, they are in South Africa. 2, foreign exchange risks. Foreign exchange risk management is likely to be improved in the group of companies. In other words, it's centralized, and therefore they will be able to negotiate the treasury components, because the being centralized, they will be able to know and track all the information in regards to the currency exposures. But if it is decentralized, then every country will be on its own. The other idea is that, or the other point is that the bank charges could be lower, could be low. In other words, there will be no need for keeping very many accounts for events, because everything is centralized at the top. The last one we can look at is even borrowing. Any borrowing can be arranged in bulk. Because here, since we have only one treasury department, it means you can be able to borrow more cash, because they are going to be looking at the transactions, all the cash flows that are combined together. If let's say it is MTN Group, they have combined all its branches in different countries, and they are combining all the cash flows at one point. So when you are looking at the cash flows, if at all you want to borrow them or to lend them money, you will find that the company can be lent so much, and when they get that money, they can actually come and distribute to those different branches that may need cash. However, the examiner may ask you for the advantages of decentralization. Let's also look at the advantages. Advantages of decentralization. Now, for decentralization, I'm going to explain very few points here. Then you'll be able to add, to explain. I'm just going to highlight them. One, there is greater autonomy. In other words, you find that every branch can actually do things on its own. There are things they can do, and they don't need to make very many consultations on certain issues. So there is greater autonomy. to every branch or division, the different divisions. 2, in case of urgency or in case of an emergency, there is an emergency need for cash, because you can just get the cash when you need than going through the formal procedures of picking cash from or waiting for the headquarters to actually remit the cash. Then the other one, sources of finance, can be diversified and can match local assets. Because now when you have the cash, you can actually know what is trending in the company and you can be able to buy depending on the local needs or the local demands that are there. Then there is also quick decision making. So that's where we are going to stop for today. That's the end of our lecture number 1. So we shall look at lecture number 2 some other time. So thank you for watching. Endeavor to subscribe, hit the notification bell icon so that you can be notified whenever we upload new videos. Thank you for watching. Bye. Hello viewers, welcome back to our channel. We are now looking at financial management, and this is lecture number 2. In our last video lecture, we should have covered all about the introduction, the finance function, and environment, or what we call the business environment. But we were left with various topics, like we are left with the various forms of business organizations. We didn't talk about the business environment. We didn't talk about the goals of the firm. So those are some areas that we didn't talk about, which are also examinable. So these are also examinable areas. We should have completed them, but the issue wasn't to complete the whole introductory part, but we were supposed to analyze and understand certain things. So these areas, of course, we also have the agency theory and other things that we didn't talk about. So those areas, those are the ones I want to start with for today. So these 3 areas, they are the ones that I want to start with. So when we are done with those areas, finally we can conclude with the agency theory. We can also look at the profit maximization versus the the wealth maximization. That's also within the goal of the firm, if at all we happen to get to that point. However, if we don't cover all of these areas, if we don't cover these sections, all these sections, it's also okay. Because the issue here is to actually understand. So if we don't conclude them, we shall look at them in the next lecture. Because the point here is to understand the theory. Because this theory, we need to understand it very well before we start the calculations. Remember the calculations, we start the calculations from the essential concepts. That's where we start the computations. Some small initial computations, essential concepts of finance. But before that, we have to look at the agency theory, we look at the ethics, because those are the things that we need to look at and we understand, and we make sure that we read at least every day. We give it like 15 minutes for this theory, because by the time we proceed to other areas, it will be very hard for you to come back to these small areas that we started with. So it is very important. Therefore, it is very important for you to understand the initial computations. And we say the initial computations are going to be in the essential concepts of finance. That's where we are going to be having the initial calculations of financial management. However, as I said, you should be able to download the course materials, the training guideline, can call it the training guide or the plan, and make sure you also pay attention to the past papers. They are also very key, because they are past papers in our Telegram channel, but we say they are those that we link on our training guide. We make sure that we link or we reference each lecture or each lesson, and you'll be able to look for those past paper numbers that we keep on referencing on each topics that we go through. So we want to see how they are examined, and that's why I guided you that you should be able to download the question bank, or you download either the soft copy or you buy, because you can download these papers as long as you can download them from the institute website. You log in, then you start downloading the papers. And of course, as you download them, the question papers, you also download the marking guides. Although some marking guides you may find when they have some errors, but those we shall be able to highlight them as we keep on proceeding. So you can get those from the Institute of Certified Public Accountant of Uganda website, or you can download them from our Telegram channel with the link that is provided in the About section of this YouTube channel. And by now, you should have downloaded them. So I believe that everyone should keep in touch with past papers, and that's the only way we can understand that we have got the concepts from the different topics that we've discussed. However, by the end of today, you'll be able to answer the homework that I gave you, because we started with a homework and we had two questions. We had the two questions. It's the one that we started with, because homework number 2 is involving some technical aspects that we need to understand. So what I only request you is you listen to my arguments today, but as I said in the first lecture, that you need to have the tools ready. You need to be having your calculator and also know how to use it, because it's not important for you to have the calculator but you can't even use it. But we shall give some guidance, especially when we are doing some computations. So, because in the next lecture, we may actually start looking at our initial calculations, and you need to have the tools ready since we have already started. So, the other key thing that I need to emphasize here is that you at least give yourself, if you just give yourself 15 to 20 minutes every day to go through the theory that we've covered, and make sure that you limit yourself to what we've covered only. Even if for a day you just read something to do with the roles of a finance manager and you know how to explain them, it's okay. Because by the time we start off the calculations, it will be hard for you to start reading the theories, because things are going to be a little bit many for you. By the time we go to the computations, you'll find yourself focusing on calculations and you forget the theory. But if you give yourself time to at least 20 minutes, maybe 20 minutes in the morning, 20 minutes in the evening before you go to sleep, you read something for only just give yourself 20 minutes. We shall keep on adjusting the time as we proceed with our tutorials. So basically that's what I wanted to talk about. Let's now try to focus on the forms. This is where we ended last time. Let's look at the forms of business organization. Business organization. Now, you covered this under business law on level 1. There is a paper for business law. You must have covered the forms of business organizations. But we also cover the same thing here. And this is another area where we can get some good marks if at all it has been examined. This is where we can get some good marks. So you can start a business, you can be a sole proprietor, or you can be a partnership, or you can be a company. And the company, for financial management, we call them corporations. So those are the ones I'm calling corporations. Therefore, your examiner expects you to understand these items, Because tomorrow you are going to start your own company. You are going to start your own business. And you can't survive unless it's registered. And I hope that makes sense. However, in this case, we are not talking about cooperatives. Here we are not talking about cooperatives. Because the cooperatives, they are going to be registered under different law. We have a different law for cooperatives. But if you are going to start your own business, then you will not be able to start it as a cooperative. Because a cooperative means, co means together. Then you are operating. There are very many people that you are coming with. But if you are starting your own business as a single person, then it's supposed to be registered in these three categories. Therefore, the examiner expects you to know these three businesses as we've explained them. So, having seen those, then we are going to look at each of these categories. We look at the sole proprietor, we look at the partnership, we look at the corporations or companies. We are going to look at each of them in detail. So let's start off with the sole proprietor. Sole proprietor, or what we call the sole trader. So we need to understand who is a sole proprietor. The examiner can ask you the features of a sole proprietorship. And you find that he has given it maybe, let's say, 4 marks. But we are saying that a sole proprietor is an individual carrying on business with the view of making profits. So that's who a sole proprietor is. So you start your own business, like let's say a retail shop, with an aim of making profits. Whether you sell products online or you do physical shop visit by customers. But the goal is actually to make profits and nothing else. So, however, the examiner will not ask you to define who a sole proprietor is. Meaning, he will not ask you for the definition of a sole proprietorship, but he can ask you for the features, as we said. So, let's try to look at some features. Features of a sole proprietorship. Now, here you should never forget that it's a one person owned business. It's a one-time owned business. So the business is owned by one person, and that's all in terms of the ownership. So there is nothing that you are going to explain from this point, because if the business is owned by one person, that's okay. The other explanation you may say it is either going to be a female or a male, that's it. But it is one person only business. Number two, the owner and the business, the owner and the business are legally fused, whereby you can't separate the owner from the business. In other words, the business and the owner, they are legally seen as one person. They are inseparable. In other words, the business and the owner, they are one person. When the owner is there, then the business is also there. When it's not there, then the business is also not there. That's what we call they are legally fused. Number three, the life of the business. Its life depends on the life of the owner. So it has a life as long as the owner lives. And the owner may actually live, but he doesn't decide to actually run the business. So the life depends on the life of the owner and the decision to run the business. In other words, his decision to run the business, because he can be there, but the business is not there. So the life of the business depends on the life of the owner and his decision to run the business. If he decides to run the business, then the business will actually be there. Next is that it's more preferred. It's a more preferred form of business. It's more preferred because it is easy to form and run. Because there are going to be less procedures that you are going to follow when you are forming a sole proprietorship. And even running the business as a sole proprietor is very easy, because there are certain things that you are not going to look at. There are some taxes that you are not going to pay. Because if it is income tax, you can't pay income tax if you are a sole proprietor. There are some provisions that you are going to be paying in terms of tax. So you are excluded from some taxes. So that's why it is a more preferred form of business. So that's all that we can talk about here for the features. But we need to see if there are advantages of operating a sole proprietorship business. because the examiner will ask you on the same thing. So let's try to look at the advantages of sole proprietorship. One, it's easy to form. That's an advantage, and dissolve. So if you want to start, let's say you want to start a washing bay as a sole proprietor, you can start it straight away because there are very limited formalities or procedures that you are going to follow. And at the same time, maybe after 3 months, you can say, I'm not making any money. Then you can decide to dissolve it and close it out. So it is easy to form and dissolve, because even dissolving doesn't include so many procedures like the company has. Now, the second thing, in most cases, there are low startup costs. Low startup costs. You don't need to have a lot of money for you to start a sole proprietorship business. You can start it with whatever you have, because you don't need to hire experts. Like for the company, you have to go through the registration procedures, and you may actually hire consultants or lawyers to form the business. But here you don't need to hire experts. And even those operational overheads, they are not actually there. So you can start it when you can. The other advantage is that you own all the profits. The sole proprietor enjoys all the profits alone. So that's self-explanatory. So the other one, it requires sole proprietorship are subject to less or fewer regulations. I'm not saying there are no regulations. They are there, but they are few as compared to companies. So those may be the advantages, but we need also to look at the other side, whether there are disadvantages. And of course, there are disadvantages. They are obvious. They are there. So we need to see the disadvantages. Of sole businesses or sole proprietorship. One, there is a limited lifespan. So as long as the owner lives and decides to run the business, then the business will be there. And if the owner dies, then the business will also die. So it is limited. There is a limited lifespan. The other one is low levels of working capital or capital. Since it is a sole trader or it is a sole proprietorship business, it will be the sole proprietor who puts in the capital. And if he has less money or less capital, then he's going to have a lesser business, because it will always depend on what the person who is starting the business has. The other one we can look at is that the owner or the sole proprietor suffers the loss by themselves. It's the same way they suffer the losses. So that's what we call, or that's what we wanted to look at as far as sole proprietorship is concerned. So let's now try to look at partnerships. Now, for partnerships, this is always a situation where two professionals, two or more professionals, or two professionals or many more entrepreneurs come together and they start a business. Remember, a business is anything that you do with an aim of making profits. So the examiner expects you to know what are partnerships. And when you're explaining that, you need maybe to give some examples. Some examples that we may look at Ernst and Young. Ernst and Young. These are audit firms, and these are partners, Ernst and Young. So the other we may look at is KPMG. These are also audit firms, and these are also individuals who came together and they started these auditing firms. However, those people, they may not actually be available as of now, because these companies, they started long ago. They must have maybe died, but the other behind aspect is that there must be documents that they left behind on how they can run these audit firms and how they can keep on opening branches in different countries, and the general way of how these entities are going to be run. So these partnerships, they started long ago. The KPMG, Ernst and Young, but you are seeing they have dominated the industry. So the examiner expects you to know what a partnership is. He expects to be knowing the advantages and the disadvantages, or the demerits of partnership as a business. He also expects you to know the features of partnership business. So we can start by looking at the features. Features of partnership business. Now, one is that owners are not distinct, from their business. So in other words, a contract entered by one party on behalf of the other binds all the partners. So this area is very important because the examiner can throw a 5-mark question here on the features. Because most of the times you find that these are going to actually come together and they start working. Maybe they are professionals, everyone is specialized in different aspects, but a contract that has been entered by one person on behalf of the partner or on the partners, it is going to bind all of them. So that's why they are not different from the business. Normally, they are governed by a written document that we call the partnership deed. It's an agreement, a written agreement. And there are many other features that you can read on your own. So some of these features, we just highlight them. So you may also find that they are supposed to, because this agreement is going to be showing how they are going to be sharing the profits they have made. They are going to find if they have misunderstandings, how can they resolve them? So those are all going to be within the partnership deed. And the partnership deed is very important because gathering people of different, maybe they have different professionals and they are going to be starting to work together. You need to have, you have to be careful on when you are making these agreements, because they are the ones that are going to be resolving certain conflicts if at all they arise in the future. So there are other aspects that you may look at in terms of the features, but now let's look at the advantages. Of partnership. Number one, we have what we call synergy. If you say that the two companies or the two entrepreneurs or the two people have become one, then it means everyone is going to pool resources and that's going to increase the performance of the company. And that's what we call synergy. Because you can pool resources and these resources, they may be including, they may be in terms of skills, it may be in terms of capital, it may be in terms of any other technical knowledge that you may be having. So you pool skills and if that happens, then we are going to have what we call a partnership business. So a synergy is that extra advantage you've gotten as operating as an individual. So if you become to many people, it means even resource allocations are going to actually be very easy. Even allocating for jobs, you do something called specialization of labor. Everyone is going to be doing exactly what they know best. So that's going to improve on the overall performance of the organization. And that's what we call synergy. So it is as a result of synergy. So number two, the partnership can be cost effective, as each partner is going to specialize in certain area where maybe one could be an expert, because you may find that they are going to be maybe, let's say, three people. One is an expert, let's say, in strategy and consultancy. One is an expert in, let's say, auditing and accounting, and maybe the other is a specialist maybe in IT. So you find that when you come together, you are going to form a very strong company, but everyone is going to be specializing in that area of their expertise. So you find that you are going to come together and form a business, and you do work related to those disciplines, whereby if you get any job or any contract that is within the IT, it will be the IT expert to handle that docket. If it is in accounting and finance or auditing, you have a specialist there. So it becomes very easy and cost effective. In other words, you don't need to hire more extra people to do the same work. You guys, you are experts in different fields, so you get very many contracts that are coming from different disciplines because you came together with people that are from different disciplines. So that's what we say, it is cost effective. Number three, partnerships are easy to form. So it is easy to form. However, the considerable effort should be put into delivering or developing a partnership agreement at the point of formation. In other words, when forming a partnership deed, you need to have clear thoughts on who is going to be doing what, such that tomorrow, if you disagree, then things are easily sorted. And I hope that makes sense. The other one is losses and liabilities are shared. They are shared among the partners, and that's going to reduce the burden that is placed on an individual. Because if you have started a business alone, the risks and all the losses, liabilities, they are going to be bared by that one person who has actually started the business. But if you come together as very many people, you share the loss. And by sharing those losses and liabilities, it is going to reduce a burden from each individual. Now, we have another point here. Normally, partnerships don't pay. Partnerships don't pay tax. They don't pay income tax. In other words, if you have done some taxation, or if you have some taxation ideas, it is true that the partnerships, they don't pay taxes, but it is only the individual partners who file their individual returns, and they are the ones that are going to pay taxes. They are going to pay taxes on the money that they have earned from the partnership. So what the partnership will do, the partnership is only going to prepare the statements, and they reach at the point where they share the profits. So when they are sharing the profits, they distribute to each partner their portion, depending on how they share their profits and losses. And that's going to be taxed separately to the individuals. In other words, we are going to be using the individual tax rates to tax the individuals, but not the partnership itself. So those are some of the advantages. Let's now look at the disadvantages. The disadvantages of a partnership. Disadvantages of a partnership business. One, we have unlimited liability. Because here, the general partners are individuals that are going to be responsible for the obligations of the business. So the partners, they are individually responsible for the obligations of the business, thus creating partner risks. In other words, the individuals themselves, there is a risk for the obligations of the organizations. For example, if the partnership is unlimited, and maybe your partnership is, say, it has 10 million in assets, and that's your total assets or equity. It is 10 million. Now, if you go to the bank and borrow 30 million, because they can give you the 30 million even though the assets are going to be 10 million. And if it happens and this partnership is liquidated, and you find when your assets, you've sold all the assets and you only raised this kind of money, the 10 million, that's the amount you have raised from the sale of the company assets. But the loan was supposed to be for 30 million, or was 30 million. And that means you are going to personally raise the balance of the loan. So if the assets are 10 million, it means you have to look for the 20 million. It's these partners that are going to look for, they are going to raise that money personally. And that's what we mean by unlimited liability. So that's what we are meaning. Number two, partners may have difficulties in deciding on how they value each other's time. So there are those that are going to put in more time, maybe more time and skills. They have done a lot of work. Maybe they have been available at the organization 24/7. They have been on the organization from Monday to whichever time they do their activities. So the whole week they have been available, but you find that they can't actually be rewarded as it should have been. Whereby you'll find that some partners will be, as I've said, will be working hard. They will put in all their efforts, and they may not be appropriately rewarded as per their inputs, and that's going to be frustrating to the partners, to that partner who has put in their best. So that's what we are meaning from that perspective, because it is going to be very hard. You find that they are going to be disagreeing on certain issues. Other partners are going to be working very hard, and others, they may not actually have a lot to do because they are going to be specialized in different disciplines. You may find that today we've received work or proposals or contracts from maybe one docket of expertise, and you find that that partner, maybe for the month, is the one who has been performing. The other dockets, maybe you've not been receiving contracts, maybe for IT, and you've received maybe for auditing and accounting. So you find that the person who is specializing in auditing is going to be having a lot of work to do, but these other partners, they are not. So it will be hard for them to be compensated as per their input. So that's what we wanted to look at as far as the partnerships are concerned. So now let's focus on corporations. Corporations or companies. Now, a company, they are regulated by Companies Act. Company or corporations. These are regulated by the Companies Act. Companies Act of 2012. And a company can be, as per the act, it can be a public limited company, or it can be a private limited company. And you need to watch out for these two aspects, because there is when the examiner is going to try to ask for the differences between these two aspects. Now, if you are forming a company, we should know that the people forming a company are the ones that we call shareholders. These are the owners, and these are the people who are forming the company. Even if there are only 2 people or 3, so as long as the company is registered with the registrar of companies. However, in law, a corporation is treated as a separate entity. A corporation is treated as a separate entity. It is separate from the shareholders. Even though these shareholders, they are the ones who have started the business, they are separate. These are like, this is an artificial person, this is a human being. So it means, since it is a separate entity from the owner, then it means it can be sued. It can be sued, or it can sue in its capacities. A corporation can sue, or it can be sued in its individual capacities. Now, the examiner is going to be looking at some features of companies, of a company. Is going to look out for the difference between the public and the private company. They are going to look out for advantages and disadvantages of corporations. But what is very important here is we should understand the differences first. The differences between a public and a private limited company. That is very important because that's where you need to be very careful, because those are going to be a little bit technical as per the Companies Act. Now, let's focus on because I know the features, those ones you can actually get them. But let's focus on the differences. The first difference, we are going to categorize these as according to certain criteria. So on membership, we are going to look at a difference, but basing on the membership. Now, membership wise, a private company must have a minimum of 2 shareholders and a maximum of 50 shareholders. Whereas a public company, these are the companies that are listed on stock exchange, should have a minimum of 7 shareholders, but we don't have maximum. The maximum is infinity. We don't have maximum shareholders. We can have as long as we can. There is no maximum. And this is a popular area in the exam, and it can go up to 10 or 8 marks. The other aspect that we are going to look at, the second one, is the right to transfer shares. Right to transfer shares. The public companies have free transferable shares. They can transfer their shares without any consultation. So its shares are freely transferable. Whereas for private companies, a private company are not freely transferable shares. A person wishing to do so or to transfer the shares must get permission from the shareholders, the other shareholders. So you need to be careful, because the examiner can bring, as I said, can bring up to 8 marks. So you can read those on your own, because they are very easy for you to understand them, but they are technical as per the Companies Act. But now, what I want to look at, I want to focus on a company limited by shares. In other words, I just want to focus on the limited and the unlimited companies. That's what we want to focus on: limited and unlimited companies. Now, limited companies can be limited by shares or limited by guarantee. But a company limited by share, a company limited by shares is the one in which the liability of its members is limited to the amount paid and unpaid, if any, to the shares respectively. In other words, the point here is that if you agree to form a company and you are supposed to raise, maybe, let's say you are supposed to raise 200 million. And these are the shares that you are supposed to raise. In other words, the share value, 200 million. But when the company was starting, you were able to raise, let's say you raised 100 million at start. You raised 100 million shillings in shares, meaning there was a balance of 100 that was not paid. So when you raise the 100 million, the company, of course, will be registered. And then the balance, you keep on adding as you get the money. You can come and say, maybe during the period, you add there 50. So it means you are left with 50 million. But the balance, the total you have paid is 150 million so far. Now, what happens? These shareholders, they have brought in 150 million. And the business has been registered. At first, they brought in 100, but they added in 50 million. That makes 150. But now, when this same company gets some challenges, maybe they have challenges with creditors, and the creditors maybe come to sell off or to dissolve the company, to liquidate the company, and they sell off the company's assets, and the money, maybe the money they've gotten from the assets is not enough. Let's assume the creditors are demanding 300 million. But when they sell the company's assets, maybe they have been able to raise 250 million. Meaning there is a balance of 50 million that is not paid. Now, so since these assets, they got less cash, 250 million, but they wanted the 300. What happens? The shareholders, they must come and bring in more money to clear the debt. But the argument here is that the amount they are supposed to bring is this extra that they didn't bring, the extra 50 million. Because they were supposed to raise 200 million, but they only contributed 150, meaning they were left with 50 million extra. So the issue here is that they are only supposed to bring the 50 million. They are limited to their share, whether paid or unpaid. They paid this, but this is unpaid. So they are supposed to pay this extra 50. And that extra 50 million will be added back to make 200 million that would have been deposited. Meaning they are only limited to the shares. Even if these assets, they had sold them 200 million. Even if they had sold these assets for 200 million, but they want 300 million, it means these shareholders, they will only pull out 50 million and they will give to these guys. They get 250 million. So the 250 million will be enough, even though these guys are demanding 300 million. Because the shareholders are going to only be limited to their number of shares. In other words, their contribution is what is lost, but they don't touch their personal assets, meaning they are limited by shares. Whereas a company, unlimited company, it means if you have sold off and you've gotten, maybe they are demanding 300 million, but you've gotten the assets for 200, maybe 200 million, and your shareholding was supposed to be 200 million, but you contributed 150 million. It means you will bring back all the money. These guys, when you bring the 50, it will top up to make the shareholding of 200 million. But if it is not enough to offset the creditors' loan, the creditors, then you are supposed to bring more money because you are unlimited. In other words, you suffer their liabilities. These liabilities will go up to your personal properties to offset the liabilities of an organization. So these things are actually technical areas, and we are not supposed to put in our own things, but rather we go with what the Companies Act is saying. Company Act of 2012. So therefore, we can now try to look at the advantages and disadvantages. But those ones, I'm sure you can just explain them. I'm just going to outline them, and you'll be able to explain some of those things. So the advantages of companies. One, they have unlimited commercial life. Even if the owner dies, they still operate. It's legally treated as a separate entity, as a separate entity from its owners. In other words, whatever happens to the organization, the owners are only going to lose their shareholding, and that's enough. The other one is a limited liability. The limited liability, of course, they are not going to go to their personal assets to offset the business outstanding obligations. So let's now look at the disadvantages. Of companies. One, they have complex and expensive procedures. For winding up and information, because there are some paperwork you're supposed to have. The other thing is that they have a higher organizational and operational costs. They have to pay income tax, they have to pay workers, and they are mandatory. The last one, we can talk about the regulatory restrictions. They have some restrictions in themselves. There are certain things they are supposed to do, and there are other things they are not supposed to do. Companies, there is a format they follow for preparation of their accounts. It's not that they need it, but it is just by following the regulations. So there are certain things that the company can actually do, and there are those that they can't do as per the regulations that are available. Now from here, I want you to allow me to, so that I bring in something that is related to what we are doing, and it's all about the external environment. And after this, we can see the agency theory before we look at the goals of the firm. And I have skipped some of this because it's wide and you need to understand it very well, because it is connected to the key things. Because I've skipped the goal of the firm because it is connected to key issues as per our financial management paper. So now we want to focus on what we call the external environment, external business environment. Here we are not going to talk about plants, but we are talking about the business environment. Now, the external environment last came as a full number carrying about 8 to 10 marks in 2017. But that doesn't mean it can't come back. Therefore, we need to talk about business environment, because it's an area, if it comes in the exam, you can actually get good marks if you understand it well. But before that, I need to first give it a background. Now, because when you form your company, the company is surrounded by 2 layers. The first layer which is the one we call the micro layer, and then a second layer. The second layer is what we call the meso layer, and the first one is the one we call the micro. There is what we call the meso layer, and this meso layer, according to economists, they name these layers as micro layer and then the meso layer. So normally, when we are talking about the micro layer, we are looking at the environment that is surrounding the company internally. In most cases, this layer is internal. And when we talk about the meso layer, we are looking at the environment surrounding the business externally, meaning the external from outside the business premises. In other words, the micro layer is basically where the business is plus its internal stuff. Where the business is located and its internal stuff. That's what we call the meso layer, the micro layer. However, immediately outside the business premises, there is a layer that we call the meso layer, meaning the external people. But the examiner will not ask you like that. So the question is, in the meso layer, who are there? And that's the topic for today. We are basically focusing on the external environment. And we are going to be looking at the environment outside the organization. So in the meso layer, we have people like, here, we have people like customers. We have people like customers. We have people like suppliers. We have people like the government. We also have people like competitors. All those are in the external environment. We have the customers, because in the business, when you make products, then customers must be able to come. And although you must know that the customers are also stakeholders, because we have the whole of these suppliers, customers, competitors, government, they are called stakeholders. We shall look at stakeholders as a topic of its own. But what you have to know is that customers, they are also stakeholders. And this is where we are going to find the competitors. You may decide to set up, let's say, a factory that is maybe a brewing factory, maybe for beer, for soda, whichever it may be. Maybe it's Coca-Cola or Pepsi. then also other people are going to be doing the same thing. So those are the ones that we call the competitors. So that's the environment that we call the external environment. And that's what the economists call the meso layer. But if you reach level 3, you are going to be doing business strategy. And even for level 4, integration of knowledge. So you'll find that you'll find them more in detail, and especially for the paper for business strategy. However, the examiner there will ask you, how do you analyze the internal environment? Because the environment itself is a two-fold. We have the internal environment and the external environment. So, for internal environment, the internal environment is always analyzed using a tool called, this one we use SWOT, a SWOT tool. And more so, if you are looking at the internal environment, then we shall look at S for strength, and then W for weakness. Because the strengths and the weaknesses are applicable for the internal environment. And here, we look at the company itself. For example, the board, we look at the board in terms of how strong is the board, how weak is the board. We look at the staff, how weak are the staff and how strong are the staff. We look at things to do with internal control. In other words, we look at the internal operating system. We look at the board. Then we look at the staffs themselves. These are the people within. So we look at their strength and also look at their weaknesses. So we analyze the internal environment using the SWOT tool, but especially strength and weakness. Now, from the SWOT tool, we say that we've handled S and W. Now we are left with O and T. When you are into this O for opportunities, then T for threats, and the threats are challenges. Challenges, especially the competitors, meaning these two opportunities and threats analyze what we call the external environment. And I hope you've now understood my aspect here. Thus, when you are using the SWOT tool to analyze the internal environment, we are only limited to strength and weakness. That's when we limit ourselves on the strength and the weaknesses. If you are analyzing the internal environment. But now the O and the T, the O are the opportunities. The opportunities external to the company, which the company can tap into. And then the threats. The T are the threats affecting the company, especially the competitors, the political regime, and others. Therefore, when you're using the short tool, we say that the short tool is a double tool where it can be used to analyze the internal environment, and at the same time it can be used to analyze the external environment. However, when the examiner brings that question, you are going to find that the way the examiner is going to bring that question, he might give it about 6 to 7 marks. So, if you use opportunities and threats, the T and the O, to analyze the external environment, then you can get like 2 marks out of the 7. So in this paper, we have to find a tool, or we have to look for other tools that are going to, that we can use to analyze the external environment, that will give out more points, because this is only going to be looking at the threats and the opportunities, and those are 2 marks. But if the examiner has given it 6 to 7 marks, then we need to develop another tool that we can use to analyze the external environment. Now, there are tools that we can use. The tools that we can use the Porter's 5 forces. And because there are 5 forces, then you can pull the 5 forces to analyze the external environment. But the Porter's tool is not applicable for you here, because you are not doing strategy. And it's a tool that you will learn better when you reach on the level 3, that is business strategy. The second tool that we can use, there is what we call BCG, Boston Consulting Group. But we can also use the SWOT, but specifically O and T will be the ones that will help us to analyze the external environment. But as I told you, the problem with the SWOT tool. Now, the question is, which tool should we use? The tool to be used, the preferred tool. May I call it I call it pastel as our preferred tool, because you are seeing here we have very many points, 1, 2, 3, 4, 5, 6, and there are others we can add. So this is the preferred tool that you can use that can actually help you be able to score the marks that we need. So we need to look at the pastel tool and we see what letter. We look at we open up the tool to see each of these letters is representing what. So P, so the P looks at the political environment. Or the political factors. In other words, where you are operating, what is the political situation? And the E is representing the economy. The S is representing socio-cultural practices. The T is for technology. Then E is representing the environment. Environmental concerns. Then L is the legal environment. Or the legal factor. So that's the tool that we use to analyze the external environment. So, in other words, will you operate a business that's not legally registered? Otherwise, if you do so, then the law enforcers will actually hunt you down. In other words, for the economic environmental concerns, can you really operate a business that is causing pollution in the environment, or that is polluting the environment? And here you can also, even if they have given you, because these are 6, if they say they want 7, you can put another E for ethics. Because we know we are accountants and we have to be ethical in whatever we are doing. So this is the tool that we can use to analyze the external environment and nothing else. So we need now to look at each of these and we see how we can deal with it. But before we look at the tool, please note that you have to note that you are not supposed to analyze the business environment with just the tool. In other words, you are not just going to explain the tool. The question is, you need to be analyzing. You look at, how can I use the political factor to actually address the concern of business? In other words, how is the political environment going to affect the business environment? So those are the things that we are going to look at. So, number 1, We said political factors or the political environment. Now, these are related to management of public affairs and their impact on the business. So it is important to have political stability. Here what we need the political stability. If at all we are to operate, so we need stability in trade. So we need to make sure that at least we can be able to trade freely. But what is important here is how do you use this tool to analyze the business environment externally, or to analyze the external business environment. So you need to know where is the business located. If you are going to be located in areas, say for example, South Sudan, areas of maybe Ukraine, where politically there is insecurity. So it means that is going to limit the business growth. Therefore, you need to analyze the business location to see whether the area is safe for you to carry out your business. But also, you need to be careful of the current regime in power for not showing any interest, because you need to avoid or refrain from involving yourself in activities that are against the ruling party. So the current regime in power, you have to show no interest in the affairs of the political regime in power. Otherwise, your business might be swept away. Because the way they will do it, they may just use one of the regulator to actually sweep you off. Like I heard what happened to WBS, because I heard it collapsed due to tax issues. Because the tax, you know, they can use the tax regime to actually throw you out of business. You find yourself having unnecessary taxes that you can't actually pay, and they are incurred, they are getting charges, have penalties and fines. So, as a company, you should refrain from supporting political activities that are against the ruling party. And that's what I'm intending to communicate to you. So the political factor is going to be a problem if at all you involve yourself in activities that are against the ruling party. Number two, we have economic factors or the economy. You need to analyze the economic factors. So you need to analyze it. Like these days, it's not good to throw in your money in any business before you do analysis, or you analyze carefully the economy that you are investing in. Like in terms of the inflation, what are the inflation rates? Because you find that the inflation is high and you can't invest. For example, when you look at countries like Zimbabwe, where the inflation rate is high, If you look at countries like ours, Uganda, the interest rates are high, even the taxes are so high. And analyzing the things to do with the interest rates, the inflation rates, that's all to do with. Of course, we also have to look at the purchasing power. Because you may be in times, maybe in times of elections, because now we are proceeding to elections, you find that the purchasing power is low. People have no money. So it is very important for you to analyze the economic key factors. So these are some of the reasons as why you find those people with money and they don't want actually to do investment because of poor economic factors. And they are not even sure of how it will end. Because sometimes it may actually worsen. Just like Lewau told you, towards election times, people fear to invest because they don't actually know what will be the outcome. So you look at things to do with the purchasing power, whether people actually have the money to actually buy the products that you want to produce. Then the other thing, the third point is social factors. The social factor, as a business person, you need to be mindful of the cultural events in areas of operation. For example, it will be hard to open up a piggery business in areas that is mostly occupied by Muslim people. So it will be hard. Therefore, you need to be mindful of the community. If you want to set up maybe a company that is processing biscuits, then you have to look at the demography in terms of the age rates, the age limits that are there young people that are actually going to buy, because most of these old guys, they don't actually take those things. So you have to look at the demography. So before you set up, you have to make sure that you have analyzed the external behaviors. The other factor is the technological factor. Now, no company for these days can actually survive without implementing technology. Because even right now on this same YouTube channel, in these lectures that we are providing, if you are not having, let's say, a laptop or a smartphone, then it will be hard for you to actually even have access to these tutorials. That is by default. So you must be having one, either a laptop or a smartphone, to be able to access these tutorials. Therefore, if you want to succeed in business, you have to take note of this same point. But the other thing you need to note is that some of these points we give, you may be given a case and you are the one to just uproot those from the case. But let's just look at all of them. The other one, we have the legal environment or the legal factor. We said these days it is possible for you to run a business unless your legal documents are clear. And the company is actually registered, or the business is registered, either as a partnership, a sole proprietor, or a company. And the concern these days is that you must be registered with URSB, Uganda Registration Service Board, Bureau. Uganda Registration Service Bureau. And immediately you register with it, you register with URSB, then you find yourself have to get a TIN number because URA will just come in there and then. So I hope you get my point. And it's clearly impossible for you to run an illegal business these days in Uganda. So look at the other is the environment factor. The environment, in terms of the climate and all that. Nowadays, we are seeing that the NEMA is actually doing some activities. The National Environment Management Authority is the one that is responsible for wetlands and all that. So you find that they are trying to come after those people that are doing business in wetlands, in wetland areas. They are demolishing their properties, like the business buildings and others. So these activities intend to avoid pollution of the environment and other climate challenges. And finally, as I said, we are accountants. We have to look at ethics. So if you are an accountant, you are supposed to remain ethical, and you should have nothing to do with bribes, corruption. Although these are things we just study, but other things actually, guys out there, they are just doing, they are just corrupt. But these are the things that we are supposed to look at. Conflict of interest. etc. There are other things that we shouldn't do as accountants. So therefore, ethics matters. So by using the PESTEL tool, we are able to analyze the external environment. And I hope that's clear. So the other thing that we want to look at, let's now go to another topic called ethics. We look at ethics in detail. Ethics in financial management. Now, let me talk about ethics. Because ethics is very important aspect. It is an important issue. And we need to be careful on this section about ethics. Because it appears in most of the exam sittings. It appears in most of the exam sittings. So, it's a popular question, and it's an area we must be able to capture the good marks. So, you as a finance manager, you are supposed to promote ethical practices. In other words, You are not supposed to promote unethical practices in the business. And those ethical practices, they are not many. However, you'll hear me talking about ethical and unethical issues. But I prefer to start it from the unethical point of view. I prefer to start from the unethical point of view. We first look at the unethical behaviors or issues, and then we look at the other aspects. Number one, we have bribery. You are not supposed to seek bribes in order to offer a service, and I hope that is okay. The other one is corruption. The third one is money laundering. The fourth one, we have inside dealing. So here, I call it insider dealing. Number 5, we have fraud. So, number 6, we always say others. In other words, from here, we have issues to do with pollution or waste management. So, those are some of the issues that we may look at. Therefore, if you are a company and you are a finance manager, you are not, and you find yourself that you are not providing money to handle issues to do with pollution or waste management, then you just know you are corrupt. Now, let's get the examination perspective. Examination issues. Now, the examiner will bring a case. It will be a scenario or a case. If you are lucky, in the case, he will mention the unethical issues or practices. So, the examiner will be direct and ask you what are the unethical issues in the scenario. So, he will be direct and he will ask you the unethical issues in the case or in the scenario. So the rule of the thumb is that you should try as much as possible to make it practical. When you're answering this question, you should be practical. In other words, being practical, it means you are linking the answers to the case. However, you have to dictate how many marks the examiner has put. If the question has, let's say, 6 marks, And in the case you are seeing only 2 or 3 marks or points, then you have to first pull out these 3 that are in the case and try to show him that as you have mentioned these in the case, it is said that this and this is doing ABC. And that's the way the examiner is going to feel happy to see that you are referring to the case, which means that you have understood what you are supposed to do. So because in the case there is 1 or 2 unethical practices, but the marks are up to 6, then you can add others. You can add others as we talked about, corruption, bribery, as we talked about them. So let's try to explain the unethical issues as we outlined them, because we need to have an understanding of those issues that we have highlighted. Now, we said bribery and corruption. Now, these two are similar, so avoid starting with them when you are answering the question. In the case, whether there is one case or one unethical issue, let's say there is what we call insider dealing. Then just know that the insider dealing, it results to corruption. Therefore, when in the case there is insider dealing or insider dealing, and you have answered it very well, then you can go down after you have brought all the issues, and then you talk about the issue of corruption. At the end, depending on how many marks the examiner has located to that question. However, never talk about a case or a point that is not near or close to the case in the question. And most of these points, like things to do with, let's say, money laundering, things to do with insider dealing, most of these points, they are either mentioned in the case or they are not there. So there are other issues that you can talk about. We have issues to do with the window dressing, or what we call creative accounting. It's also an ethical issue, meaning doctoring accounts or misrepresentation of facts. There are so many other unethical practices. So we've now known how we can handle the examination aspect. So let's look at the unethical issues in details. Issues. Therefore, I'm talking about ethics. I'm talking about things that are not acceptable. They are not acceptable. Or things that are not morally right. Not morally right. And those are the ones that we call the unethical issues. as we outlined them. But now we can try to look at some of them in details. We looked at one, money laundering. Now, money laundering is the practice of using illegal money in other words, money got from unknown sources. The money is there and it has been introduced, let's say in the company, but we don't actually know where it came from. So, illegal money or money that came from unknown sources, if not checked, it can cause problems to the economy, either politically or in any other way possible. For example, someone can obtain money from, let's say, the donors. You can get money from the donors or these NGOs. But you find that this money is not declared to the organization. Like what you saw what happened to FDC. We had that the Secretary General received money into the political part of FDC, but it wasn't disclosed where it came from. And that resulted into conflicts among the party members. And we all know what happened to FDC at that time. So, if that was a company, the finance manager will not be allowed to promote money laundering in the organization. However, when you do auditing and ethics, it is a paper on level 2 and level 3 possibly. Then from there you'll be able to analyze, to go into deep understanding of what money laundering is. But here our issue is just to understand. We don't look at the details. We just need you to be aware that money laundering is not acceptable and it shouldn't be promoted as a finance manager, and that's all we need from you. The second point, we can talk about inside dealing, or what we call the insider dealing. For example, inside dealing is something mostly done under these commercial banks. Commercial banks have those funny stories of insider dealing, because you find that these directors get people's savings and they lend the people's savings to themselves beyond the regulations. And when people come for their money, then you find that the money is not actually there. So insider dealing is not a good practice. But what we have to understand is basically how it happens. And that's how we can understand it better. However, how I teach it here is the same way I teach it in advanced financial management. Although for them they bring mainly detailed cases and you'll be required to analyze the unethical issues available in that case. So when you look at the advanced financial management paper, it brings out some of these things, because for it brings a very detailed case, and you can be able to get some of those things. If maybe you can try to download October 2021 for advanced, the question paper for advanced financial management, October 2021. There is a case to do with insider dealing. Insider dealing, I think, with the conflict of interest, but it's an advanced finance management paper. Although the same way we studied it, we studied that here is the same way we studied from the other side. And sometimes from advanced financial management, we don't actually study them. We just take assumption that we covered them at financial management. Therefore, insider dealing is where you use the information private to you or private to the company for your own benefit. You use private information for personal benefits. In other words, you stand to gain. You give out the information and they give you something. So, in other words, you just provide information just to enrich yourself. For example, if let's say you are the CFO of let's say MTN Uganda, and you know that this company is making good money, and since this company is making good money, you've seen that they are now going to sell shares to the public. Then you go ahead and tell your brothers and sisters and other relatives to come and buy shares, when you know that after maybe 1 year, the market value of the shares will increase. Because you are the one running the company, so you know what is available in the in the organization, because you are there. Meaning you are using the information you know and you are giving it to your relatives to actually come and benefit. So that's what we call insider dealing or inside dealing. And the whole point here is that promoting inside dealing or insider dealing is unethical. That's what we are trying to get from this. The other, we can talk about conflict of interest. Conflict of interest is just a situation where someone who has to make a decision in an official capacity stands to benefit personally from the decision. You find someone, instead of other people saying we do this, the other person is just saying we do this. So you're just contrary to what other people are actually saying. And there are no justifiable reasons as to why you are actually taking the opposite side. So you stand to gain because you know what you will be promoting. The other issue is we can talk about fraud, bribery, corruption, etc. There are other things. Now, the question, the way it's examined, once you know these unethical issues, in the exam, you should go with the general points as we've given them. The unethical practices: bribery, corruption, fraud, money laundering, insider dealing, and others like window dressing, misrepresentation of facts, tax evasion, etc. There are others. And those are the things you will see in the case. So once you have these unethical issues, then you can look at the case on how is the examiner examining the question. One way, because it's going to be a two-way. how they are going to examine it is going to be a two-way. Now, the one way, the examiner is going to bring a general question. That's one way, where the examiner is going to bring a general question, and therefore it's general in nature, then you should answer depending on what the marks they have given. Give corruption, bribery, etc. But he could bring a case. It would be a case question. Or a question that is specific to the issue. They may bring a case that is specific to, let's say, insider dealing. Then you have to pick the practice that are there in the case and nothing else. And I hope that's okay. But also the examiner might not be direct, but he could give you, you'll find that maybe the examiner is not bringing a case, is not bringing a general question, but is just dodging you. So the examiner will be dodging you, but he will also be giving you scenarios. In other words, he could be showing you some aspects that are leading to unethical practices. In other words, those are the ones that we call the temptations. The examiner is tempting to mention that there is unethical behaviors, temptations to undertake decision that are morally questionable. You may find that the examiner is actually trying to dodge and is giving you situations that could actually lead to unethical behaviors or that are not morally right. So those are the things that we are going to look at. Number one, he will tell you that the accountant has delay in payment of suppliers without any justification as to why. So you may find that he may give you a scenario that the accountant has delayed to pay maybe dividends, even though the board had approved the dividends, and there is no justifiable reason as to why he delayed to pay the dividends. So this alone can lead to one, bribery or corruption. Because if you can't give a reason as to why you are delaying, then it means you are just waiting for them to give you something before you make the payment. Of course, I also understand, but I understand the situation where the accountant may be trying to delay, maybe the money is not there. But the money is there and it has been approved, but the person is not actually making the payment. So I hope you understand the argument, because things will not be direct as you think they may be. The other idea, the examiner might also tell you that the supplier made their supplies maybe 2 months back. But the accountant has delayed their payment. So the accountant has delayed to pay the suppliers, and there is no justifiable reason as to why he's holding their payment. So I don't want you to take it in the other aspect, because I know there is the other point where you, the accountant, you are saying, I can delay the paying suppliers because there is no cash flow in the business. But you see, here the examiner is telling you that there is no justifiable reasons as to why you are holding the payment, and that means you are looking for bribes. So when he asks for the unethical practices, then you can say that owing to the fact that he has delayed to pay the suppliers, then is promoting corruption or bribery, since there are no justifiable reasons as to why he is delaying. You may find that the examiner is talking about cases to do with the destruction of environment, maybe destroying the environment or polluting the environment, cases to do with the environment. So there could be a case of destroying the environment. There could be cases of using relatives at work. Maybe instead of these guys, instead of giving the people, the qualified people, they are just bringing in their relatives to come and work. There could be issues of nepotism. There are issues to do with emphasizing on substance over form, that kind of stuff. You may find yourself, people are saying this is right for you, are saying the other one, because you know what you are, you know what you are promoting. So this is actually the softer part where the examiner can actually use by not being direct. So we need to be careful on that. But let's look at what could be or why is it good for companies to operate ethically, or to do things in the right way, things that are morally right. So we look at the importance of operating ethically. Importances of operating ethically. One, it helps the firm to avoid fines and legal fees. So for example, if you're a finance manager who has been doing creative accounting, you are doing tax evasion, misrepresentation of accounts in order to avoid maybe paying taxes, which is unethical, and once discovered, then you'll pay higher values in terms of fines and legal charges. Secondly, It promotes public trust. Operating ethically promotes public trust. And therefore, as a company, you are expected to live longer. So you need customer loyalty. So the customer will keep on buying your products as long as you do what is right. If in terms of quantities, you are making the right measurements, the weights are okay, the pricing is okay, even the quality, then you expect that customers are actually going to be coming in, and that will create customer loyalty. Also, promoting customer loyalty is also another point. Customer loyalty. Because customers, they become loyal, and they, in the end, you are going to be getting more money. Then the other one, it also attracts employees to work for the organization, because everyone is looking for the company that can actually operate ethically. So good corporate behavior tends to attract the best talent to work for the organization. Now, we need now to look at situation to do with mitigation. How can we solve the unethical issues? Now, this is our last item that we can look at. The examiner will bring a question on ethics. This is what is going to happen. The examiner will bring a question on ethics where it's a two question in one. It's 2 in 1, where he wants you to identify the unethical practices in the case, and then you tell him how you will mitigate those unethical issues identified. So, for example, if you've seen that there is bribery or corruption in the case, those are the unethical issues. So you've seen them, then the question is, how are you going to solve those unethical issues that you've seen in the case? So we are going to look at the different ways on how unethical issues can be mitigated. So, ways to mitigate unethical issues. So, there are two ways of answering this question. If the question is asking for ways to mitigate, of course you can't mitigate what you have not seen in the case. So there are two ways. It's a two-way also. One, we can decide that maybe we first identify the unethical issues. We identify the cases or the issues, the unethical practices in the case, and then quickly give the solution. You identify one case, then you give the solution. The other way is to make sure you first identify all the ethical issues. You identify all the cases, and then at the end you give general solutions. Because we say these things, they are actually related. So you identify the unethical practices, maybe one or two that you've seen in the case, then you give. After that, you come back, then you address that you showed that these can be mitigated in these following ways. Then you start highlighting those cases. As I said, after you come up with those unethical issues, it's where now you can say, however, the above unethical issues can be mitigated using the following practices. Now, one, we are saying refocus compensation plans towards meeting the other stakeholders' objectives. So we have to refocus the compensation plans towards achieving the objective of other stakeholders other than our personal objectives in order to make more money for the business. Because if we focus on satisfying every person's interest, as we the people who are serving the organization, then we can be able to make more money for the business and mitigate those unethical issues. Because by looking at what these other interested groups want and we fulfill them, it will actually mitigate the issues. Secondly, promoting and designing codes of conduct. So, we recommend also to promote and design codes of conduct, like how someone is supposed to behave. And once you know that the code of conduct is this, then you are not supposed to promote unethical practices. Because when you are joining some organizations, they take you through the orientation week and they give you what they follow as far as the organization is concerned. So you come to know what the do's and don'ts of that organization. So at that point, if we promote those codes of conduct, we are not going to be able to have unethical issues in place. The other one is improve communication across board. We can also improve communication across board because some of these things happen in companies because the management, they actually don't know, or they happen to some people and they don't actually know how to actually handle certain things. And it is possible for something to happen and the board doesn't actually know. So we can mitigate the issues unethical practices by improving communication across the board so that it is not a complicated area and anyone can actually be knowing what's going on in an organization. The other one is we can join and be part of, join and become members of associations. So you join and you become members of associations that emphasize ethical decision making, like the Institute of Certified Public Accountants of Uganda. So if you are a member, you find that you are going to operate ethically because you have someone who is regulating you. And for any instance that you make maybe fraud, you may find that the institute will actually withhold your certificate. They can withdraw your certificate, and now, so by fearing that, or by becoming part of an organization or an institution, an association, it helps you to avoid some of those unethical practices. So we shall elaborate more on these things when it comes to revision classes, when we are going to be talking about the different cases that are within our different past papers that we already have. Therefore, I'm going to conclude this. We can actually look at a practical question. There is a practical question that you can download, go through it, and see what the cases there were, or what they were talking about. We have November 2017, question 2. And there is also question 4A, part A, of November 2018. So those are the things that we may actually, you can download it, have a look at what the case was, how it was set, then we can be able to talk about some of those things when we go to our revision classes. So I want us to end our lecture here. The things that we didn't complete, they are the ones that we shall look at when we go to the next lecture. Thank you for watching. Endeavor to subscribe. Make sure you join the Telegram channel, download the course materials, and follow along. That's all for today. Until we meet again. Hello everyone. Welcome back. We are starting our lecture number 3. And we'll be here for about 2 hours. And this is financial management paper. So welcome back once again to our YouTube channel. However, you'll give yourself about 10 minutes break in between those 2 hours. For those that are returning back to our YouTube channel, I appreciate you guys, and I hope everyone has actually downloaded the course materials from our Telegram channel as we begin our class for today. Now, we have to be careful because this course is made up of at least 40% theory, but in between those theories, there are calculations. So you need to make continuous reading of the theory aspects. So, meaning it has over 60% computations or calculations. So you need to do some reading of the theory aspects, because it is these theory aspects that are backing the computations that we are going to have. So I request you to stick to this channel because the calculations are the easiest. And that's why I'm requesting you to read the theory. And when you're reading, make sure you stick to those that we've actually discussed. And understand my arguments when it comes to the theories, because I try my best to explain those theoretical aspects to you, because I know they are very important. Now, from our last lecture, I guess you guys have realized that by now we have started hitting question papers. So I request you, and I would like you to move with that pace, because every time I add on a lecture, it means I'm adding something new. In the previous lecture, or in the lecture number 2, we did not finish some of these things. There are things that we wanted to talk about, but we never concluded them. One of them, we had the goal of the firm. Secondly, we had agency theory. We had also stakeholders. So these are the key 3 things that we were supposed to talk about, but we never concluded them. We never looked at them in our previous lecture. But the reason we are not able to cover some of these things is not that we just want to cover whatever we are supposed to cover. But the issue here is that we need to understand, to make sure that we understand the concepts by not just rushing through finishing whatever we have to do for the day, but we need to make sure that we are understanding these aspects, because as I said, these theoretical aspects, they are the ones that are leading into the computations. And if you don't understand the theory behind the computations, it will be hard for you when you're doing your self-assessment. So we are not here to rush topics or rush concepts, but we are here to understand, even if we cover less, but at least we have internalized everything. So I want to start with these aspects that we never spoke about in our previous lecture. So let me start off by looking at the goals of the firm. The goals of the firm, then it will be followed by the agency theory, and then we finalize with, or at the end, we look at stakeholders, if at all time allows us. But if time doesn't actually allow us, we shall add these other that will remain to the next lectures. And if time allows us, we will be able to add in some small key things to do with essential concepts. But for now, let's dive in and kickstart our new topic that is going to be on the goals of a firm. The goals, they are called goals or objectives. Objectives of a firm. These are very, very, very important areas, and they're a bit technical. So we need to understand and you don't need to rush them. So this is another important area. So when we are talking about goals and objectives, it covers, or it comes from the aspect that every company has what we call a strategy. That's where the goals and objectives are coming from. And by definition, a strategy is anything that creates direction, into the future. So anything that creates direction into the future, we call it a strategy, in simple terms. And every company, or at every company that we may look at, strategies are clearly laid out in what we call a strategic plan. Something that we call a strategic plan. These are the things that you look at when you're doing business strategy. But all these strategies, they are laid down into what we call a strategic plan, or we can call it a corporate strategy. However, you may not be aware if you are still at junior level. In other words, when you are still employed in these lower sections within the organization structure, but those at the top, the managerial levels, they actually have access to what we call the plan for the organization, the strategic plan that has all the different strategies that the company is supposed to follow to achieve certain things. So if you are still at these junior level or positions, when you reach senior management level, or this you be on the senior management team, then you'll find that the guys that are seated in those positions, they do have access to the strategy, or they are the strategy builders. So you find that you maybe at your organization, you may find maybe the top managers, they are just seated in board meetings, they're discussing certain things. So they're just seated somewhere, but they are thinking for the organization. So but what those guys actually do, they are what we call strategy thinkers. So they are thinking of certain things to implement, to actually come up with what they want to achieve. But strategy, one thing that you need to understand is that strategy can be short-term or long-term. There are those long-term strategies and there are those that are short-term. So as a finance manager or as a student who is doing this paper, we want to focus you on what is happening in the business. The examiner will not ask you what a strategy is, and that's going to be for business strategy paper on level 3. But here, there is something that we pick and you learn the rest from level 3. Here we are not going to internalize into what strategy is, what is a strategic plan, and other things. Those are going to be done on level 3 in the paper of business strategy. Now, once you have goals, then they will be categorized when these goals are going to be categorized. We shall have those that we call the broader goals, and these broader goals that we have. In other words, when you have these goals, objectives, they are always categorized into two, where we have the profit and then the wealth. But they are all grouped into what we call the broader objectives or broader goals. Now, we always have two, and this is where we pick these objectives. For example, you could be a company where we say either you promote what we call profit maximization. It's either a company is promoting profit maximization, or you could be a company and your goal could be to promote wealth maximization. So these are the two objectives. But however, the way we design these objectives or these goals, you find that you can't promote both as an organization. So you are either a profit-led company or a wealth-led company. And that's how the examiner will tune you on. In other words, we are going to look at those companies that are profit-led companies, and also the wealth-led companies. So the profit-led companies, these ones, they focus on profit maximization. Then the wealth-led companies, they focus on wealth maximization. And we are concluding that you can't promote both. You can't be a profit-led and at the same time you are a wealth-led. You are supposed to fall into one category. And even that's how the examiner is going to be looking at it. So either the examiner will ask you the merits, because these are the things that the examiner is going to ask. You may ask about the merits and demerits of a profit maximization strategy or goal, or they may be the merits or demerits of wealth maximization strategy. So that would be in one case how the examiner can actually ask you. But before I focus on these two areas, because these two areas, they are the ones that are going to come in exams, and they are the ones that are disturbing students. But they come in a simple way, and I have mentioned the different ways how they may bring or examine these strategies. And even the examiner cannot actually trick them, because that's how he's going to look at the goals of the firm. So if he brings these two aspects of wealth and profit maximization objectives, then that's how they will be. But students get challenged with how they can actually answer them. We are going to look at those areas. Now, whether you are going to be a profit-led or you are a wealth maximization company or wealth-led company, we will always come up with objectives that we must be able to carry out in order to meet our overall goals. In other words, we have the overall goals of the organization. Maybe they are looking at maximizing profit, and that's the overall goal. But before you look at the overall goal, you have to look at, you have to come up with strategies, or you have to come up with different objectives that you must carry out in order to meet the overall objective of the firm. And our overall goal could be profit maximization or wealth maximization, as I've said. So, for us to come up with what we call the corporate objectives that we as companies must be able to carry out in order to meet the overall objectives. Remember, we said you can't be both. It's either you are profit-led or you are wealth-led. And that's the main goal of the firm. So that's the main goal of the firm. But for you to achieve this, to achieve the profit that you want to look at, you must set up other objectives. And these objectives, they are the ones we call strategies, or the corporate objectives that we must do in order to achieve the overall objective of the firm. Now, let's take an example. Let's look at some of the examples of those corporate objectives. Examples of corporate objectives. These are the things that we must do if at all we want to achieve the overall goal of the business. Now, when we are drawing these objectives, they come from the following key areas. Because these objectives are going to be generated from different sections. because there is something that we need to do in the production, there is something that we need to do in selling and distribution, there is something that we need to do as administration. And when we do all of those things, then we are going to achieve the overall aim of the business, and that's maybe profit maximization or wealth maximization. So these objectives or these corporate objectives, they are going to come from key areas. So we need to first look at these key areas where the objectives are going to come from. One, it could be an objective focusing on market. It could be focusing on market, objective focusing on market. And what can we do to our market in order to achieve the overall objectives? So if we look at the market as a key area, so how is this market going to help us to achieve the general objectives? Here, it may be either that we are going to be looking at maybe market share, gaining market share. It may also be customer satisfaction. Customer satisfaction. In other words, we are focusing on satisfying our customers so that we can sell more. Customer satisfaction. The other item, we may also try to say that let's come up with new products or services. Products or services. Because if you are focusing on the market, you have to look at, are we dominating the market? Secondly, are the customers satisfied with the services that we are providing? Then you have to look at the aspect, can we be able to add in some new products to tap into those other opportunities that we may be seeing as an organization? So by doing all this, you realize that maybe you find that maybe your products are not selling. Then you can come up with an objective to refocus your market and finally get a more market share. Because you may find that by focusing on the area of the market, you may look at the market and you realize that your products are actually not selling all that as you expected it to do. So you find that instead of you focusing on producing what you've been doing, you change and you look at how you can improve your products so that they can meet the marketing demands and finally gain a bigger market share. That's one way that we can. That's the first key area. Then the second key area, secondly, you may come up with an innovation. It will be in areas of innovation, where you come up with one, you may decide to come up with, you can decide to come up with better processing, maybe methods. Secondly, you can also bring in new products or services. Because by bringing in new products or services, that is as per innovation. You can make an innovation and make sure you add in some good products. Thirdly, we may look at, it may be in the area of, it could be something to do with productivity. Or profitability. This one could be an area where you are supposed to focus. So you may say, you may come up with different ways of how you can be able to improve what you are producing, and at the same time you find that that product that you are producing is actually making money. So I'm giving you something that you can add on the broader aspects that we have. But at the end of the day, I will show you where the question is going to come from. The other fourth area could be public responsibility, where you can come up with an objective that is focusing on compliance with the laws. Like if maybe the company has been polluting the environment, and in other words, if you find that maybe you've not been doing some recycling of the industrial wastes, you find that you've been polluting maybe the drainage channels and other environment aspects. So to avoid environmental damage, you can decide to refocus on the objectives of being compliant with the legal laws. Because if you are not compliant, you may find that you are going to incur legal costs. Recently, we are seeing NEMA is invading some of the organizations that set up their maybe processing plants in wetland areas. So you should also look at it. It may be an area that you could look at. However, these business people, the people that actually make money, or the people that own these businesses, sometimes they become very dangerous, because like those guys who are actually profit-led, those companies that are profit-led companies, for them, what they are looking at, they are only considering profits and nothing else. So profit-led companies, because for them, their overall objective is going to be profit maximization. Some examples that we may look at, because what is going to happen is that in the exam, they may actually give you a case. The examiner can actually bring a small case and they tell you to illustrate and show some objectives. Now, in most cases, someone who is profit-led, the objectives will always be financial. Someone who is profit-led, the objectives are always going to be financial. And even when they go into their board meetings, when they go in the boardroom for their meeting, they only talk about money. So profit-led companies, their objectives tend to look at the things to do with money. You find them talking about increasing the turnover, reducing costs. So you find them talking about reduce the cost of this, reduce the cost of that, and they're talking about things that can help the organization to actually increase their profits, but they are not looking at the other side, whether these people who are actually making the profit, whether they are earning a good amount of money. But strategic objectives should always be split between financial and then the non-financial. These are the strategic objectives. We are supposed to have the financial objectives and then the non-financial objectives. We may try to look at some of the examples of financial objectives. One, to increase turnover to 5 million, maybe 5 million US dollars in the next 5 years. So this is financial. We are just saying that the objectives, they are including in monetary aspects only. These are the financial objectives. But what you should know, for these objectives, they must be SMART. SMART means, this S means specific. They're supposed to be specific. So these are the objectives, it must be specific. So whenever I read the objective for financial objectives, they are supposed to be specific. Like if you read to increase turnover to 5 million in the next 5 years, it is specific in nature. M means measurable. Whether you are able to measure the objectives. In other words, are you able to measure that objective? Of course, here we want to achieve 5 million. So it means it's measurable. A means attainable. Can we achieve it? Attainable or achievable. Then R means realistic. Realistic. When you're setting these objectives, you're supposed to be realistic. In other words, you don't set goals that you can't achieve. Then the T is the time bound, the time factor, time bound. In other words, they should be up to a certain point in time. So that's why we are saying for the next 5 years. So can we attain the turnover to 5 million maybe US dollars in the next 5 years? Or we can't? So these financial objectives, they're supposed to be SMART. So number 2, we may talk about number 2 here. We are saying to increase total revenue by 10% annually for the next 5 years. Now, so It's measurable and even time bound because we have the percentage and we have the time frame. However, we said that these objectives are financial. The other objective that we can look at is to reduce total costs, whether production or company costs, by let's say 15% or 18% annually for the next 3 years. So we are looking at reducing the costs, because by reducing the costs, we are trying to increase our revenue. So if you look at all of these objectives, they are financial objectives, and there are many companies of that nature. Although the examiner can tell you to give examples of what we call the non-financial objectives. Non-financial objectives. Now, these non-financial objectives, they may not be taking that smart approach. They may not be smart, or they may not be taking the approach, the smart approach, but they could be there, although they are not taking the smart approach. Now, we can try to look at some of these. One, to improve the welfare or the well-being of all employees. The welfare of employees in our organization or in our company. So to improve the welfare of all employees, it's non-financial. And this is very important objective. And if you don't do that, then you might lose the best hardworking employees. Although the examiner has never brought a question to write about the objectives, but he can throw a 4-mark question in that line. But you need to balance here, because in this paper you don't actually going to pick these from the case as it is in the business strategy paper. So here it's more like an illustration, as long as you understand that we have the financial and the non-financial objectives, because in the other side they may bring, in the business strategy paper, they will bring a scenario, then it will be you to pick some of those aspects from the case they have given you. So therefore, what is dictating having either a financial or a non-financial objectives are these two goals. The one we call the wealth maximization or the profit maximization objectives. So these are the these two objectives, they are the ones that are dictating whether we are going to be having a financial or non-financial objectives. So those two goals are the ones that are taking you in that format. So you need to pick You need to pick me well, starting from this point, since it is where the examiner is going to pick the question for you. For example, most of the times you find that these Indians, they promote what we call the profit maximization goal, and they don't care about anything else. They are only looking at the profits, and basing on that, that's how it was until these economists thought of the other way to increase performance. Because these Indians, for them, they were focusing on making profits, reducing costs, increasing the revenue. But they were forgetting that they should care for the employees so that they can actually produce more units or they can generate more revenue. So for them, instead of focusing on the non-financial objectives, they were only looking at the financial objectives, and the main motive was to maximize profit. So it is until the economists, they brought in what we call the wealth maximization objective. So the wealth maximization aspects, for it is very beneficial to both the shareholders and also the employees plus the public or other stakeholders. Because once the employees are better, then more revenue can come in, or they can be able to generate more revenue. So that's what we call the wealth maximization objective, because for it looks to both the stakeholders, the shareholders, for the owners of the business, and at the same time they look at other stakeholders like the employees. However, the examiner will not ask you which of these two goals you prefer, but they will only say that maybe some companies still promote profit maximization, even though it's not a good thing. Or they may say, although some business owners are saying it's a good one. So the examiner will ask you what are the arguments in favor of profit maximization. So the profit maximization objectives, what are the arguments for that are in favor? Arguments in favor of profit maximization. So what are the things that we can look at that can actually, so we need now to look at the profit maximization objective. Before we look at the objectives, let's now try to focus on the profit maximization objective or goal. So the profit maximization objectives, one, those who promote profit maximization as an objective or as the goal of the business. So the goal of profit maximization most of the time is short term, because 1 year, as you prepare for the financial statements, you can actually see whether you've made a profit or loss. It is a short term. In other words, it's a single period, like 1 year. Because with 1 year, you can prepare the statement and be able to see whether you've made a profit or you've not. So the goal is short term in nature. So it is always delivered within 1 year. You focus only on profits, then you can achieve it in 1 year. And it's done. And they don't care what happens after 1 year, because for them, what they want to see is, have we made a profit? And that's it. They don't actually want to know how much is the profit, but they just want to know, have we made a profit? And that's it for them. And it's always achieved in 1 year. Whereas this could increase the profitability, because we look at it, by making a profit, it increases the profitability in the short run, but it's likely to affect negatively the future growth and development, and even the long-term survival of the organization. Because for you are looking at, we've made a profit, but you've not gone ahead to look at how much have you made as a profit. Now, the examiner will ask you, what are the favorable arguments for profit maximization goal? So that was just as a brief introduction. So the favorable arguments, or the arguments in favor for profit maximization goal or objective. So from this, the main thing that we are looking at are the aim of the business. Because for them, they are saying that the main aim or the main goal of a business is to make profits, is to earn profits, and nothing else. That's one of the reasons why they are preferring the profit maximization objective, because they know that the main aim of any business is actually to make money. Two, profits, of course, if you make profits are the parameters of the business operation. In other words, if you are making profits, we can look at your business and we say you are actually working well when you have made profits. Then even these profits, they're actually a source of profit, is the main source of finance. Because it is through these profits that we kept on accumulating what we call the retained earnings, is what we can use to do other investment. Eventually, profitability eventually meets the social needs. If you are profitable, you can actually be able to meet the social responsibility. So profitability eventually meets the social needs. Because if you don't have money, there is no way you are going to do social responsibility. In other words, there is no way as an organization you are going to construct schools for the society. There is no way you are going to provide maybe some good roads. So there is no way you are going to be doing the social responsibility. So these are the advantages of profit maximization. It's an aim of the business. Profit is the parameter of business operation, because that's where we start operating. That is the main focus as businesses. So let's look at the unfavorable arguments. These are the disadvantages, the unfavorable arguments. For all these are arguments against profit maximization objective or goal. One, profit maximization, it leads to exploitation of workers and even consumers, because these companies, when they are profit led, they don't care what they have paid to the customer as long as they earn the profit. The other thing is that these customers, these are the people that are going to be consuming our products. They are not going to care about them because they can do even wrong measurements. Because by doing wrong measurements, for you as an organization, you are getting money, because these customers, they will be taking things that are not of the appropriate sizes. And for the company, it will be profitable to them. Two, it creates immoral practices. Immoral practices such as corruption. So practices that are unfair. They may be in terms of corruption, unfair trade practices, such as you find someone has packaged a 1 kg of sugar, but instead of having 1 kg or 1,000 grams, you find that someone is putting 900 grams instead of the 1,000. So 1,000 equates to 1 kg. But instead of having 1 kg, you find it is having 900 grams. So those are the unfair treatments. Those are unethical. We shall look at ethics later in the course. So these are the things. We are just only giving out a few, but you'll find more of these. The idea is actually to get the concept. Therefore, the examiner will bring this question, and it is going to be either you contrast it with the wealth maximization. In other words, if he asks you for the advantages of wealth maximization goals, contrary to those of profit maximization, or you may say you bring the advantages of profit maximization contrary to those of wealth maximization. Now let's try to look at the challenges or the drawbacks. Drawbacks or challenges or problems of profit maximization objective. So what are the drawbacks? So the drawbacks, one, it ignores the time value of money. It ignores the time value of money. We are going to look at time value of money. It ignores the time value of money. In other words, for it doesn't care as long as you've made profits, but it doesn't look at the timing of the cash flows. When are these monies coming in? Secondly, It ignores risks because we've not had anything to do with inflation. They are not caring for changes in the interest rate, changes in foreign exchange currencies. They don't care about that. Then the other thing is it's vague. It's vague. So I need to explain what vague means in this perspective. Because the word profit, as you hear the word profit, it carries different meaning to different people. Because if you talk about profits in the religious perspective, it is spiritual, something that is related to money. If you talk about profits in the business language, it is revenue minus costs. So it carries different meanings. In other words, we don't actually know what it means. And that's why we call it's vague. It doesn't portray its meaning. So it doesn't actually specifically tell what it means. And sometimes when you talk about profits, someone is going to be wondering, what do you mean by profit? Are you meaning the operating profits? Are you meaning the net profits? Are you meaning the profit before interest and tax, or profit before tax or after tax? So someone is going to be asking those questions. So the word profit itself is vague. It doesn't clarify what exactly it means. That's why we are saying it's vague. Then the other one, we said when you are considering profits alone, it fails to consider the social responsibility of the business. Of course, when you're aiming on profits, it means you're not going to do social responsibility to the public where the business is organized. The other one, it is short term. It's also problematic because it is short term. In other words, in the long run, the business may actually collapse. Because for you, since the word itself is vague, you may be talking about you've made profits. But the profits itself, maybe you've made just 1 million of profit. You can't use this profit to sustain the organization. Even if you keep accumulating this, in the long run, you are not going to do any kind of investment. So that's all that we can talk about as far as profit maximization is concerned. Now let's look at what we call the wealth maximization objective, profit maximization goal or objective. So what we are probably saying is that the wealth maximization is the best because it's balanced, since it looks at both the financial and non-financial objectives or goals, objectives. So what we do by definition, because someone is going to ask, what do we mean by wealth? What is wealth? So wealth, it can actually be the present value of all future cash flows. Because of course, by looking at the present value, it means you have already discounted your cash flows. So Wealth is the present value of the firm's cash inflows. In other words, what you expect to earn in the future, discount it back to the present. That's what we mean. Whatever you get is what we mean by wealth. So this is the present value of all the cash inflows we anticipate to receive. For example, if let's say you've planted a forest, you have trees, maybe you have, let's say let's be specific to eucalyptus trees. Maybe you have, let's say, 5 acres, and maybe you expect to have, let's say, 100 million from that in, let's say, in 5 years. You expect to get 100 million from those 5 acres. So this 100 million is the cash flow that we are expecting to get. So want to discount this because we are expecting to get this 100 million in 5 years time. So want to discount it back to present, or what we call the now. In other words, today we see how much is 100 million today. So we do that by doing what we call discounting. We shall look at some of these words in detail. So the figure that we've gotten in today's terms, or the present worth, is what we call wealth. So let's now look at the arguments in favor of wealth maximization. Those who are saying wealth maximization is okay, what are the advantages of it? So arguments in favor of wealth maximization objective or goal. One, it emphasizes that benefits are measured, in terms of cash flows. In terms of cash flows, what you expect to receive. In other words, in an investment or in an investment decision and the financing decision, it is always the flow of cash. The flow of cash that is important, and not the accounting profits. You know, there is a very big difference between the accounting profits and the cash profits. Whatever that involves in the movement of cash is categorized into cash profits. But the accounting profits has some different aspects. The non-cash items like depreciation, provision for bad debts, and other things like amortization and all that. So accounting profit is different because it will take away even things that are non-cash items like depreciation, which are not involving into physical movement of cash. Because expensing depreciation from the profit you've earned doesn't necessarily mean that you have paid out the money to depreciation expense. The other aspect is that it considers the time value of money. In other words, we are discounting it considers the time value of money. We shall learn the time value of money or the time quantity of money, because we shall see why we call it the time quantity of money. Then the other one, it also looks at the risks. Because by discounting, remember you are discounting these cash flows with a discount factor. So it gives weight to the risk factor by making the necessary adjustment in the discount rates. So if you have got your cash flows that are spread over maybe for the next 5 years, and maybe you want to know your worth now. If let's say you have these cash flows, let me just illustrate that. You have cash flows maybe for the year 2024, 2025, maybe 2028. So you will see that maybe here you have 100 million. Maybe here you have, let's say, 5 million. This one is 50 million. And now maybe we are in year 2023. Just assume, even though we are in year 2024. So the issue here is that we are focusing on the cash flows that we are anticipating to receive in 2025, 5 million, then 100 million in year 2028. So by discounting these cash flows back to the present, what you are doing, it's like you are taking care of the risk that is associated with that cash flow, because we are going to be discounting for the different time period. Therefore, by getting the present value of the future cash flows such that you are able to know your worth or the worth of your investment, then you are catering for risk that is associated with that investment in the future. Then the other idea that we can talk about is the survival. It takes into consideration the long run survival of the business. Survival and growth of the business. So it looks at other factors. So these are the things that the examiner is going to be looking at. It will ask you to give the advantages or the arguments in favor of, let's say, wealth maximization against profit maximization, or it will be the other way around. So that's all to do with the goal of the firm. The other thing that we are going to look at is what we call the agency theory. It's also another technical area that we need to understand and see its applicability, because it never misses. Agency theory. That's what we are going to look at now. So I need to first give it a background. So what you need to know is that when you look at the formation of the company, you'll find that once we form a company, there are things that come along with. But before we go to that stage, you'll understand that when you're forming a company, on the top of the company, the top, we have the shareholders. So we can represent it in an illustration. On the top, we have shareholders. Those are the ones that we have at the top. They are followed by the board of directors. And finally, we have what we call the managing director, or what you know as the CEO, Chief Executive Officer. That's how, or that's what we expect to have as far as company formation is concerned. Now, the agency theory means the relationship between the shareholders, the board of directors, and the managing director, or the CEO. And that's all. In other words, it's just the relationship. The relationship that exists between all these three stakeholders, all these three people, is what we call the agency relationship, and that's it. Therefore, agency theory shows the relationship, between various stakeholders, So agency relationship is just showing the relationship between the various stakeholders in the firm. And because of that, it helps to explain the various conflicts and duties that occur. But what is important, we need to understand how it starts. And that will help us to understand it better. Now, let's see how the duties and the conflicts, they are going to come out. And then we look at the relationship. Because we are going to look at the relationship between these people. We are going to look at the relationship between the shareholders and the board of directors. Then we look at the relationship between the board of directors and the CEO. Because that's how it flows. It comes from the top, middle, then the bottom. So we need to look at the relationship between these three different stakeholders. So, now, the shareholders, these shareholders are the ones we call the owners, or the owners. These owners, these are always many. Most of the times you find the owners or the shareholders are always many. Like for the Companies Act, they say two shareholders or two people can actually start a private company. For public, it is 7. So we find that there are many as per the Companies Act. Since there are many, then what they do what we call, they appoint the board of directors. They appoint the board of directors to run the company on their behalf. They appoint to run the company on their behalf. That's what the shareholders do, because they can't get involved themselves. So if they can't do that, and there are very many, they appoint the board of directors. And it should be the board of directors that will be running the business on their behalf. But at the same time, this is the first relationship. At the same time, you should be able to know that the board of directors are actually not employees of the organization, and therefore they are not going to be there every day. And because of that, the board of directors, because they are very many and they are not employees of the organization, so they are not going to be there every day in the organization. So what do? They go and employ. The board of directors are going to employ or appoint the managing director. The managing director to run the company, on their behalf. So it will be the managing director that will be running the business on behalf of the shareholders. Sorry, on behalf of the board of directors. And this board of directors, they were appointed by the shareholders. So, and below the managing director, we have others. Below the managing directors, we have employees. And the employees, they are the ones that are going to do the daily work. These are the ones that are going to do the donkey work. They are the ones to handle the daily operations of the business. So the agency relationship, the same way you learned it in business law, will be the same way that we are going to learn it here. But we are not going to go in the legal perspective. So when we are talking about the agency theory, we are interested in knowing how does the principal relate with the agent. That's the only thing that we are interested in knowing. How the principal relate with the agent. Meaning, the agency theory is all about showing the relationship between stakeholders or interested parties. And our parties here are the owners or the shareholders, the board of directors, managing director, and then the employees. Because you are now seeing we brought in 3 people. We have the shareholders, we have the board of directors, we have the managing director, and at the same time we brought in the employees, because these employees are going to be employed by the CEO. It will be upon CEO to appoint some managers that are going to actually help out to sort the day-to-day activity. So in that case, it means there is going to be, so the other aspect is that we are always going to have we have a principal and an agent. That's what we need to know. But now we just want to see how the principal relates with the agent. In other words, in between here, we have what we call the relationship. We want to look at the relationship between those two people. So, how is the examiner going to examine this? The examiner will ask you the forms of agency, ask you the forms of agency relationship. So from that, they are going to ask you to explain the relationship between the principal and the agent. Those are the two things. So you have to look at the forms of agency relationship. And in this form, we have only 4 forms. We have only 4 forms. 1, there is a relationship between shareholders and the board of directors. That is the first form of agency relationship. So you will find that some textbooks, they will call the board of directors as managers. But still, they mean the board of directors. And that's even what the syllabus calls it. They call them managers instead of board of directors, but they mean the same thing. So here, the shareholders, they handed the business to the board of directors. These guys, they gave out their business to the board of directors. And because of that, there will always be conflicts. There are going to be conflict of interest. So the examiner will need to know the causes of those conflicts. Because these guys, they have given out their business. And that is going to cause conflicts among those two people. So there will always be conflict of interest. But the examiner will ask you for the causes of the conflicts. And the causes of conflicts that they are going to ask, they are going to be for the different forms. Because it's not all about the shareholders. Even the board of directors and the managing director, there is going to be conflicts. So they will need to know the causes of the conflicts of the different forms of agency relationship. And then they will also ask how best can we be able to resolve those conflicts. In other words, giving the solution to solve the conflicts of interest. And the good thing, I'm going to explain these aspects. But first of all, I want you to understand the forms of agency theory. Secondly, let's look at the second aspect, or the second form, we have what we call the board of directors, and employees. Then we have what we call the shareholders and the creditors. And finally, we can look at also the shareholders and the government. Shareholders and government. But you need to understand certain thing, that when the examiner asks you for the forms of agency relationship, if you just outline them like the way we've given them here, we've just made an outline of these forms. If you just give them like the way they are, then you will not get any marks. So you need to first define what agency relationship is. If at all you are handling this, you define what agency relationship is. Secondly, you have to tell us or bring in the various types of agency relationship. After telling us what agency relationship is all about, then you can come with the different forms. So you don't stop by giving these outlines. You explain one by one. And for you to explain the forms, the examiner, these are the things that the examiner wants. The examiner wants you to tell him who the principal is, and who the agent is, and who the agent is. These are the two things that the examiner expects you to answer. You need to show who is the agent in that form and who is the principal. Now, we can see that the principal is the one who employs the agent. The principal employs the agent, and the agent will perform the activities with the third party. So it is going to happen in this scenario. You'll find that the principal is above here, and is going to employ the agent. Here we shall see they will be employing. Then the agents are going to be working with third parties. Then the question is, these are going to be working with third parties. Now the question is, what will happen here in this line? Because there is going to be a scenario whereby maybe the agent has done something to the third party. How is the principal going to be connected to the third party? That's also very important. Because as the agent performs or is working with the third parties, mostly with third parties we have customers, suppliers, and others. And in the case there is a problem between the agent and the third party, the principal will be accountable. This one will always be accountable. This one is going to be accountable to the third parties. So it's going to be accountable for any actions that may be done by his or her agent. And I hope you are getting my argument from this perspective. So since you have understood this, then let's go and start looking at the forms of agents theory or relationship. We highlighted them, but we are not going to repeat them. So one, we said we have shareholders and board of directors, or the managers, as the syllabus calls it. Now, so what happens here? The shareholders or the owners, the shareholders who are the owners of the business, they are the ones that are going to be acting as principal. So the shareholders who are owners of the business acting as principal, who appoints the board of directors as their agents to run the business on their behalf. And that's all. And you are done explaining your point. So the shareholders, they are the principal. They appoint the board of directors as their agents to run the business on their behalf. So if I'm to repeat, the shareholders who are the owners of the business acting as the principal who appoints the board of directors as their agents to run the business on their behalf. And that's it. So you are finished. You have just explained the point and you don't include in anything. As long as you explain who the agent is and who the principal is, you are done. We go to the second one. The second one, we said we have the board of directors or the managers and employees. These employees we also include in the CEO or the managing director. Now, the board of directors here, the board of directors appointed by the shareholders acting as the principal hire staff or employ staff to run the day-to-day activities as their agents. And that's something that is small but meaningful. So the board of directors, let me call it BOD, the board of directors appointed by the shareholders acting as the principal hire staff to run the business as their agents. And that's it. Then we go to the next one. The third one, we said we have the shareholders and creditors. So in this case, the shareholders, in this case for the shareholders and the creditors, it's the creditors who are the principal. And the shareholders are now going to be agents. But this is how it goes. These creditors, we will say the creditors who are the principal, because these creditors, they are the principal because they lend money to the company, and the company is being owned by the shareholders. But remember, these shareholders who appointed the board of directors as their agents. So the creditors will be working with an agent of the shareholders. And because of that, you must be aware that creditors are dealing with agents. And they are not dealing with the owners of the business directly. So this brings what we call restrictive covenants. And we also have in our homework number 2, we have this. But the restrictive covenants, these are things that are put in an agreement when they lend you money. These are just things that they put in an agreement. These are just conditions they put in an agreement when they are lending you money. Because these creditors, they are going to lend money to the business. But that business, however much it is owned by the shareholders, but it's not the shareholders who are operating the business, it's the board of directors. So the board of directors are agents of the shareholders. So it means since the creditors are not going to be dealing directly with the owners, then it will cause some problems. And to sort those problems, that's why they bring in something to do with the restrictive covenants. These are examinable things. So if you are to explain this, you say creditors are going to be the principal because they will be lending money to the organization or to the company. And the company is owned by the shareholders who appoint board of directors as their agents. And because of that, because of creditors being working directly with the agents of the shareholders and not the owners themselves, it's going to bring what we call the restrictive covenants. And you're done explaining it. But we said restrictive covenants are things that we put in an agreement when they lend you money. For example, they may say if you have, let's say, pledged assets, maybe you have given out the assets as maybe collateral, they can say that never pledge those same assets anywhere. Or they may say if you are to do so, you have to be in consultation with us. They may also say never sell those assets if you have given them out as maybe security. So there are some of the restrictive covenants that we may look at. One, they may stop you from paying dividends. They may stop you from paying dividends. Secondly, they may stop you from doing any other investment. Stop you from investing. Because they may say that we gave you the money and that money should be invested in that same activity that we gave you the money for, not putting the money to other investments. They may also restrict you on merger or on merging. If you want to combine with another company or you want the other company to buy you out, they may restrict you. They may stop you from disposing of assets. So those are the things that we looked out. But we said there are conflicts of interest between. I want to look at the different categories. We have the managers. Let's start with the managers or the board of directors and shareholders. We've said because of the agency relationship, there is going to be conflicts between managers, and because it's the managers or the board of directors who run the company and the shareholders who own the company. The other one, they're owning the company, and this one, they are the ones running the organization. So the examiner will ask you, what are some of the sources? And this is a technical area. If you don't know, then you don't actually know. These are very technical areas. If at all you don't know, you can't be able to add in anything. Number one, we have salaries and allowances. We have salaries and allowances. Salaries and allowances. This is a major source of conflict of interest, but we need to know what happens. So, the managers, they are going to pay themselves highly, even if the company is not making profits. And I hope that you get the idea of managers or the board of directors paying themselves highly, even when the company is not actually making profits, or even when the company is actually making losses. For them, they will keep paying themselves highly, and that's one of the source of conflicts. The good example that we can have, you see what happened to UTL, the Uganda Telecom Company Limited. Because for it had top managers from Libya, whereby these guys, even though the UTL was making losses, their salaries remained. And this is what caused the conflicts or the conflict of interest. Number two, we have differences differences in risk portfolios. So the managers might fear to invest in risky investments. But we all know that in risk management, the more risk, the better. That's from the risk perspective. So the investors may say, you invest the money, and then the managers may fear to lose their jobs, because when the investment doesn't work out, they will lose their jobs. Secondly, since these managers are always on short-term contracts of employment, the contract of service, so they prefer to invest in short-term projects. Since these long-term projects, they may start to realize when they are no longer employed. Therefore, their contracts, you may find that maybe they are not going to be renewed, and they will prefer to invest in short term so that they can reap the profits of their investments when they are still employed by the organization. Thirdly, we may look at the motivation problem. It becomes a problem when the managers are not all that motivated. This is very clear because shareholders, they may prefer not to motivate their people. And then the managers, they will find it hard to run the company without motivating staff. And that can also be a cause of conflicts. The other one, we can talk about creative accounting. Creative accounting is basically doctoring accounts, misrepresentation of facts. It's another way, it's another source of conflict, because the managers might begin manipulating accounts for the sake of maybe dodging taxes, for the sake of having lucrative company accounts. The other one we may look at is takeover bids. Here, the shareholders may want to sell off their company, and for them, they may see that it's a good transaction for them. But the managers might fight it because accepting to sell the company would lead to loss of their jobs. So by all means, they find themselves fighting the takeover bid. In other words, they don't want the shareholders to sell off the company, even though it would be a very good transaction to the side of the shareholders, and that also brings conflicts of interest. Then lastly, we can talk about things to do with the divorce, ownership, and control. This is a bit tricky, but let's get the concept behind it. Now, what happens from this? The owners, they don't actually know what is taking place within the organization, and they will never actually control the organization. So the organization or the company is controlled by the directors, because the owners are the other side, and they just depend on what the directors are saying, since it is the directors who know what is taking place in an organization, and that alone causes conflicts because the other guys, it's like they don't actually own the business because they don't actually know what is taking place in the organization itself. So this is a popular question because it's a bit technical in nature, and the question could be about 8 marks or 7, where they may want you to show how these conflicts arises, and then you propose how to minimize the conflicts. So let's now look at the mitigation ways, or how can we be able to sort these issues. So minimizing conflicts. Minimizing conflicts. Now, one of the answers of minimizing conflict is threat to fire, or threat to firing managers or the board of directors. When the shareholders these shareholders, they tell the managers that if you don't actually, they may say that if you don't actually perform as we expect, we are going to replace you with other people who can actually achieve the performance that we need. And in that process, these can push the managers to actually pull up themselves so that they can retain their jobs. So it is just a threat, but it will be a good threat because it will direct the managers on what to do. Secondly, we usually say that shareholders can incur further agency costs. And some of these costs may be cost of monitoring management's activities. In other words, you find that you as managers, we are going to incur more additional costs, like the cost of monitoring what the managers are doing, whereby they institute the audit team to actually come and carry out the audit of what the managers have done. But just know there are those that are external auditors that are supposed to be there by law just to audit the organization. But there is when the shareholders themselves can institute an audit team to look at the work done by the management. So by incurring further costs to pay the auditors, these auditors are going to be different from the external auditors that are supposed to be there by law for auditing the organization. But these are going to be auditing the management activities. In other words, they are going to be delivering management reports. So the other way is to set up commission remuneration, or you set up payments, managers remuneration or payments based on performance. You can actually decide to give managers percentages. So you peg managers remuneration to performance of the business, like paying them commission, say maybe 10% of the profit after tax. And by doing that, the managers will always find ways to have higher profits after tax. so that they can earn better pay checks. So you peg managers' remuneration to performance of the business. The other one, also shareholders can pay, let them pay good salaries. If they are supposed to pay, maybe they are paying 10%, and it's going to be maybe 10% of profit after tax. This percentage should be good, because if, let's say, someone has made maybe 2 billion in profit after tax, and the person is taking 10% of 2 billion, that's something good, especially for those managers. So whenever they increase maybe to 3 billions, 4 billion, 5 billion, even their pay keeps on increasing. So we need them to be rewarding, paying the managers well. Even when it is just a percentage, it should be fair to avoid conflicts, especially by giving, maybe they can try to give out some non-monetary payments. The other one, number 5, we can look at bonuses, rewarding managers with shares. This makes the managers to feel that they are part of the organization, and they can start to work hard or to work with a new energy, because they will know, since they are shareholders, they are actually making their own paychecks. So when you promise them to get some shares, maybe at the end of the year, then it means they are going to actually perform well. Then lastly, when everything has failed, then we expect shareholders intervention, direct intervention, but that one comes as the last scenario, direct intervention by owners. So when you see that things have actually failed to work out, they can actually intervene and they fire all the managers so that they can reorganize the things that they are supposed to achieve in an organization. So that's basically what we can talk about as far as minimizing conflicts is concerned. Let's look at now something new, and this is going to be on stakeholders. Now, we all work for companies, and everybody has what we call stakeholders. Whether you're working with which company, whether you're working with which company, every company has what we call stakeholders. So even where the company is, because where the company is located, like the exact premises where the premises are located, they are stakeholders. And the stakeholders could be internal or could be external stakeholders. So these stakeholders, they may include, without grouping, they may be include shareholders. We have employees, we are just highlighting them. We have the suppliers, we have the customers, we have the credit institutions, we have the competitors, we have the government and its agencies, because there are many. Then we have the community or the public or the society. Community, public, or society, where the organization is located. There are others. However, the examiner will not only ask you to give these stakeholders like the way we've given them. These stakeholders that are surrounding any business. But the question is always a two-way question, where you'll be required to identify the stakeholders and possibly their interest in the business. And that's what the examiner will be looking at. And that's what I'm calling a two-way question, because they're asking you for the stakeholder, and at the same time, they're asking you the interest. So we need to understand who these stakeholders are and possibly what are their interests in the business. So we need to go back to look at each of our stakeholders one by one, as we are also showing their interest in the organization. So a stakeholder refers or is any person with an interest in the affairs of the business or in the affairs of the entity, because it may not be a business. If it is a business, the person who has an interest in the business. So we gave these shareholders. It is just a matter of giving the shareholder and then their interest in the business, and that's all. So that's the only thing that we need from them. Number one, we have the shareholders. The shareholders are the owners. So shareholders are people who own the business, and they also have a claim on the business, and their interest is, one, they expect good performance. Good performance of the company. But their main goal is actually return, the return on their capital. Since these are the people that bring in the capital, what they are only interested in is basically the return on their capital, and that's all with the shareholders. Of course, they have to look at the company is performing well, it can sustain in the long run, the survival of the company is okay, and it can be there for years as they keep on receiving their returns. That's what we want to talk about as far as shareholders are concerned. So we talk about the stakeholder and then their interest in the business. Two, we have employees. When you're talking about employees, don't just come and say maybe they're interested in paying their salaries. No. We know that these are the people who are recruited to work for the organization. So their interest is actually knowing whether the company has a going concern. So by having a going concern, it means they are assured of their salaries and wages. They will be coming. So they are assured that the salaries will actually be coming. And they are also assured of job. That's job security. So there are two things. We have job security, and at the same time, it is the job security is as a result of the organization having a going concern perspective. In other words, the business is expected to operate indefinitely in the future. So if the company is actually going to be there, then they expect that their salaries and jobs are assured. But all in all, they also expect better salaries and better working conditions. Number 3, we have the suppliers. Now, the suppliers, these are people who supply goods and services to the company on credit terms. So their interest, the suppliers, their interest is they are interested in knowing whether there is also a going concern. Because by having a going concern, they are assured of continuous supply. You are going to be supplying the organization, and they are also interested in the performance. Because if the company is performing well, performance of the company, if the company is performing well, it means their money will actually be paid in time, on time. The other one we can look at are the customers. These customers, they are the consumers of the goods and services of the company, and they are interested in quality. They are interested in quality products and services. Of course, even the price, basing on the prices, even fair prices. Fair prices. The other one we may look at is government and its agents. Of course, these are only interested in compliance. Compliance with the regulations. Is the organization compliant? Is it registered? Is it not polluting the environment? Because these we may have even, is it paying taxes? So we have other agencies, the URA, the NEMA. So we have so many government agencies that need compliance to the legal regulations. The other one, we have the credit institutions. These are people who provide credit. So they provide credit to the organization, and they are interested in being paid on time, timely payments of the money of the interest and whatever. They are also interested in the performance, because there is no way they are going to give you the money when the company is not performing. So they are interested in the performance of the company. And they have to be sure that there is also what we call a going concern, because they can't give you money when you are going to close, because they may give you money and then you close. So the other one, we can look at the community. Now for the community, this is where the business is located. It may be a factory, and for them, they expect support through the corporate social responsibilities. Like building schools, building hospitals, and other things. So there are many other things. We have also competitors. We have competitors. And for these competitors, of course, they just want to look at your products. They see how they can compete with you. So what you have to understand is that these stakeholders, they are divided into two. We've said there are those that are internal and those that are external. So you can also come and categorize those that are going to be in the internal and those that are going to be in the external. Of course, the external, they are the ones that are many. External stakeholders, those that are outside the business, have, of course, the customers, we have the suppliers, we have banks or credit institutions or financial institutions, we have the government and its agencies, we have the competitors, we have also the community. So there are others, but those are the ones that we wanted to look at. So the internal stakeholders, we have the employees, we have the managers. The other side for external, we're supposed also to put in the shareholders, because they are not part of the organization itself. So the shareholders are the external that we forgot to highlight there. So those are the things that we wanted to look at as far as this lecture is concerned. What we need to look at next are the essential concepts. Essential concepts of finance. And this is going to be our next. This is what we are going to start with in the next lecture. So thank you for watching. Hello everyone, welcome back to our YouTube channel. If you are new to this channel, I request that you subscribe and also turn on the notification bell icon so that you can be notified when we upload a new video. However, if you are a returning subscriber, I appreciate you for trusting our content and supporting us. So without wasting more time, let's dive in and get started with what we call the essential concepts of finance. Now, here we begin by understanding what we call interest. We begin by understanding what interest is, and the examiner will never ask you what interest is, but in this course, interest refers to the cost of using borrowed funds or borrowed money. Cost of using borrowed funds is what we call the interest. But as I say, the examiner will not ask you for the definition, but we needed to understand it. Now, for the interest, there are things that we need to note. Interest on the side of the borrower, when you're talking about interest on the side of the borrower, the person borrowing the money is going to see that as it is a charge that the borrower pays for using, that the borrower pays for using funds obtained from outside the company. So it is the charge that a borrower has to pay for using borrowed funds that are obtained outside his or her company, and that's all for interest. However, we have got types of interest. We have the types of interest. Here we have what we call the simple interest and what we call the compound interest. So there are two types. We have the simple interest and then the compound interest. So simple interest is what is mainly what you learned in primary, because these are the same things that we did in primary schools, where we said interest equals the principal times rate times time. In other words, we said it is P times R times T. Principal times rate times time. That's what we learned from primary schools or high school. And that formula has never changed up to now. Although the examiner will not give you this formula on the formula sheet, but just know that has never changed for a simple interest. Therefore, the simple interest, if you want to get it definition-wise, is a one-off payment. Simple interest is a one-off payment paid or received in future for using a principal sum of money, a principal sum of money today. So it is a one-off payment that is paid or received in the future for using a principal sum of money today. And when you look at the compound interest, because we said we have the simple interest and then the compound interest. The compound interest refers to the situation where interest realized or received earlier also earns interest. Also earns interest in the future. In other words, it's a situation where the interest that is received or realized earlier also earn more interest in the future. In other words, for compound interest, in other words, if the interest is compounded, it means you are going to earn interest on interest. Meaning, interest itself can actually earn you more interest. But we said the formula for compound interest is the principal into 1 plus r to power n minus p. And this p is the principal or the money that we have used. And r is the rate. In other words, the rate that is charged on the borrowed funds. Rate charged on borrowed funds. Then this one is the principal amount borrowed. And this n here is the duration or the period. The duration or the number of years number of years that we've been with that money. That, like, maybe we've borrowed money for 2 years, 3 years, depending on whichever period that we are taking that money for. Now, when you compute this compound interest, and then you take away the principal you have borrowed, what you remain with is what we call the compound interest. In other words, this figure you are seeing here will compute the principal plus the interest. Then when you get the principal and the interest, we make sure we take off the interest, or we subtract the principal, and what will remain with is what we call the compound interest. But the whole idea for compound interest is that interest earns more interest in the future. So this is the whole idea, and we shall look at it when we start off some computations. But here we are just giving a brief introduction. The other thing that I need to talk about is what we call the discount factor. You may call it a discount rate, discount value. Now, we need to understand what is a discounting factor. And a discount factor refers to the rate of return that equates a future value to the principal value of money today, or what we call the present value. In other words, a discounting factor is a rate of return that equates the future value to the present value. For example, if let's say you have invested your money, let's say you have invested in tree planting, and specifically we can talk about projects like pine trees. We can talk about things like eucalyptus trees and others. And you expect, let's say, you expect to get 200 million, maybe in 10 years time. So you have gone ahead, you planted your pine trees or eucalyptus trees, but you expect in 10 years time you'll be able to get 200 million, meaning 10 years from now you'll be able to get this 200 million. But this 200 million is what we call the future value, or the value that we expect to get in the future. So we all know that these trees, they are actually going to take long to grow. However, if If you are to go maybe to the bank, if let's say you want to go to the bank, you have gotten some challenges and you want to go to the bank and get a loan. And the loan is going to be basing on this project of trees. It's going to be basing on that forest. And the bank will ask you how much is the forest. That's what the bank will ask you. So for the bank, the figure they are going to ask, it will not be the amount you expect to get in the future, but they will be asking how much is the forest now. In other words, your trees are worth how much as of now. And for you to get that figure, it means you have to do what we call discounting. So this means that the 200 million you anticipate to receive in the future, in 10 years' time, you expect to get 200 million in 10 years. So we shall discount this value of the 200 million, we discount it back to make it present today. So that's what it means by knowing your value today. Now, for you to discount this 200 million, to make it present today, you need to do what we call discounting. And discounting will need a discounting factor. Therefore, if they ask you for a discounting factor, then it will be the rate that will equate the future sum to the present worth. So it's all about looking at that amount you expect to get in the future and you convert it back to its present value today. And that's what we call, or that's what discounting factor does. Now, finally, in this paper, we shall be looking at what we call future cash flows. These future cash flows, as I've given you an example, the 200 million we expect from our forest in 10 years' time, that's what we call a future cash inflow, because it is an inflow because we expect that cash to be coming in. It is an outflow when we are expecting cash to be taken away from us. So in this paper, we shall be looking at future cash inflows, but we try to make them today by doing what we call discounting, or by discounting them. And the formula for a discounting factor, or we can use a short abbreviation, DCF, which also means discounting factor. So the discounting factor will be equaling to 1 over 1 plus r to power n. Or some books they write it as 1 plus r to power negative n. So this is the formula that we use, and this will give us what we call the discounting factor. So now from here, let's look at a simple case before we proceed to other areas, because you may get confused a little bit if we fail to understand the first principles that we have here. So let's internalize the simple interest before we look at the discounting kind of stuff. Let's first have a simple illustration to make sure that at least we have internalized the simple interest, and now we can be able to proceed to the next areas. Now, let's focus on simple interest first, because I need you to understand it. Maybe when we throw an illustration, because when you go to discounting, it will be a little bit confusing if at all we have not given some lights on some of these issues. The simple interest and at the same time the compound interest. Compound interest. These two areas, we need to have a deep understanding of these two ideas. So let's do an illustration and we can be able to understand some of these things thoroughly. But as I said, remember these things we said, these are the computations that we've been doing all the way through our high school, but they are the same things that we are going to repeat for now, just to remind ourselves on what is supposed to be done in these areas. So let's have an illustration. So illustration. Now, in this paper, at times we call the principal as the present value. Whenever we are talking about the principal amount you've borrowed, just know we are meaning the present value, because what you have borrowed, it means you have the money now, and that's what we call the present. So let's assume that if you borrowed 10 million, let's just use 10 million. If you borrowed 10 million today for a period of 2 years, then we need to know what would be the simple interest and the compound interest. If at all the rate is 10% per annum. This one, if the examiner doesn't tell you that it is per annum, we just assume it is per annum. It is always per annum unless specified by the examiner. So this is our illustration, and this is what I want us to focus on. So for simple interest, we said it is simply, if you are looking for simple interest, we said it is simply the principal times rate times time. So that's the formula for simple interest. Therefore, the principal board, we have 10 million. The principal board is 10 million. So it will be 10 million times the rate is 10%. So it will be 10%. Then multiply by time. Now, for the time they have told us, it is 2 years. So if you multiply this 10 times 10%, that's 1 million. 1 million times 2, that will give you 2 million. So the answer there is 2 million. And that's the interest. The simple interest is 2 million for the 2 years. Meaning each year you are going to be submitting 1 million. And for 2 years, you'll pay a total interest of 2 million. So if you borrow the 10 million at 10% per annum, it means that every year you're going to be paying 1 million. For 2 years, it will be 2 million. However, I want you to see how compound interest works. We are not going to first use the formula. We are going to first do a breakdown of what it means. Then we can finally look at the formula at once. Now, we are going to use the same question. So we are going to use the same figures up here in the question, and we are going to do what we call the compound interest. So you will ask yourself one thing, that in 1 year, how much interest am I going to be paying? In year 1, how much interest are we going to be paying? Because this is compounding, I just want you to take this analysis in this same format. So what is the interest to be paid in 1 year? And the formula is going to remain the same. We are going to use the same formula that we used above there for simple interest. So the interest, we said, is going to be the principal times the rate times time. You have to first listen to my argument before we look at before we apply the formula itself. So the formula is going to remain the same. So I want to first do it the way it's done for you to understand. And finally, I will bring in the compound interest formula. So in year 1, we are still going to use interest equals to principal times rate times time. So it will be, the interest will be 10 million times 10% times the time. Now for the time is going to be 1 year, because we are taking only 1 year. And this will give us 1 million. So it will give us 1 million. Now, we have now to go back and check in 2 years. In year 2, what is going to be the interest? Still, we are going to maintain the same formula. We say, now this is interest for year 1. Then we go to interest for year 2. it will be the same formula. The formula is up there, so we are just going to put in the figures. But now from here, we need to be careful, because in year 2, the interest for 1 year will be added to the principal, because we said compounding makes you earn interest on interest. So if we had the principal, the new principal, is going to be the amount we borrowed, which is 10 million, plus the interest for the first year, which is 1 million. When we do that, we shall get 11 million. That is our new principal. So it will be, the interest is going to be added, because we said that we earn interest on interest. So it will be, the principal will be increasing by the interest component, and that's what we did here. Of the year 1, the interest component of year 1, which we computed as 1 million. And that's what we call compounding. So what we are going to do here, we just get the 10 million times 10, sorry, it's not going to be 10 million. It's 11 million, that's the new principal, times 10%, but still we are computing for year 2, which is a 1 year, times 1 year. And this will give you 1.1 million. So this 1.1 million, it means the total interest we've got for compound interest was interest of year 1 plus the interest of year 2. And that will give you 1 million plus the 1.1 million. And this will give us 22.1 million. So for the 2 years, we will be paying 2.1. Remember, for simple interest, we only paid 2 million. And that's what we call the compounding. And that means the interest for the year will remain. For this one, we said the interest is actually going to be 2 million for compound, 2.1 for compound interest. But now we need to look at the formula. Let's look at the formula for compound interest. We say that the formula is principal into 1 plus r to power n minus the principal. So our principal, the first principal was 10 million into 1 plus 10% to power 2, because there were 2 years, minus the 10 million. And this will also give you 2.1 million. So whichever way you've gone, as long as you know the aspects, I hope everyone has understood that, because we may not do these same computations unless maybe it's within a question paper, and that's when you'll see me bringing it again. Otherwise, we are done differentiating these two interests. So what we can do now, we can go back to our discounting factor and see how we may apply it also. because we need to understand the discounting factor and we also know how to apply it. So I just wanted to get for you the difference between the simple interest and the compound interest before we proceed to discounting factor. Now, remember we said a discounting factor is that factor that makes a future sum present. That's what we said. And I gave you an example. Let's say you have maybe 10 cows and you know you will sell them maybe 5 years from now. In other words, you sell them 5 years later, and you assume that 5 years later your cows will be worth 20 million. Let's say they will be worth 20 million. And then the question is, how much will this 20 million be if at all you want to maybe to mortgage these cows? Maybe you want to go to the bank and they give you the loan today. So what we say that from there, they are going to use what we call the discounting factor. They are going to use the discounting factor to actually see their worth today. In other words, this future amount of 20 million, when they use the discounting factor that we said it is 1 over 1 plus r to power n, or the one that we said it is 1 plus r to power negative n. This is what we are going to use to discount this amount. So, we say the discounting factor is given by these two formulas. And we say there are some books they write it as 1 plus r to power negative n. That's how some books write the formula. And they are also correct because what they do, they just get the reciprocal of this, from our mathematics. To get the reciprocal, you just change if you have, let's say, 1 over n, then this is the same thing like someone saying negative n. They are the same. So that's what we are meaning from that perspective. So we have seen a simple interest, we've seen a compound interest, and we have also talked about a discounting factor, but there is also what we call an effective interest rate. Effective interest rate. It doesn't have a right symbol, but we can call it EIR, or we can just use a small r like that to represent effective interest rate. So let's look at the effective interest rate and we see what it means. Now, the effective interest rate, for effective interest rate, is that rate that you charge, which includes which includes all the borrowing costs. And this is mainly charged in banks. For example, a bank can quote for you that they are charging, let's say, they are charging 10%, and that's their quoted rate. But they go ahead to tell you that on top of that, we also charge what we call monitoring fee. There may be monitoring fees depending on the kind of loan that you've received. There are other costs to do with monitoring and evaluation. If let's say you want to get a logbook, they have to get the evaluation costs that you are supposed to incur. You wanted a logbook loan, they have to incur what we call monitoring the vehicle itself by maybe putting a tracker. They may also do what we call valuation. Of course, they may say, for us, we are going to finance your car 65% or 70%. But within this, it's you to pay the valuation costs, whereby they will get the valuer and to know the exact value that they are going to give to that car. So you find yourself incurring monitoring and valuation costs. They are also, banks also have what we call the processing fees. The processing fees, you may find that they are charging, let's say, 3% or 2%. 2% of the value of the loan that you are taking, and they take it as processing fees. And when you add the processing fees, the monitoring fees, and the interest they are telling you that they are charging, everything that is summed up, we get what we call the effective interest rate. In other words, it's that interest that includes all the the borrowing costs that are monetary in nature, because there are other costs that we are going to incur but can't be quantified. Therefore, in the agreement, because what is going to happen is that in the agreement, you will never see what we call the effective interest rate. What you will only see is what we call a nominal, it's called a nominal rate, this 10%. The nominal rate or the quoted rate, it's what they tell you. They tell you, for us, we'll earn at 10%. But on top of the 10%, there are processing fees, there are others, they just charge a fixed amount of application fees. So it depends on how they have, it depends on their policy. So whenever we include all these other costs, we get what we call the effective interest rate. But as you go to the bank, they will never tell you that our interest is this, because you may add the nominal rate plus these other 3%, maybe the monitoring is, let's say, 0.5, insurance is, let's say, 0.01%. So you find that all these costs, when you sum them up, they give you what we call the effective interest rate. But when you come to the bank, they will never tell you that we are charging you, let's say, 15%. They will only tell you the nominal rate or the quoted rate. And the nominal rate is what is the one that we call the quoted interest rate. But the only day that you are going to see, if you want to get this effective interest rate, you will only see when you ask for what we call the repayment schedule. Because on that repayment schedule, they will show you that this amount is going to insurance, this amount is going to this amount is administration costs. So there are other costs that are hidden, but they will never tell you, because they only give you the nominal rate or the rate that is quoted. In other words, all these costs When you put them all together, we get what we call the effective interest rates. However, the concern here is how do we compute the effective interest rate? And this is where students get confused. Therefore, we need to be careful when we are handling this section, because the examiner can also ask you to compute the effective interest rate. But you should know that an effective interest rate is an annual rate. The effective interest rate, we said it doesn't have an abbreviation, but we can use that, or we can use a small r. We said this is always an annual rate. So you be careful. The effective interest rate is always, because there are those costs that are going to be charged on a monthly basis. But this annual interest rate is an annual rate. And it is computed using a formula. The formula for effective interest rate is 1 plus R to power n minus 1. It is 1 plus R to power n minus 1. And that's the formula that we use to calculate the effective interest rate. And if you look at these items, the R, this R is our interest rate. Then our N is what we call the number of years or the duration. And this interest rate is what we call the nominal or the quoted interest rate. Now, there is when the effective interest rate is compounded. We can look at a situation where the effective interest rate has been compounded. Now, it is called compounded or multi-compounded. And I need you to understand this area, because this area, if you don't actually understand it, you'll actually meet problems, because this area is very important. But let's first understand what multi-compounding or compounding means before we go any further. Compounding, we looked at it, but or what we call the multi-compounding. Let's first understand this. Definition-wise, it refers to how many times interest is paid or received in a year, a single year. So, how many times is the interest being compounded or has been paid or received in a year? If you give out a loan and you receive your interest on a monthly basis, then it means in a year you receive it 12 times. If You are receiving your interest at the end of 3 months. That's what we call a quarter. It means in a year you receive interest 4 times. If it is semi-annual, then it means you receive your interest twice a year. So those are the things that we refer to as compounding. How many times is the interest being paid or received? So you need to be very careful with compounding, or what we call multi-compounding. And the formula, because now if there is an element of compounding, then the formula changes. So for the effective interest rate, if there is an element of multi-compounding, then the formula also changes. So for that case, for effective interest rate, in that case, is going to change. And it will depend on how many times the interest has been paid in a year. So there are those, we said there are those that are going to receive it on a monthly basis. It means they are going to receive 12 times a year. Those that are going to be, when it is semi-annual, it means that this is going to be twice a year, 2 times a year. Quarterly is going to be 4 times a year. So if it is a weekly stuff, then you know it's going to have 52 times a year. So it depends on what the examiner wants, but these items are very, very important as far as financial management is concerned. Even paper-wise, this compounding aspect is very important. So once you begin paying interest every month, or what we call on a monthly basis, then we call it compounding. Meaning that the interest is being compounded and you are going to pay, maybe you are going to pay every quarter, like for personal loans. For those guys who are picking loans, if you go for a salary loan, you are paying every month, meaning your interest is compounded 12 times a year. If you delay to pay your salary, if you delay with your salary, you may find that you have accumulated what we call arrears. So arrears, meaning the interest was not paid, so it becomes a principal. Because if you don't pay the installment, if I'm supposed to receive the installment this month and I don't receive the installment, the interest is going to become part of the principal. Meaning, even at the end of the day, you are going to be paying interest on the interest that wasn't paid. That's what we call compounding. I hope we are at par. Now let's look at the formula. So, if there is compounding, then effective interest rate is going to change. And it's going to be 1 plus R divided by M into a power N times M. N times M minus 1. So this is going to be the formula, where M is going to be the number of times interest is paid or received in a year, and N will be the duration. The rest are the same. Then our R is what we call the rate. So the effective interest rate will change if there is an element of compounding. So it's going to depend on the scenario in the question. So you need to decide yours, whether it's going to be, whether the interest, because what is going to happen is that it will be on your side to find out in an exam whether interest has been compounded or it has not been compounded. And if it has been compounded, then the formula will change to that one. And to emphasize this is that interest is always going to be compounded in an exam, because that's where the trick is. Otherwise, the rest is easy to do. But the trick here is on the compounding. So that's why I'm very concerned, and I'm making sure that at least we get this we pick it from the first things that we have before we proceed. So for this, and the other thing is that this formula here is not provided on the formula sheet. It's not provided on the formula sheet, and you need to actually have it in your head. Therefore, that's what we wanted to cover as far as compounding is concerned on the side of effective interest rate. I hope you can now understand how compounding is done. So compounding, as we said, is the number of times the interest is paid or received in a year. For example, it could be semi-annual, meaning the interest is paid twice a year. The examiner can also tell you that the interest is being paid on a quarterly basis, meaning it's going to be paid 4 times every year. And finally, it could be compounded every month, meaning in a year, it will be paid 12 times. I'm repeating this because I know they are very important for us. So, I talked about the word nominal interest. I talked about the word nominal interest, or what we call the quoted rate. So the nominal interest is that interest that is quoted. For example, when you go to the bank and ask what is the interest on this loan, if they give you a loan, then you ask what is the interest. They may tell you it is 18, we charge at 18%. So just know that that quoted interest, or that nominal rate of 18% is what they have told you. Actually, what they have told you is a nominal rate. But also, there is also what we call real interest rate. Now, the real interest rates, these are rates that reflect current prices. They reflect current prices and don't factor or include in what we call the future inflation. So these represent interest rates that are current without including future inflation, because inflation, remember, inflation is always there. But the real rates, those are going to be the rates that are going to be representing the current situation. And when we reach investment decision, then I will be explaining more on some of these ideas and you will understand them better, because you need to know what we call the real interest rates and then the nominal interest rates. But there are some key points that I need to make straight away from here, that because some of these things we need to understand them, especially when you are doing investment decision or capital budgeting decision, because the nominal rates and the real rates, we mainly use them under investment decision. That's where they are more applicable. Most of the time is we focus on those two. There is no way you are going to look at the cash flows or discounting without first considering the interest rates that they have provided for you, or the rates that they have provided for you. Even in the advanced financial management paper, for their case there is also a bit wide, and we'll talk about them often, because these two, they are associated with what we call the Fisher's formula. Money rates and all that. We shall talk about some of those things when we go to investment decision, which is coming very soon. But these are the things that I want you to cram. If you can't understand them, make sure you cram them from these two rates. So if you don't understand them, make sure you cram. There are two things that I need to note. One is that we always discount cash flows using market interest rates. Those that are prevailing current situations, and not, there are also those that we call the coupon rates. Coupon rates. But also, these coupon rates, they are the ones that we use. Coupon rates, they are the ones that we use to get cash flows. Coupon rates helps helps us to get cash flows. Even when we are dealing with financial assets, we shall use some of these aspects. So we need to understand them. But if you want to understand what a coupon rate is, so a coupon rate is a nominal rate. In other words, this coupon rate is a nominal interest rate. And this coupon rate, they will always tell you. For example, if you're applying for, let's say, a loan, or you're applying for a debenture or a bond, then they will tell you that this debenture is, let's say, 7% per annum. They may tell you it is 10%. And that 10% or 7%, whichever it is what we call the coupon rate or the quoted rate. But this coupon rate of 7% is the one that we are going to use to generate the cash flows. But now, the market rate, they will also give you what we call the market rate, the market interest rate. But this market interest rate is the one that is going to help us to discount the cash flows that we generated from the coupon rate. So we need to make sure that we understand these, because they are very important. They are theoretical, but they will take us from financing decision up to when we are done with investment decision. These are the things that we need to first understand. It is theoretical, but it is science in it. So let's now look at another term. The other term that we want to look at is what we call a discounting technique. I'm defining some of these key terms because I have seen when they are being asked. So it's not that we are just wasting time defining terms, but they are very important. So the discounting technique, this is an investment appraisal technique that takes into consideration the time value of money. So discounting techniques, most of them, they take all of them that are that discount cash flows, they take into what we call the time value of money. And for you to understand what we call the time value of money, time value of money is basically, if let's say you have $1 today, the argument here is that $1 today is better than $10 tomorrow. If someone gives you $1 today and someone tells you, I'll give you $10 in 10 days, after 10 days, you better receive the $1 today. There are reasons as to why you should take that money, because you can actually eat it. It can be used for current consumption. You can even invest that $1 today. The money you've received today doesn't have anything to do with inflation, because you've received the current money and it will move with the current situation in the country. Those are some of the reasons as to why we should hold a cash today than getting the cash later. So $1 today is better than $5 maybe in the next week, because once you get $1 today, then you can invest it to make more money in the future. Because we are talking about $1 as just a 1 shilling, but sometimes we may talk about maybe it is $100,000. You've received it today, and someone is telling, maybe you have a comparison. Someone can maybe say, I'm going to give you $100 at the end of the month. And the other person says, I'm going to give you $50 today. You better take the $50 today, because we don't actually know what will happen after 1 month. You may find that an item that was supposed to cost you $50 by 1 month, this time it may be at $8. So because of the inflation aspects. So you better receive the money today and you invest it to make more money. So that's the argument. So whenever we are analyzing things, we always take into consideration the time value of money. And that's why we discount the future cash flows. For example, we've said that, let's say there are those people that are saving with NSSF, National Social Security Fund, and they are supposed to access their retirement benefits when they have clocked 45 years. Meaning after 45 years, this is when they can access. And in this, if you are 45 years, you can only access. So if you are saving with NSSF, National Social Security Fund, and you're expecting your 20% by the time you reach 45 years. So, but now, if you are, let's say, if you are 30 years now, and you want to know how much your 20% will be, then what you will do, you can actually forecast that. So you can predict how much amount you'll be likely to have in your NSSF account. If you are 30 years and by the time you clock 45, it means there is a difference of 15 years. So you need to know how much is your 20% of this amount that you've saved with NSSF. So the issue is, by the time you reach 45 years, let's say that your NSSF account has, let's say, 200 million. So the question is, how much is that 200 million today? Because for you may say that, since, let's say my 20% is going to be the 200 million. So the question is, if you are going to receive that money in 15 years time, the question is, how much is this 200 million today when you're 30 years? And to get that amount, you apply a discount technique using a discount factor. So I just want to create a background for the computations because we shall need to see how the theory feeds into the computations. But you need to understand the theory because they are the ones that will guide you on the computations. Because if you are looking at the present value, PV, we say the discount factor is 1 over 1 plus R to power n. Remember, they have told us it is going to be 15 years from you are 30 and you just want to reach 45. The amount, the present value will actually be the future value times this. The whole of this is our discount factor. So we shall put this 200 million here and we also put these years here. But the question is, what will be the rate? So I'm just creating a background for you to understand. So we are not going to do any computation for now. Let's now look at something else. There is something that we call a sinking fund. Now, a sinking fund, this is what we call the sinking fund. In other words, it's a fund created out of a fixed payment. So it's a fund created out of a fixed payment each period to accumulate to a future sum. A future sum after a specified period of time. Specified period of time. You may say, we can take an example. For example, you may have a dream of buying land, maybe land worth 50 million. Now, if you have a dream of buying land worth 50 million, and for you to achieve it, you've decided, let's say, that I'm going to be saving a fixed amount of, let's say, 500,000. So if you are saving 500,000, you need to be specific. You are saving that money. What is the duration? Like you are saving it for maybe every 3 months. Let's say every 3 months you save 500,000. Just an assumption. So, but your dream is to buy a piece of land for 50 million in 2 years. Now, since you are saving 500 for every 3 months, we don't actually know whether the computations might be right, that when you compute this, you should be getting to the 50 million, but just get my argument. So if you are earning this money, you are saving this 500,000, it is a fixed amount, you pay it every 3 months. But now, what you do, you make sure you deposit this money in the bank. When you deposit this money in the bank is going to be paying you some interest on the money saved. It will be a saving. So by the time it clocks 2 years, whatever you have saved, because you can't, this one will not, I know it will not be equating to this. But when you add on the interest that you have accumulated for the period you have saved that fixed amount, we get what we call the targeted amount, or the future value of 50 million that we had planned. So that's the idea. So the 500 million, when you deposit in the bank, it earns some interest, but the payment should always remain fixed throughout the saving period to be able to achieve your dream. And this 500,000 is what we call a sinking fund, because it is a fixed payment that you pay every given period of time to accumulate to a future sum. However, the examiner will not tell you that this is a sinking fund, but he will provide you stories or a case or a scenario that will show you that this is actually a sinking case, a sinking fund. For example, he can tell you that someone is planning for, let's say, anniversary. Maybe they are celebrating for their maybe 10 years. If someone is planning for anniversary and the total amount for anniversary is, let's say, 30 million, we are just giving assumptions. So if it is 30 million, then the examiner is going to ask you how much are you going to save, or how much can this person put aside every year so that they can accumulate the 30 million. And that amount they are keeping aside is what we call a sinking fund. So we have a formula that we use to compute the sinking fund. But before that, you need to first understand that you are dealing with a sinking fund, because if you don't actually know the definition, then you can't be able to pass the computations. Now, the formula comes here, but at times a sinking fund can be called an annuity and can be estimated using this formula. Let's have a formula. We are going to write the formula down for a sinking fund. But now, let's just use an assumption that we are going to make some deposits, and maybe we are saving some money for a certain period of time to accumulate to a given amount. But as I said, what you have to note, this amount is going to be banked. So since it is an annuity is just a uniform cash flow. So it is called an annuity because you are going to provide an amount, or you are going to save a given amount, a fixed amount, to accumulate to a future sum. But we are going to look at annuity shortly after this. So let's look at the formula. Sinking fund The formula for sinking fund is future value annuity. We'll open a bigger bracket. This is R over 1 plus R to power n minus 1. So that's the formula, where this FVA is the future value annuity. This R is our discount rate. So that's the formula that we use. But when we are doing some computations, we shall have other steps or other options. We have a second method, but it has steps that we follow to help us compute what we call a sinking fund. But now, we talked about the word annuity. And annuity is the uniform amount or cash flow. A uniform cash flow or amount that you save, that you either save or pay up to the end of the period. Like the rent you pay. The rent you pay per month, you pay every month, and the amount is fixed until the landlord increases it. Or the salary you receive every month, it is fixed until the HR or the administration increase your salary. So even for a sinking fund is an annuity because it will be uniform for every period until the end of the period. And we use the above formula to compute it. And we shall see how we can be able to do some of the different computations. But for now, let's look at something that we call time value of money, the time value of money concept. The concept of time value of money. We are looking at the concept of time value of money. Now, we need to look at what is the concept of time value of money. This concept, it's actually a concept. It is a concept that the amount of money to be received in the future is less than the value of the money today, or the one that is on hand today. A dollar today is more valuable than a dollar tomorrow. And that's all that we need to know about the concept of time value of money. So, if they ask you, what does the word time value of money mean? And that's what you should write and nothing else. And if actually you want, you can also say that $1 today is better than maybe $10 or $2 a year later. And that's what I mean if I'm to put if I'm to put in the concept of time value of money. So some of these definitions we are giving them because sometimes they ask them. There is a year when they asked, it was I think May 2018, question 2. They asked about some of these definitions: the discounting technique, the sinking fund, time value of money, and others. That's why I was actually providing some of those issues. However, there is one key term that we haven't explained, and I had forgotten it. There is what we call perpetuity. I had forgotten this one, perpetuity. So we need to know what it means. Perpetuity means a cash flow, and you must understand when I talk about, when I'm using the word cash flow, because for the cash flows, we are technically referring to either cash inflows or cash outflows. For example, when you pay out rent, it is a cash outflow. But when you receive salary, it is a cash inflow. But generally, perpetuity refers to these cash flows. And these cash flows that we are talking about, they are supposed to be received or paid indefinitely, meaning they have a going concern. They should be received or paid indefinitely. So you should understand when we talk about cash flows, things that are paid in and those that are paid out, they are generally referred to as cash flows. And I hope you get what I mean if I say it is one is out and the other is in. So for the perpetuity, first of all, it is a uniform cash flow. Is a uniform cash flow you pay out or receive indefinitely. Indefinitely, or what we call up to infinity. For example, an example that we can use, they are shares. If let's say you buy shares, let's say in MTN, if you buy shares in MTN, it means that every year you expect to receive dividends. So you expect to receive what we call dividends. And these dividends, you will get them as long as MTN is available. In other words, even if you die, your beneficiaries will actually be receiving the dividends. Meaning, as long as the organization is there, you are going to be receiving the dividends. And that's what we call perpetuity. But there is also a way that we can discount perpetuities. We use a formula. So we shall look at those computations later. But for now, let's look at the future value and the present value, because we've been using all these words, but we just want to know what they mean. We've been using these words. Now, let's start off with present value. I want to give it a background. I said if you expect to earn or receive, let's say you expect to receive 100 million in 5 years' time. So you expect to receive 100 million 5 years later or from now. The question is, how much is this money today, especially if the market rate is, let's say, the market rate is, say it is 15% or 18%. So from here, I want to explain those two terms above. I want to look at the present value, and at the same time I look at the future value. So let's try to put in time. Let's try to put in time here. You expect to receive 100 million in 5 years, 5 years from now, at a market rate of 15%. Now what I want us to put in the years or the periods. Now let's try to put in, let's say this is 2024, and 5 years from now it will be 2029, meaning this 100 million you expect to receive will be in the year 2029. Here, that's where we have the money, in 2029. But we want to know how much is this money today. We want to know how much this one is today. And today is 2024. So this is our today, this is the tomorrow. So this is what we call the present value. The figure that we want to know here is what we call the present value. And this 100 million here is what we call the future value. So this is the present value. However, I told you that if you have a future value and you want to make it present, we do that by discounting. And we said discounting, we need to have a discounting factor. And we said a discounting factor is equal to 1 over 1 plus R to power n. That is the formula for our discounting factor. That is going to help us transfer this future cash flow into the present that we don't know. So the present value will be equaling the present value that we are looking for will be the future value divided by 1 plus r to power n. Or the other person can say it is the future value times the discount factor 1 out of 1 plus r to power n. This is the discount factor. So by multiply this, we multiply this, it takes you to this side. So this is the formula that we shall use to discount all our cash flows. Therefore, the future value, we have it. They gave us the future value. And the future value is 100 million. So it will be 100 million over 1 plus R. Our R is 15%. They gave us here 15%. We put that in a bracket. We now look at the number of years from 2024 to 2029. Those are 5 years, and they gave them us here. They gave them to us. And this, if you plug that value in the calculator, that's why I told you one of the requirements, you need to have a scientific calculator, because this one, you just put in the bracket, you just put everything on the calculator. You don't need to. We are not kids that we have to break this one down. As long as you can put it on the calculator and you get the right answer, no need to break down. And this will give us 49.7 million. So that means we've discounted the 100 million that we anticipate to receive in the future in 2029, and you expect to receive that money today. So meaning, if you are to go to the bank to borrow money, they will only give you 49.7 million, even though you are expecting 100 million. And the reason as why they are giving you less money is because they are taking into consideration the time value of money. That the money you have today is more valuable than what you will get in the future. And that's exactly what you are seeing from this perspective, that we are seeing the money, you are going to receive 100 million, but if you are to get it today, you will only get 49.7 million. And the only way to do that is by putting in this, by discounting the cash flows. And by discounting, you are taking care of the inflation and other economic conditions that may happen. So we've put in what we call the time value of money. So finally, we are getting to look at a great example, and I'm only creating a background. We are yet to look at a very good example, but here I'm just creating the background so that when we start talking about present value, future value, discounting factor, you know what we are talking about. So, although the present value is now being explained, then we need to look at the future value. So we need to have a perspective that you have this present value as this, but you want to compute back to get back to your 100 million. So this is going to be the things that you are going to do. Just assume today you have 49.7 million in 2024. 5 years from now to 2029, you want to know which value will be here. This one, 5 years. We are taking the same market market rate as 15%. So we want you to get to the point where we can actually be able to have that in place. Because it will be the same thing. This side we shall get the future value, which will be equaling to the present value into 1 plus r to power n. That will be the formula that we shall use. So let's now focus on the present value. Remember here we've said the answer will be 100 million that you will get. So let's now look at the future value. Now, if you, let's say, if you deposit, let's use another assumption to have this also understood. If you make a deposit of 100 million in the bank today, and they are giving you an interest of 10% per annum for 5 years, then how much will this money grow? How much are we going to be having after 5 years? You've deposited 10 million, they are giving you 10% per annum for 5 years. So now we want to find out how much we get in terms of the future value. But let me first take you back to what we said. We said the present value, equals the future value over 1 plus r to power n. But mathematically, if you make the future value here the subject of the formula, because this is going to be over 1, then you cross multiply. If you we are trying to make this one the subject of the formula. Future value will be equaling to the present value into 1 plus r to power n. And that's how we make the present value the subject of the formula. So we are now seeing that the future value is equaling the present value into 1 plus r to power n after that cross multiplication. However, the present value is the amount of money you have today. And the money we have today that we are depositing is 10 million. The 10 million is the money that we have today. So it is going to be 10 million. Our future value will be 10 million. We multiply that by 1 plus 15, the 10% percentage to power 5. So the rate is 10% and the n is 5 years. And this will give us what we call, it will give us 16.1 million. And that 16.1 million is what we call the future value. So I hope you have now understood how we get to the present value and how we get to the other values. Now I want you also to take back this value here. The value of 16.1 million, you take back, you get this 10 million. You get this as your present value, but using this as your future value. That's your homework, and make sure you put the answers in the comment section below. So We are now going to look at another item called annuity. I have already explained the word annuities, where an annuity is an asset that generates regular or uniform payments for a given period of time. But this definition is a bit longer. You can just say it's a uniform cash flow you expect to receive or pay. In other words, it must be a uniform cash flow. In other words, it must be uniform throughout. It's either you pay it or you are receiving it. So any of these two can actually define what an annuity is. However, we have got three types of annuities. We have different types of annuities. And the ones that are basically known, there are two. There are two types of annuities. One, there is what we call ordinary annuity. But sometimes the ordinary annuity, they call it deferred annuity. And then the other one, we have annuity due. Annuity due. So we have the deferred annuity, ordinary annuity, and the deferred and annuity due. But we need to understand their meanings. So let's start with annuity due. Annuity due. Annuity due means a uniform cash flow you either pay out or you are receiving at the start of the period. What is important is that it is occurring at the start of the period. That is what is very important from there. And when you look at the deferred annuity, for it is an annuity that is received or paid at the end of the period. So the key issue here is at the end of the period. So we need now to have some examples. We have rent. The rent we pay is an annuity due. Here we have rent. The rent we pay is an annuity due, while the salary, here for deferred we have salaries. The salary we receive it at the end of the month, so it is a deferred. since it is received at the end of the month or at the end of the period. But for the rent, rent is paid at the beginning of the month. Now, we need to know that if the examiner doesn't tell you that it's annuity due, then it is technically a deferred annuity. If the examiner doesn't tell you that this is an annuity due, then it is a deferred annuity, or what we call ordinary annuity, because we say deferred annuity is the same as the ordinary annuity. They are the same, or they mean the same thing. Since these are different items, these are also cash flows that are coming in at the beginning and those that are coming in at the end of the period. The question is, how are we going to be handling their present or future values? So we need to look at the future value of an ordinary annuity. Maybe we start with an ordinary annuity. So let's go to the future value of an ordinary annuity. Ordinary or deferred, we say they are the same. So this, we have a formula to compute it. The formula for deferred annuity, the future value of an ordinary annuity, let me call it OA, equals the cash flow. Let me just use CF to mean cash flow into 1 plus R to power n minus 1 over R. And the CF means present value. The CF is for present value. So you need to note that there is always a problem with the cash flow you are supposed to use. And we will say the cash flow that we use here is the present value. That's very important because we are looking for the future. Since we want to know the future, we use the present values. And we can only understand some of these in a better perspectives if at all we do some calculations. But we are not going to do computations here. We are just trying to analyze certain things. So now that's what we do for future value. Let's now look at the present value of an ordinary annuity. We see the formula. The present value of deferred annuity. We say they are the same. Now, if you are looking for the present value of an ordinary annuity, then the cash flow that we are going to use will be the future value. So whatever cash flow that we are using in the formula must be the future value. So, but we shall look at some examples to actually showcase some of our formulas that we are giving out. So the present value of ordinary annuity will be the future value we open these square brackets, 1 minus 1 plus r to power negative n over r. Then we put the left square bracket. So that's how we actually do the computations, or that's the formula that we use to actually get those values done. For this, maybe we can just throw some small example just to understand maybe this. If we assume that we are receiving shillings 10 million every year for the next 5 years, and we are going to invest, we invest at a rate of, let's say, 5% interest. That's the interest. Then what could be the present value of this annuity? If we are to do that small illustration, we just bring the formula PV ordinary annuity. We say the cash flow, it is the future. So we are assuming we are going to be receiving 10 million. So the cash flow is going to be the 10 million into 1 minus 1 plus. The interest rate is 5%. 5% is 0.05 to power negative 5. They are 5 years, and the percentage is 5%. So we divide by r, which is 0.05. Then when you sort it out, you'll get 43294767. That's the value that we will be getting. That will be the present value. You make sure that these equal signs, at least they are in a line, they are in a straight line, at least. So some of those formulas, we shall talk about them when we are handling questions. And I know questions, they are the ones that we are going to start on. They are the ones that we are going to spend more of our time handling. Hello everyone, welcome back to our YouTube channel. And if you are new to this channel, I request that you subscribe and also share to your friends so that they can have the same benefit that you are receiving. However, if you are a returning subscriber, I appreciate you for trusting our content, and I request that you turn on the notification bell icon so that you can stay notified whenever we upload new video lectures. So without wasting time, let's dive in and get started. And this is our lecture number 5. And what we are going to cover today is all about essential concepts. essential concepts of finance. But today we are starting our computations. As I said earlier, that in this topic is where we shall start our initial calculations, and we are going to have over 10 numbers. So we are going to have simulations over 10 numbers. So in these simulations, we are going to be looking at certain issues to do with the initial computations or the initial things that we need to have. So let's not waste any minutes. Let's just dive in and we'll look at the first simulation. So we look at the different simulations. So our question number one is going to be let me just use ABC Limited. ABC Limited, an investor having 50 million to be invested at a rate of 10% per annum. The question is, what will be its value after 5 years? That is our first simulation. That's our first simulation. Now, from here, we need to first know some of these questions. They are within our workbooks, but I make sure I repeat them here so that we can actually have to know certain things. Now, from here, we need to first know whether we are looking for a present value or we are looking for a future value. And based on the question, it shows that we are looking for a future value, since we are looking for the amount in 5 years' time. So let's begin the computations. Now, since we are looking for future value, we say that future value equals the present value into 1 plus r to power n. That is our present value. But we can see that ABC Limited is investing 50 million at a rate of, for them they are investing 50 million at a rate of 10% for 5 years. And this means that the amount they are investing now of 50 million becomes our present value. So we shall have the 50 million here into 1 plus R, and R is our interest rate, which is 10%, to the power of 5. And this will give you 80 million point 525 million. So it is 80.25 million. And then you can see that what they wanted us to do is they wanted us to find the value after 5 years. And we've done exactly what they wanted us to do. So let's now go to the second question. We've done with our number 1 question. So let's now proceed and do number 2. Question 2 says, supposing the above investment of 50 million is to have interest compounded twice a year, find the future value of this investment. That's our question 2. The same future value that they are talking about is this same. We are going to be using the same question for ABC Limited. The amount of 50 million, but now this time round, we are going to maintain the question, but what we are going to be focusing on is when the interest is compounded twice a year. In other words, it's semi-annual. And we said compounding the interest means that the interest will be paid. In other words, we are looking at the number of times interest has been paid in a year. And here they are telling us it's compounded twice in a year. And that's our main issue. That's the only thing that has changed from what we had in our question 1. So first of all, we need to understand what we are looking for. Either a present value or a future value. And here we are investing and we want to know the future values because that's what they are asking for, future value of the investment. So let's dive in and do the computation now. However, if you look at this, there is something that we need to emphasize on the future value. So the future value after any year's time is given by the formula present value. We need to emphasize this. Future value after any years is given by the formula present value into 1 plus R to power n. But if the interest is compounded if the interest is compounded, then it means the formula is going to change. And I hope you understand, because I talked about compounding in the previous lectures. And if you want to know more about compounding, you can go to our previous lectures, especially lecture number 4 will actually detail you with what we call compounding. You can learn about it more from there. However, I talked about compounding when I was dealing with effective interest rate. But for this case, if the interest is compounded, then it means the future value, the formula for the future value is going to change. And the formula we are going to be using, it will be the future value will be equaling to the present value into 1 plus R, but this R is going to be divided by M, and then to the power of N times M. That's only and only when there is compounding, which means that for this, the future value is going to be future value N years times M. That's the implication. So the formula changes from the normal future value that we knew to this new one. Because this one was just for N years time, maybe 1 year, 2 years, but this, the interest has been compounded twice a year. So we introduce in this M. M represents the number of times interest is paid or received in a year. So in this case, we are looking at a situation whereby the interest has been compounded, meaning that interest is being paid or received more than once a year. Although in this question, they said interest is compounded twice, meaning interest is received or paid 2 times a year. So, since the formula changes by just changing the R and we divide it by M, and we said M stands for the number of times interest has been compounded in a year. It can be semi-annual, it can be quarterly, it can be on a monthly basis or a weekly basis. However, we looked at this same scenario earlier, but you can rewrite it again to focus on it, because the formula will not be given on the formula sheet. This is the formula that we are going to be using. So you need to be knowing it. Therefore, the first simulation, or the number one simulation that we had, or the first illustration that we had, we never had any kind of compounding. But now in this one, we are compounding, and for examination purposes, the examiner will pick interest in these scenarios where there is compounding. So let's look at the question again. Let's go back to the question and see what we have in the question. They said ABC Limited, an investor having 50 million to be invested at a rate of 10% per annum. That's the question, but That's where the question is referring to that one. But here they are saying, supposing the above question or the above investment of 50 million is to have interest compounded twice, then they're asking us to find the future value of this investment. So, but if there is something that you feel like you need clarity on, just make sure that you always share those questions in your comment section on this same channel so that we can give you an immediate response to the issue that may be disturbing you before. I don't want you to wait until you finish maybe the lecture and you start asking. Every time you find that there is something that is unclear, raise it through the comment section. You will be responded to as soon as possible. So, because I need you to understand these areas before we go to other issues to do with maybe investment decisions, because it also has its own complications. So let's go through the question and we see what we can do. They are saying, suppose the above investment, and this above investment was for 5 years. And the only problem is that we are now compounding, but we are going to be investing same amount, the same amount of 50 million at a rate of 10%. The rate is still 10% per annum. So we can now incorporate everything in the formula because we have all the information that we have, that they have given us. So the future investment can now input the figures. Now, the future value will be equal to 50 million into 1 plus 10%. But this 10%, since we are paying interest twice a year, so we have to divide this by 2 because we are going to be paying interest twice a year. So this is 10%, divide it by 2. Then the number of years is going to be power 5. This is the n, but we have to multiply by 2 because the interest will be paid twice a year. And when you work out this, as I said earlier, these things you don't need to, you just plug everything in your calculator. You don't need to simplify some of these things. But if you want, you can first add that this is going to be 50 million into 10% divided by 2, that is 5%. So it will be 1.05 power 10. So when you do that, you'll be getting 81.445 million. And that's all. 81.445. That's all that we were supposed to do in that question. Let's look at simulation number 3. Number 3, this is number 3, part A. They are saying calculate the present value of shillings 600,000, assuming a 5% time preference. Preference rate. Then we have Roman 1 received 1 year from now. Roman 2 received at the end of 5 years. Roman 3 received at the end of 15 years. We have part B. Part B, they are saying assuming, part B they are saying determine the present value of shillings 700,000. Each paid at the end of each year for the next 6 years. Then assume an 8% rate of interest. Part C, assuming a 10% discount rate compute the present value of shillings 1 million, shillings 900, shillings 1.5 million, and shillings 700,000 received at the end of 1 through 4 years. In other words, year 1 we receive the first one, second year up to 4th year. So that's what we have. but we are going to start with the first one. We are going to start with the first one. Let's now start with our Roman 1. Roman 1, where the shilling 600,000 was received 1 year from now. Then they are asking for the present value. So what we need to know is we need to know if this 600 is a future value or a present value. And from the case for Roman number 1, we are receiving it after 1 year. So if today is, let's say, 27th, today is 29th July 2024, and if you are receiving 600,000 1 year later, then we need to know how much it is today. Therefore, this is a future sum and we want to make it present. And I said we can only do that by discounting back to know the present worth. So this is question 3. It is question 3, part A, Roman number 1. So we said that in this case we are discounting, but whenever we whatever we did in question 1 and 2, we were depositing money for it to grow in the future. Although in question 1 it was growing per annum, and in question 2 it was growing after every 6 months, because we could get some interest at 6 months and then we reinvest it, and that's why we are compounding. However, in this question 3, part A, Roman number 1, we are receiving money after a year, and the future value in this question is 600,000. The future value is 600,000 that we are receiving every year, and we are receiving it at a rate of 5% per annum. It is at 5% per annum, and our number of years is 1, because our N is 1, because we are receiving the money after 1 year. Now, we said that the discounting factor is always, the discount factor is always 1 out of 1 plus R power N. Or you can call it 1 plus R to power negative 1. We said some books they write it that way, which is just a reciprocal of the first one. Therefore, we said we discount the future value. So to get the present value, it will be the future value divided by 1 plus r to power n. And I hope you can actually be able to understand this. Thus, the future value in the question is 600,000. So when you get the 600,000 over 1 plus 5% to power 1, because our n is 1. So if you plug that in your calculator, you'll be able to get 571,429 shillings. That will be your present value. So we are finished with that. Meaning, if you expect to receive 600,000, if this is the 600,000 that you are going to receive in 1 year's time, if you are to get this money today at a rate of 5%, it will not be 600, but it will be 571,429 shillings only. So that's what we were supposed to do in that part 1, or Roman number 1. Now we are going to look at the Roman number 2. So, since we are doing these things for the first time, then you shouldn't get lost. We are supposed to move in the same way. Now, from part 2, or our Roman 2, it's question 3, part A, Roman 2. We are receiving this 600,000. We are receiving the 600,000 at the end of year 5. And this means that the present value is going to be using the same formula. We are going to be using the same formula. So, the present value, PV, is going to be equal to the future value over 1 plus R to the power n. That's the same formula that we are going to be using. But we get the future value, we divide by 1 plus R to power n. And our n is the number of years, R is the discount rate. So we can now plug in the numbers so that we can be able to get answers. This is 600, the future value. This is the 600 that we are getting at the end of the 5th year. So we shall divide the 600 by 1 plus our R is 5% to the power 5. That's 5 years. And when you plug that in your calculator, it will give you 470,109 shillings. So that will be the present value after 5 years. That's the money that you receive. So no, this is the present value for the money that we are receiving, that we hope to receive in 5 years' time. So that's our Roman number 2. So let's go to Roman number 3. Question 3, part A, Roman number 3. Here you are investing the 600,000. The 600,000 is the amount that we are investing. And no, we are expecting to receive the 600,000 at the end of 15 years. And then they want us to know how much that will be today. So it is the same thing. We are looking for the present value, and we are going to discount this future value so that we can be able to get its worth now. So it will be the same thing, present value equaling the future value divided by 1 plus r to the power n. Same formula. Therefore, it's going to be the 600,000. This is the money we are expecting to receive over 1 plus our R is 5%. That is the discount rate to the power of 15. And when you work out that, you'll find that we have 288,610 shillings. So that's the money that you will receive. If you go to the bank, you expect to receive 600,000, but it's going to be in 15 years' time, which means if we discount that back to the present, it will only be giving you 288,610. So I hope now you can see the deviation in the answers. When someone tells you that you will receive 600,000 in 15 years from now, then its worth is this 288 for now. Meaning, if you were to get a loan today, then you will only qualify for this. And I hope you are getting my argument from that perspective. Because we need to learn how to discount, because we are going to do these things more often, especially when we are doing investment decision. So let's continue with the question, but you must be on the same pace, since we are doing these numbers for the first time. But as we go on, we shall keep giving some of these formulas, because some of these formulas we've been using them. So we are done with part A, because it had 3 Roman numerals and we finished all the 3. So let's keep in mind the things that we've discussed as we proceed to the next part. So let's look at part B. Now, let's be careful with this part B. And this is where I want you to pick interest most. Here, they want the present value, but you will be receiving 700,000. You'll be receiving 700,000 at the end of each year for the next 6 years. End of each year until 6 years. And it's not like in part A, because in part A, you were receiving it after 15 years or 5 years. But here, every year you are receiving 700,000 up to 6 years. And you are getting that 700 at the end of each year, which means it's an ordinary annuity or deferred annuity. Therefore, for you to get the present value, it's a bit tricky. And this is how we are going to be doing it. So, you will allow me to first set up the years, the cash flows, and the DCF, or the discount factor plus the present value columns, because we are going to use a table to have this done. We are going to have the years, we are going to have the cash flows. We can just call it CF to mean cash flows. Then we are going to have the discount factor. We can call it DCF. And from there, we can go to, now we can look at the present value, or PV. So that's how our table is going to look like. So this is in a table format. So I'm going to give you a chance to also set up your table like the way I've set it up. Now, we are going now to start filling in the values. In year one, just use a different color. In year one, you are going to be receiving 700,000. That's what the question says. So the 700,000 is going to be under cash flows. And in year two, we are also going to be receiving the same amount, 700,000. As a cash flow. And we are going to continue up to the 6th year. So this is 3rd year, 700,000. 4th year, 700,000. 5th year, 700,000. Then the 6th year also have 700,000. So year 3 is 700, year 4 same 700, and in year 5 same 700, and finally in year 6 same 700,000. So we have now set up our table. But they told us the discount factor is 8%. So you can now copy the table, and we are We are going to fill it together. But just know what we are looking for is this present value, which we call the PV. That's what we are looking for. And these present values that we are looking for all these 6 years. But before we proceed with the table, let's try to see the difference between what we are doing now from what we did in part A. So if you look at what we did in part A, if you look at what we did in part A, Roman number 2, we are receiving the 600,000. And the 600,000, we are receiving it once after 5 years. And in this part 3, this Roman 3, we were receiving after 15 years. We are receiving the same 600,000, but we are receiving it once at the end of the 15th year. And in part 1, we are receiving the 600,000 once after 1 year. And in each stage, we are trying to find out how much it is today. We concluded that it's better we receive after 1 year, because after 1 year we were receiving more money. So the more you delay, or the more it delays, the lesser it becomes, because here you are seeing for 15 years it went up to 288,610. For the 5 years, it was 470,109. So the longer it stays, the lesser it becomes. And this, it is the one that is bringing us to the concept of time value of money, that $1 today is better than $2 tomorrow. And we can now see that it is practical because it was declining. However, in this part 2, or part B, we are receiving this 700,000 every year for 6 years. It's not at once, but every year we receive 700,000. And because of that, we use a table to be able to get the present value. So we begin now to discount the cash flows every year, and that's why we've put the table as you've seen here. We are discounting every item each year. And that's why we are including even the DCF, the discounting factor. And you have to indicate it as it is given per question, because they gave it, in our question they gave us 8%. Therefore, we are going to use the table. These DCF, the discounting factors, we can pick them from the table. We can pick that from the table. And this table will also be attached by the examiner, because whenever you open any past paper, you will see these tables that they are there. They will be attached in the formula section. And it is also, I also attached a copy in our notes for the discount factors. So we can take a look at them, or we can open any paper for financial management, and if we check from the formula section or the formula sheet, we'll have these tables. But when you try to check those past papers, you will see that there is a table with a formula that looks like this: 1 plus r power negative n. It will be there on the top extreme end, the top right corner. You will see this. And when you see that, it means you are now seeing the present value table. And you'll also see the present value. You will see the word present value written on top of that schedule. But there you'll find that the after that same table, there is also another table. There is also another present value factor, but for it is for annuity, ordinary annuity. It will also have a formula for ordinary annuity, which is different from this one. And that's not what we are going to use for now. We are going to use the table that has this formula here. In other words, if you don't want to check the table, you can actually use this same formula to get these answers by just substituting the rate and the period. You can just say 1 plus 8% to power -1. Then you put on the calculator. Whatever you get, you round it off to 3 decimal places and you put it there. So that's how we are getting those values. So, but now we are seeing that our cash flows, we are receiving cash flows of 700,000 each year for 6 years. But the key issue here is that you need to know the interest rate. Because on the table provides those interest rates. The table starts from 1% to 24%. There are you'll find two tables. The one that is running from 1% to 13%, sorry, to 12%, then the one from 13% to 24%. Meaning they are only giving us percentages in this range, 1 to 24. If you find the percentage that is above this, then it means we can't use the table. We shall be using the formula. But for now, you have to learn how to use the table, because we are doing this for the first time. Then there are those periods. Those periods, they are not years. There is that first column that has numbers. Those are periods and they are not years. Although the periods could be years, months, quarters, or even weeks. And the periods, they run up to 20. So when we receive a period or an interest that is above those provided, then we shall compute using the formula. And that formula is the one we gave for a discounting factor. And most of the times in advanced financial management, they give you things that are outside the formula, whereby you have to apply the formula, not using the table. So let's now locate you can try to locate the interest of 8% that is given in the table, that is given the question. And then you can also check out, you follow through the table, the first table, because 8% interest and period 1, the discount factor there is 0.926. So we bring that value into our column here. And that's how we are going to be picking these values, even if you just place it on the calculator. So the one for period 2 is 0.857. The one for period 3 is 0.794. The one for period 4 is 0.735. For period 5 is 0.681. Then the last one is 0.630. There are 3 decimal places. Even when you use a calculator, you make sure you round it to 3 decimal places. Now what we do, we just get the cash flow, we multiply the cash flow, we multiply by the discount factor. So we get the 700,000 times 0.926. So we get this times this, and that will give you 648,200 shillings. That is the present value for the first period. For the second one, it is 599,900. The third one is 555,800. The fourth one is 514,500. The fifth one is 407,700. Then you put the last one as 441,000. So we sum up and we get the total. We are only interested in the total of the present value. So the total, we are getting the total as 3,236,100. 3,236,100. This is the value that we are interested in. And that's the value, that's the present value that we will be looking for. So this 3,236,100 would be the present value. So this one is our present value. And this is the money that we will receive all from these sums of cash flows that we are receiving. So we are trying to add up these values here. They are the ones that we added up to give us the present value of 3,236,100. But what you have to note is that in the previous lecture, I mentioned something called annuity. And we defined it as a uniform cash flow that you receive every year. And from this same part B, this is the part B that we are talking about. This same part B, we realize that we have got what we call an annuity. And from this table, we can see that this 700 that we've been receiving every year is an annuity. Therefore, supposing they were 15 years, because now if they were 15 years, we couldn't be able to draw this table up to incorporate all the values for 15 years. If at all maybe they were 20 years, we couldn't make this 700 up to the 20th period. And there would be wasting our own time by using this table to calculate this same amount. So since this was an annuity, then we can use the annuity table. As I told you, the annuity table is always provided with the first table that we used. So you can now first give me a chance and I set up the annuity table. We see how it looks like, how we can use this table to make sure that we don't spend all the time here. Here we can have the years, we have the cash flows, let me just call it CF. Then we have the discount factor at 8%. Then we have the last one, which is the present value, PV. It is the same table, but this one is going to be very short, because if as I said, if we are having, let's say, 20 years, we wouldn't actually use that same first approach. This is the second method of calculating the same amount that we've gotten. So it's an alternative way of solving this above part B. So we are still solving part B, but this is an alternative method. So since the cash flows, because we've seen that the cash flows are uniform, and this alternative works when the cash flows are uniform. When they are not uniform, then this approach doesn't work. So we have the years, we have the cash flows, we have the discount factor, and then the present value. So if you are using the annuity table, and you have a uniform cash flow, it is starting year 1 up to year 6. So this is how you do it. Year 1 up to year 6. Because we are receiving the same amount. And because it's an annuity, and we are competing, it's like we are getting the same amount, 700,000 for all the years. What we do here, since we are competing with the time, we can just combine 1 to 6 years, and then you put the cash flow, the same cash flow, 700. But the discount rate is now 8%. In other words, here you are telling the examiner that you are combining the whole 6 years, 1 to 6 years. And in that case, we look at the annuity table so that we can be able to get the discount factor that we are going to use. So what we used last time was a present value table, and now we are looking for annuity table, which is the second one on the formula sheet. And you'll see it actually has a word on top here. It has a word ordinary annuity written on top of the table, plus the formula for annuity. So you can check the rate given in the question and also the period. And then you can read the figure. The figure we have there is 4.623. So when you multiply this 700 times 4.623, you'll be getting 3,236,100, which is exactly the same amount that we were looking for. It is this figure, we can also prove it from the first approach that we used. If you add all these values here, if you add them all, they are supposed to give you this value here, the 4.623. Therefore, it's all about what you choose to go with, because we have seen that both methods provide the same results, but to save time in an examination, then you can use the second approach. Although it may look hard for now, but by the time we reach to capital budgeting decisions, where we will be applying these things practically, then you'll be able to learn more from there. So we are now done with part B, but there is part C of the same question, same number. So let's look at it. So we look at now part C. Now, here we can see that every year we keep on receiving cash flows. Like for the first cash flow of shillings 1.1, 1,100,000. That's the first cash flow. For year 1. And we'll be receiving this in year 1. Then we have also shillings 900,000 as cash flow. We will be receiving in year 2 shillings 1.5 million will be received in year 3, and finally 700,000 will be received in year 4. Therefore, what we need to identify from here is whether this is an annuity or it's not an annuity. We need to know that. Are we dealing with an annuity or it's not an annuity? And basing on the cash flows, this is not an annuity, since the cash flows are not uniform. Therefore, we can't apply the annuity table or the annuity formulas when solving this scenario, since it is also looking at the present value, because even the question here, they're asking for the present value. So let's now set up the table that we are going to use. This is going to be the present value computation, because it's also so let's set up the table. We have the years, we have the cash flows, call them CF, we have the DCF, we have the PV, the present value. So let's first set up the table. So we have year 1, we are supposed to receive 1.1. Year 2, we are receiving 900,000. Year 3, we are receiving 1.5 million. Year 4, 700,000. At a rate of 10%. So we can now get our DCF values, or the discounting factors. So that's all that we need to have as far as the question 3 part C is concerned. So let's now look at what we have for the DCF. Here, we need now to check the tables. Or we said you can apply the formula of the DCF. We said the DCF is 1 plus R to power negative n. So you keep putting this one will go up here, then you put the 10% here. So it will be 1.1 power negative 1 power negative 2, and you keep pressing the calculator. But you make sure you round off to 3 decimal places if you don't want to use the table. So the first one is going to be 0.909. The second one is 0.826. The third one is 0.751. Then the fourth one is 0.683 as our DCF values. So we multiply the cash flow times the DCF value. So 1.1 times 0.909 will give us 9. It's quadrant 900. That's 999,900. This one is going to be 743,400. The third one is going to be 1,126,500. Then the last one is 478,100. So when you sum all these up, here you get the total PV. and it's what we are looking for, which is 3,347,900 shillings. This is the value that we were interested in. And that's all that we needed to do as far as part C is concerned. So let's now look at the other numbers. We look at the other simulations to sort all these cases to do with the initial computations. However, I said earlier that the DCF, the discount factor is given by the formula 1 plus R to the power of negative n, or it can be 1 over 1 plus R to the power n. So if you are using a discount rate, let's say we are using a discount rate of 10%, then we can use the formula to see how we are able to get the discount factor that we got of 0.909. And we got that, this is the value that we took from the present value table. But we got it after making these computations. It is 1 over 1 plus 10%. Since this was year 1, it will be power 1, and that will give you 0.909. I said you round off to 3 decimal places. Therefore, we can use a formula if the examiner doesn't give you the table. In other words, there are situations whereby, because we said the table is going to be from 1% to 24%. Now, what will happen if the examiner gives you a rate of, let's say, 25% or 30%? What will you do? We shall use this formula here to get our values. Secondly, for annuities, we also have annuities. We say these are uniform cash flows. So when you want to use the annuity factor, we also have, on this one, we pick what we call the annuity factor. But it may also happen that the percentage they have, because the table is 1%, it has a 1% to 24%. Now, what if they have given us, let's say, 25% or 30%? We can also use a formula. The annuity factor, the formula for annuity factor, we have it as 1 minus 1 plus R to the power of negative n, and we divide everything over R. That is the formula. Therefore, for the other numbers that we did using the annuity or using an annuity where we had 8%, that is where we had 8%. And we got the annuity factors 4.623. And if your if the discounting factor wasn't in the table, then we would just apply this formula, this one here, to get this same value. So it will be 1 minus 1 plus 8% to power. So that was for 6 years. We got this for 6 years. So it will be power negative 6 over the discount factor, which the interest rate, which was 8%, that is 0.08. And this will give us the same answer of 4.623. So when you place that on the calculator, it will give you that same answer. But we said you round off to 3 decimal places. Therefore, we should use the formula only when those discount rates are outside the ones that are given in the table. But as far as these values are given in the table, don't waste your time. Just pick those values and substitute in the table to have everything done to save time. So let's continue looking at other simulations, because that's what I wanted to highlight from that aspect. So let's look at number 4. Number 4 says Citibank pays a 12% compounding interest quarterly. Now, if shillings 1 million is deposited initially, how much shall it be at the end of 5 years? State Bank pays a 12% compound interest quarterly. If shillings 1 million is deposited initially, how much shall it be at the end of 5 years? That's the question that we have. So here, the question we are trying to find, we need to know whether we are trying to find either present value or a future value. And if you look at the question, here we are trying to find the future value. And secondly, when you look at the 12% interest, which is per annum, because this 12% that you are seeing here, they have not told us whether it is per annum or per month. But as long as they have not stated it is, we always assume that it is per annum. So the interest is per annum unless they have specified in the question. If they have not specified, we usually assume that it is per annum. But now there is a word compound. In other words, the interest is compounded quarterly. Compounded quarterly means that the interest will be paid 4 times a year. Since a year has 4 quarters. So the amount we are depositing is the present value. We are depositing 1 million. Initially, we are depositing 1 million, and that's our present value. And we are putting it there at a rate of 12%. But this is compounded. It is compounded quarterly, meaning there are 4 times. Interest is being paid 4 times a year. So the future value, normally the future value is always equal to the present value into 1 plus r to power n. But because of compounding, then the future value is going to change. The formula for the future value is going to change, and it's going to be, the future value is going to be equaling to the present value into 1 plus r. But our r is going to be divided by m to power n times m. And this m that we are introducing in is the one that is going to cater for interest being compounded 4 times a year. So since there is compounding, the formula changes, and we are no longer going to use this normal future value formula. So let's now plug in the values. We have the values. The future value will actually be the present value of 1 million into 1 plus our r is 12% divided by 4 to the power, there are how many years? It is 5 years, but this is compounded 4 times a year, meaning we are multiplying by 4. And when you plug that in your calculator, when you put that in your calculator, it's going to give you 1,806,111 shillings. So it is 1,806,111. That's the money that we will be with in 5 years' time when you have deposited 1 million initially. So, and that's all. That's all that they wanted us to do. Let's go to another simulation. Simulation 5. We have Kato is borrowing 50 million. 50 million to buy land in Kampala. If he pays equal installments for 25 years, and 4% interest on outstanding balance. What is the amount of installment? That is our part A. Part B, what shall be the amount of installment if quarterly payments are required to be made. There are two issues here, and that's the question that we have. Now, this person is borrowing 50 million. We start with part A. We are starting with part A. This person is borrowing 50 million for 25 years, paying 4% interest. Of course, this is per annum, 4% per annum. And it's like a loan. And they're asking you how much you'll pay per year. And that amount is always equal. Because they are giving you a loan of 50 million, you are going to buy land, but you'll pay back that loan for 25 years when you're paying an interest of 4%. So the question is, they want you to tell how much are they going to be paying each year. So this amount is supposed to be fixed. You determine the amount that Kato is going to be submitting every year. So let's now do the computations. And this area, you have to pick interest because this is a highly examinable area. Because they give you scenarios that the person is actually borrowing money, 50 million, at an interest rate of 4% for 25 years. So when you borrow money, you have to pay back. And what you are paying, you pay both the principal and at the same time you pay the interest. And this, of course, for the banks, they know how they can play around with that installment so that it is going to be a uniform payment. Maybe every year you are paying the same money. Every year you are paying the same money. But that same amount is inclusive of the principal and at the same time it has the interest. So the examiner is asking for how much you will be paying every year. which is the one that we call the equal annual installment. And for you to compute the equal annual installment, we have a formula for it. The formula is, you get the principal borrowed, you divide by the annuity factor. That's how we determine the equal installment. This installment, it may be a monthly installment, it may be a quarterly installment, it may also be annual installment. So whichever they call it, whether they want you to compute it on a monthly basis, it is the same stuff. You get the amount you've borrowed divided by the annuity factor. But the annuity factor, we always write this annuity factor AF. It is annuity factor for 25 years at an interest of 4%. This one we check from the table, or you can use the formula. So the principal bold or the amount bold, we have it. They are giving us 50 million. But what we need to check from the table is the annuity factor. But now we said from our table that the annuity tables, it starts from 1%. It gives you values from 1% to 24%. But for now, the examiner is giving us a period. And the period we said it starts from one period to 20th period. We said these periods, they could be months, they could be weeks, they could be anything. But this one is exceeding what we have in the table, meaning the table will not actually work. We have to go and apply the formula. Then later on, we shall come and feed into this. So we get the annuity factor 25 years, 4% interest. We say the annuity factor is 1, the formula is 1 minus 1 plus R power negative n over R. That's how we compute the annuity. That's the formula that we use. So we substitute in the values. It will be 1 minus, open bracket, 1 plus, the percentage is 4%, to power negative 25 over 0.04. 4% is 0.04. Then when you plug all those values in your calculator, that will give you 15.622. That is going to be the annuity factor. That's the annuity factor that we are going to plug in the other formula to get the annual installment. So we've got the annuity factor. Now we want to go back to the formula and we substitute in. So we can come and put here the figures. The amount borrowed was 50 million. We write all the zeros. We divide by 15.622. Then when we do that, we shall be able to get 3,200,615 shillings. That is the equal installment that we are going to be submitting every year. So that's the amount that you are supposed to pay per year. So, but here you have also to be careful with one thing. The examiner may give you on a quarterly basis, on a monthly basis, on a weekly basis. So it depends on what the examiner has provided. But for now, we are given per annum. But we shall look for more numbers that are going to be having different requirements. So this same formula can follow you when you are doing releases in your financial reporting, either financial reporting or advanced financial reporting paper, where you may have a note talking about leases, which is going to be paid, because for a lease we have two things. We have a lease liability and we have also an interest that we are supposed to pay. But you find yourself that you may want to create or to prepare an income statement and at the same time at the balance sheet. This value that we've gotten here of 3.2, you will not take all that value alone. You will have to split this value to have the interest component, and at the same time you separate it from the liability, because we said that this amount includes the principal and at the same time it has the interest. Remember, the interest is supposed to go in the income statement, and then the lease liability is supposed to be taken to the balance sheet section. So you find that you have to do something that we call amortization schedule. So we shall learn more about amortization. We shall get a number that will require us to compute that amortization schedule. So we shall come along with those numbers that will need such computations. But for now, the examiner only wanted us to find that installment that we are going to pay every year. So this money will be paid in the bank every year. So let's now look at part B, because that was part A. So part B. Part B says what should be the amount of installment if quarterly payments are required to be paid. And this is what we call compounding, where you are not doing the payment once a year, but you are going to be doing it on a quarterly basis. So let's see how we can compute this one with compounding. So therefore, here we are looking for equal quarterly payment or installment, and the formula remains the same. which is the principal borrowed or amount borrowed over the annuity factor, or divided by the annuity factor. But we need to look for the annuity factor, because we said annuity factor 25 years at 4% interest. But we know from here there is a word compounding. In other words, interest is paid 4 times a year. In other words, the annuity factor for n years, we always know that annuity factor for n years will be equaling to 1 minus 1 plus r power negative n over r. That is what we have for n years. But if we get something to do with compounding, then it means the r is going to be affected. The formula will change. And this, it will change, and it will be 1 minus 1 plus r, but this r is going to be divided by m to the power negative n times m over r divided by m. So that's what we are going to be using. That's the formula that we are going to be using because of compounding. So we are multiplying, or we are introducing in that m that is going to help us to do compound. As long as there is compounding, we divide the r in the formula. So we'll first look at the annuity factor n times m years, which will be 1 minus 1 plus 4% over 4, because it's going to be quarterly, so it is going to be over 4. Then this is going to be negative 25. The years are 25 times 4. Everything will be divided by 4%, divided by 4. So when you do that, we can maybe try to shorten it from here. It will be 1 minus 1.01 to the power negative 100 over 0.01, and this will give you 63.029. So this is the annuity factor that we are going to use. So we shall pick this annuity factor, we substitute in our formula, this one, amount borrowed over the annuity factor. So the amount borrowed, finally the quarterly annual installment or payment will be the 50 million divided by 63.029, and this will give us 793,286 shillings. You are seeing now the installment the installment has reduced. Since you are doing a quarterly payment, then the amount will go down. You are seeing this one. The other one we had 3.2. Now we have 793,286 shillings. So the installment has gone down, but actually the bank will be paid more money since it is compounded 4 times a year. And we can actually elaborate on this by doing what we call the amortization, but we shall look at a brief number that has such kind of schedules that are not all that longer. Because this one is too long, 25 is too long, we can't draw the amortization schedule. But we can finish it using the amortization schedule. And that's when you realize that actually the bank will be taking more money. So that's it as part B of that question 5. Let's now look at question 6 or simulation 6. We have ABC Limited. ABC Limited has issued debentures of shillings 50 million to be repaid after 7 years. How much should the company invest in a sinking fund, earning 12% in order to be able to repay the debentures. Now, so this is simulation 6, and for it we are looking at what we call sinking fund. So we have seen the investment of 50 million here for 7 years. Then they are asking you how much they can invest in a sinking fund, earning 12% interest in order to repay the debenture. But here, it's my idea that you get to know that this is a sinking fund. It was my idea to mention that this is a sinking fund, because the examiner will never write it there. But it will be you to identify that this is a sinking fund. But we defined the sinking fund from our previous videos, that a sinking fund is the amount we set aside to accumulate to a future sum. So it will be upon you to identify whether this is a sinking fund or it's not. So what is happening here is that ABC Limited is issuing a debenture or a promissory note, meaning that ABC Limited will receive a loan of 50 million and it will pay it in 7 years. And the examiner is asking how much they should begin saving per year in order for it to grow and reach the 50 million after 7 years, so that they can pay back the loan amount at once. In other words, the bank is borrowing money, 50 million, and they are going to pay the money at the end of 7 years. And what is happening is that the examiner is trying to find out how much can they save they can save in what we call a sinking fund that will earn them 12%, so that they can accumulate that money to 50 million. In other words, they borrowed 50 million, but they just want to know how much can they be paying per year, or how much they can save aside. Remember, for a sinking fund, the money is always deposited in the bank. And when the money is deposited in the bank, we said the bank pays you some interest. So if they pay you some interest, but you make sure that this amount is going to be constant throughout the period, throughout the 7 years that we are saving for. And the target is actually to raise 50 million to pay back the loan. And I hope you're getting the argument. And what you have to note is that the examiner will never tell you that this is a sinking fund, but it's up to you to know whether it is a sinking fund or not. So here we are looking at a sinking fund. But now there is something that you need to note. For the sinking fund, we always have two methods. We have a formula, and we also have steps that we can go through if at all we don't have the formula. So we have already identified that it's a sinking fund and it has a future value, which is the amount of money that we want to pay in the future, which is 50 million. And this 50 million will be after 7 years at an interest of 12% per annum. So now let's look at the steps. The steps we go through. Step number 1, because as I said, for a sinking fund, we have steps that will follow. This step number 1, we do what we discount. Step number 1 is to discount. Discount the future sum or the future value to make it present. To make it present. Because the reason as why we are doing it is because we want to save the money today. So we need to know how much can we be setting aside so that we keep on accumulating money until we get the targeted amount, the future value of 50 million. So the reason we are converting back, we are discounting the other future amount. We want to determine its present worth. So the first thing we do is to discount the future sum and we get its present value because we want to find how much we can save today. So this 50 million is our future value. And for us to be able to get the present value equals the future value over 1 plus r, the power of n. So the present value will be the future value we divide by the discount factor. And the discount factor for 7 years at 12% per annum. So they gave us the future value as 550 million. So we divide by 1 plus 12% power 7. And that's because if you check the table, the discount factor for 12%, 7 years is 0.452. So when you divide those two, or when you put that in the calculator, you'll be able to get 22,600,000. Ugandan shillings. And that's our step number 1. So let's go to step number 2. Step number 2, you get the equal annual amount to save. We get the equal annual amount to save. Now, in this step 2, it's going back to where we are saying the equal annual installment in the previous simulation. And this annual amount or equal amount is actually the sinking fund. And this sinking fund will be the present value we got in step 1 divided by the annuity factor for 7 years at 12% interest. So here we continue and we get the installment. We get the present value in step 1 divided by the annuity factor. So the annuity factor, this is for 7 years. It is there in the table. We can pick it from the table. Annuity factor, 7 years at 12%. That one is there in the table. So the present value we got up there was 22,600,000. We divide by the annuity factor, which is 4.564. So we got that from the table. So if you divide that, you'll be getting 4,951,797 shillings. And that's going to be the sinking fund. Therefore, the sinking fund is 4,951,797 shillings. In other words, we must save that amount for 7 years, and after 7 years, it would have grown to 50 million. So by the end of 7 years, we would be having 50 million. Now, there is a trick here. This amount, the 4,951,797, this is the money that you should be saving every month, sorry, every year. And by the end of the 7th year, we must be having 50 million. Now, if you're just seeing from the perspective of a layman's understanding, you will get this amount and you multiply it by 7. When you multiply it by 7, you will not actually get the 50 million that we are looking for. You will not. It will not be equal. And the reason, because this 4,951,797 is the amount we are supposed to keep aside. But this amount is supposed to be deposited in the bank. So we are going to deposit that money in the bank. And when that money is deposited in the bank, it will earn an interest of 12%. In other words, for us, we are going to be banking the same amount, a constant amount every year for 7 years. But the bank will be paying us 12% per annum. Meaning, by the end of 7 years, we should be having 50 million. That is the implication, but it doesn't necessarily mean that when you get the amount we are paying, you just multiply by 7, you will get to the very amount that we are looking for. No. Here we earn interest, and the money is supposed to be deposited in the bank. And that's how we can target the amount of 50 million in the 7 years. And we shall see how we can actually demonstrate this very idea, because we can have what we call a savings schedule. You show how much you are going to be saving. We shall have a number that will have something to do with savings, where we shall do the amortization schedule, and at the same time we do the savings schedule. They are different. Amortization schedule and the saving schedule, they are different, but we shall see how they are done. Now, there is also another way that we can prove this amount we've got. Remember, we said that there are 2 methods for determining the annual installment, or what we call the sinking fund. A sinking fund has a formula, but sometimes the examiner doesn't provide that formula. It is the cash flow, or what we call the future value, the future value into R over 1 plus R to the power of n minus 1, close the square brackets. This R is our interest rate. Then n is representing the duration or number of years. So basing on this formula, we are looking at how much we are going to save every year. And we can do this by just substituting the information that we have in the question in this formula. The future value we are looking for is the 50 million. So we shall put in the 50 million, we open the left square bracket, then we put in the percentage. We multiply that by the percentage, which is 12%. We divide that by 1 plus 12% to the power of 7 minus 1. Then we close the left square bracket. Now, when you plug this into your calculator, you'll find that it will actually give you the 4,951,797 shillings. Which is the same amount as we did above. But the reason I prefer that we do in the first format, or we use the first formula, is because at times the examiner doesn't provide this formula that we are using here in the formula sheet. But if at all you can be able to remember, then it will be okay to save time. So it's up to you to choose which one is easier for you when you are doing the numbers. So let's stop here for today, since this was just the initial computations that we've started with as far as essential concepts of finance are concerned. I just want us to look at something fresh when you're doing the amortization and the savings schedule. Maybe when we are fresh, that's when we can add in something, because we don't want to pump in more issues, especially for the computations, because we are just beginning them. But as we've said, the theory is more important. And I hope now you can realize that what I've been telling you, that you first give theory at least 30 minutes, at least every day, because I'm seeing that by the end of next lecture, we shall be shifting our revision time from 30 minutes a day to at least 1 hour a day, because we are seeing that the theory, if you don't read the theory, then you will not be able to do some of these numbers. Like if you don't actually know what a sinking fund is, you can't actually do it, even if the number is doable. So I pray that we focus as much as we can on the theoretical aspects, because it's very easy for you actually to misfire on some of these numbers for computations and you completely get zero. But for the theory, you can actually pick out some 2 to 3 marks from here and there. So that's all for now. Let's meet in the next video.